by AI. It's okay, right? You already know that, you already expect that. And the biggest lie that people are trying to sell you right now is, come down. AI will create more jobs, it will not replace you. You know what's funny? The same things were said to the people who were building carriages when Henry Ford was building the Model T. They were saying it's okay, the new cars, they will not replace you, they will just create more jobs for you. I don't think it actually happened, right? Exactly. So knowing this part of information, you need to start preparing yourself, because the only people who will be left, this remaining 19% of the workforce, will be the geeks feeding the AI, the super intelligence teams, the super geeks of the world. Someone recently said that this is the decade starting 2026, the decade that is named the revenge of the geeks. So all the people who will actually be happy throughout this decade, will have fun, will make a lot of money, will be the geeks, So this is why you want to pay very close attention. And this is not the Andrew Tate matrix. This is a completely different level in which, even if you try to learn something right here, right now, the information is changing and develops so fast that all the knowledge that you're acquiring today, tomorrow, it's an old story. There are new models every single day that are released, some of which sometimes are worse than the older model. And you will see the geeks are saying, you know what, we prefer the older models, the new model sucks. This is the big red flag that you want to pay very close attention to, right? Again, there is no way back, considering that the infrastructure for hundreds of billions of dollars is currently built, or is building, or is about to get built. $500 billion, $1 trillion, data centers, so on and so forth. And this is kind of interconnected with all the precious metals trade and proprietary natural goods and resources. A lot of countries, particularly China, are trying to curb down and try to protect their intellectual property. And again, don't be just saying that a lot of these models are operating on expensive sites. Some people said that the Chinese models who are copying the US models are actually operating faster, more optimized version, and this is again a big question mark. I'm not a geek. I don't know why this works better, but there's something that we don't really know. Pay very close attention. Every single day, the people who are currently fired from the big companies are not the HR departments. You will see engineers, senior engineers from Google fired, senior engineers from Microsoft fired. You will see financial institutions firing people. And we're not talking about data entry positions. And then these people go on the open market and they're not gonna go and drive for Uber, right? Senior engineer work 10, 15 years for these big tech companies. Well, they're gonna start their own AI company. This is where the mass saturation comes into play. And imagine, it's not you against the big technology corporations, it's you against the corporations, the geeks that work in corporations, and then the geeks who are fired from the corporations starting their own AI companies. So the wave is not that high, the wave is like triple the size that you can imagine. A lot of people don't even think about this, right? This is why the conceptual wisdom that probably you want to build and understand and try to apply, because you have what? It's 2026. You have 2 years, brothers and sisters. You have 24 months to find something out that will be able to kind of put you on the side. Sure, there will be areas of business, domains of life where the AI will simply not going to be able to evolve that fast. The barber will still be out there, right? I'm not sure about the other utility workers, but remember, they're not doing all this replacement because technology is just better. They're doing it because it's effective. It drives the cost lower, makes things effective, cheaper. This is why Elon Musk is saying that in the future, when the robots taking over, everyone's gonna be rich because no one has to work. And people will just enjoy the good times, and I don't think so. Yeah, not hyped about robots either. So guys, just as much as I know, a lot of you probably are not into technology at all. They're not interested, they don't really care, understand, I get you. It's kind of a forceful part of the history where a lot of people are forced to learn something that they don't want to learn. You kind of forced to at least probably take a position or learn a new skill in area where you really don't feel it. It's kind of an artificial feeling, artificial knowledge in the AI world. But this is something that obviously will make companies more and more profitable. And the profits are always the most important driver out there. Everything is done for profits. Countries, governments, states, and cities, they all operate under the same goal, which is state to progress, to make more money, not to spend more money. And the idea over here is that this will replace a lot of jobs. And employment is one of the biggest lever that costs a lot of money. It costs not only money, it costs liabilities. You have healthcare for the workers, right? You have special plans, you have retirement plans. You don't have to really agree with me. You just have to read, if you can read, of course. Klarna currently replaced 700 customer service workers with AI. Duolingo cut completely contractors' work, which effectively means that all the bad customer support call centers overseas will also be replaced very, very soon. People will no longer complain that, you know what, I call up my bank, someone pick up the phone, their kids crying around, I don't know what the heck is going on. So this is also going away. Moving on, IBM completely paused hiring 7,800 positions, all of which will be replaced by AI. They said we're pausing hiring. Meanwhile, they already hired the AI agents doing the job, getting the job done. They just don't want to say it because they don't know how to say it, you know. Soon you will see a lot of departments simply disappearing from these big tech companies. Moving on, there is something that no one actually talks about. It is not just that people are getting fired, there are no jobs listings. And even if we see jobs listings, companies are using AI to filter, vet the jobs applications, and effectively people from one side are using AI to create CVs and resumes, and from the other side companies are using AI to review the AI applications, which is absolutely crazy, funny, and in some way pretty sad, because the same leverage the employees are using is actually being used against them by the employers. It's comical, ironical, but actually true. Look at this. There are currently so much advanced AI tools that people who have been studying very, very hard, who have been accumulating very important skills for the last couple of years, are currently no longer necessary. There are apps that can code the entire application, and I'm not talking about the apps that you already know. I'm not talking about taking scripts that are not working, scripts that are essentially need at least 2-3 actual engineers to review the code, fix the code, on the privacy side issues, on the actual functionality. No. I'm talking about extremely sophisticated AI applications that can build a full-fledged code that actually works in an enterprise level. We're not talking about the small size, my university, your university, social network type of shit. Also, junior positions are simply disappearing. I can't remember, I might be wrong, which bank, but they simply said that certain junior positions will simply disappear because the job of juniors is simply useless, pointless. They don't learn anything. The bank doesn't get anything from them at this particular level of the hierarchy, right? So they effectively give them some money before, get them as junior, just to make sure that no one else hires them. Now they don't need to do so because the AI is doing the junior job. What this means? Well, this means that the first hiring will be for the next level. But the people who are graduating, they don't have the experience either through internship or junior positions. So if the junior positions disappear, if the internship position disappears, how these people are gonna get any type of experience? I have zero expectations to see anyone getting any experience whatsoever. This means that there will be a major gap between people who are graduating and people who are getting their first job. And first job might be, well above entry level. All the entry level junior positions might effectively be replaced. Maybe some of the mid-tier as well. Look at this: junior lawyers, accountants, graphic designers. We all know about the graphic designers, movie producers, script writers. All these people positions, unfortunately, are already in the past. And this is kind of good, kind of bad. Why? Because the people from the creator space are very artistic, very interesting, but they work slow, right? If you order someone to write a script about the movie, it might take years, right? But the AI can write a full-fledged, very good, sophisticated on 17, 18 different tries, probably very good, well-written, interesting, clickbaity movie script for, a month probably. Which speed always is a good thing. Now you can see even the real estate development projects are building so fast. Especially I see here in the city, I see a project begins maybe in August or July. Now it's already fully ready for tenants. It's unbelievable. It's like 5-6 months. You have a 50-60 story building, complete, ready, everything. Outside you have the windows, you have the entrance, you have everything, the foyer. It's crazy how fast these people are actually building. I don't know, is this in some way, AI help to speed up the process? Maybe the architects, using AI. I don't know. There's some architect, someone in the industry. I will be very interested to read more about this. Do you know that average person loses around $10,000 per day scrolling on TikTok? Genuinely believe, I'm not exaggerating, we're going back in history when the society was divided by kings and peasants. I don't see how the income inequality problem will be solved. So a lot of people who are currently experiencing misfortune, they were fired, they couldn't start business or couldn't find job, I genuinely believe that things will not get better or easier. And this is not your mistake. It's just how fast the world is moving and how slow the people are adapting to these changes, right? I understand. I can empathize why so many people don't want to learn AI. Because you're not geek, right? You're not geeks. You don't really care about this software, these changes, these systems, these AI agents. You don't really care about automation. You just want to chill. You just want to have your secure job. You have to have your very expected earnings this year. You want to know exactly how much taxes you're going to pay, when you're going to get paid, etc. But life has become very, very busy. This is why you will see the concentration of wealth is increased. You will see that usually I have all the collection of Forbes magazines since back of 1989, 1980s, right? So I screw all of it. So I essentially read how the whole generational wealth has moved from one person to another. In every couple of years, you see different people are appearing in top 20, top 50, top 10. But for the last 5 years, the same people have remained on top. And these people are not losing their spot. Instead, they're actually getting wealthier and wealthier. What this means is that for the first time, we're having the same people are not losing their spot, they're not getting less wealthy, they're not retiring and moving away from business and somebody else which is currently more active replacing them. But instead we're seeing the same people actually double down. Elon Musk doubled down. The person who owns all this, the French billionaire who owns all these fancy brands, right, fashion brands, he doubled down, he didn't retire. And if you look back, the people who are wealthier, let's say in 2000s, Bill Gates, he retired, he stepped down, somebody else replaced him. The guy who owned Zara, he was the richest person in 2003, 4, 5, right? He stepped back, he scaled down operation, he focused on his life, not so much to business, right? There was a Mexican billionaire, right? He was also 2-3 years every time, first place, second place, third place. So you always get some switch. This year we had Larry Ellison from Oracle. For 1 day or 2 days, he was the richest man alive. But the concentration of wealth is in direct correlation with the AI development and how the economy is more and more related towards the technology. If before some portion of the GDP or the gross domestic product or the infrastructure or the businesses started in particular niche was kind of divided more or less equally. You had a lot of people starting and working in real estate, being on the developer side, being on the sales side, and also you had a lot of people, a lot of services that surrounded this business. Then you had a lot of people who were working in normal service jobs, right? People were happy. A lot of these jobs, little by little, especially now in 2026, will disappear. A lot of which already are gone in 2025. So this led a lot of people to adjust. The only decisions that they could do is to adjust. And adjusting is not easy. This is why, like I said, if people do not adjust, do not learn, they will be left in an old system where there were kings who had all the material possessions, all the power, they made the rules, and everyone else who didn't have all that, who didn't adjust, who didn't build his own small empire or small kingdom, or who didn't relocate elsewhere, he stayed at the same exact spot. Well, this effectively meant that the world back then was divided by kings and peasants. And if no one in this current environment, economic system, don't want to learn the new skill, like I said, I'm not judging you, not forcing you. I understand how annoying it is to move from your whatever you was doing prior to go online and start learning all the geeky stuff, all the different chatbots, all different systems, what kind of softwares. Not to mention that there is a bunch of hacks that are currently reappearing. The systems are reinforcement learning, and also the hackers are utilizing all the noobs who are just beginning to learn all these systems. So, not overhyping, not over sensationalize the situation, but if you expect things to go back, you're in a bad luck, because the corporations will like the savings on the employment side. The government will like the speed of how job is done. Everyone, usually who receives service that before was taking a couple of months to be done, now it will get very, very fast. If prior, let's say on the simple framework, let's say you buy a home and you have to change titles, and if the old model will require manual checking all the history of the property, now the AI will pull up the files and will do evaluation and will do all the necessary stuff probably in 1 hour. Like, this is the positive side, right? All the I'd say very human consuming and pretty manual work will simply be limited, which is kind of a only benefit you can think of. Question is, will the life become cheaper or more expensive if we exclude the actual inflation, money printer, and so if you just focus on the AI automation? This is what a lot of people are talking about, universal basic income. But when you think about it, right, if you start with certain amount, 20,000, 30,000, 40,000, people will want more. And every single year they want more. It's almost like these pensions that people receive in Europe, where for every holiday you get a bump on your pension. Like, you have Thanksgiving, you have what was it? I forgot what was celebrations in Europe, but for Christmas they got bump. You got additional money on top of your normal monthly allowance from your retirement. And this particular system is designed to adjust on an annual basis with the rate of inflation. It's called the Swiss rule. So I don't really see the solution over here unless everyone gets at least on a basic operational level knowledgeable to use AI, and then the life kind of can keep moving forward in the same system. Because I still see people, you know, during the week waiting on the ATMs to deposit their pay, right? It's crazy. People still wait on the ATMs. Like, you don't really get paid with the checks, so you can take a picture and deposit your money. It's really outdated systematically. A lot of things have taught a lot of people to live in the same way for a very long period of time. No one has, in fact, taught them that things could be done differently. And innovation, and the last adopters of innovation usually is the people who are losing the most. The people who are last to decide, okay, I am going to learn AI. It's already gonna be late, G. Average person spends around 2.5 hours per day scrolling on TikTok. That's around 912 hours every single year. And that's enough for a lot of people to change professions, obtain licenses. They can become pilots, they can become dentists. You can change your life, but instead people are actually scrolling on TikTok. Let's run even more numbers so you can understand the concept over here. Not realizing why so many people who are scrolling and brain rotting all day, every day are actually the most broke people out there. Don't tell anyone. Look at this. If you just spend one of those 912 hours per year doing something else, you can go and enroll in pilot's license. You can learn how to fly the seaplane, these planes that land into the water. You can go and obtain the private pilot license. You can go and obtain a captain's license. You can buy a boat. You can learn how to sail. You can learn how to ski. You can become a ski instructor. There's so many different cool things or professions that you can actually learn. Not seeing so many people complaining and crying over here on TikTok, on the feed. I got fired. I submitted so many applications. No one is hiring me because people applying for the same fucking job. Guys, you have to look someplace else. Obviously, this position, this job, this industry is finished. AI has taken over. Second point over here. This is just 1 year. What if we go and multiply the same exact years for, let's say, the period of 5 years? You can definitely become a lawyer in 5 years instead of spending time scrolling. Not to mention that there's some people who claim that in California you can actually become a lawyer without going to school. Someone said that. Don't quote me on this. But the main concept is that people learning the basics. A lot of people before just go home, go on Netflix, Disney, whatever, used to watch particular shows, series, go to sleep, and rinse and repeat. Now a lot of people work all day, they go home, scroll on TikTok for like 2-3 hours. Maybe while they're making the meal, during eating the meal, probably even after the meal, they keep scrolling and they spend a lot of time for entertainment, which I understand. Sure, anyone from time to time needs to spend some time, watching some crazy nonsense, bullshit content. But a lot of people spending the full time online doing this. And here is the $10,000 example in which we started with. This is not coming from thin air. We're not coming up with numbers over here. We're not only losing the $10,000 a day. Effectively, it's $348,000 over a decade. And that's maybe half house, maybe down payment plus some other if you live in more expensive area, or maybe you can buy a full house if you live in an area where houses are not so expensive. And just think about it. Some people are losing more money at home scrolling than they earned throughout the day on their day job. Look at this. That's, if you break down by day, you effectively could be losing around $95, which, depending on the person, how many hours, some people spend more than 2.5 hours, The calculations were based on 2.5 hours, which is based on study. So if you spend more time, you actually lose more money. If you spend less time, you lose less money, which again kind of makes sense. And this is why probably Gary Vee is pushing so many people who are already on TikTok just to go out there and start, this tele-shopping business, full-time live shopping services, which honestly I don't support. But if you spend your time on TikTok anyway, you might as well make some money out of it, right? At least you're gonna reduce your losses over here just by judging time spent. But again, it sounds crazy, but the opportunity cost, which is doing TikTok versus anything else, is compounding. Think about a friend or someone who you followed online, or some of your colleagues who started a business after the virus situation. This is like what, 5 years ago, 6 years ago. So this time spent, you not taking action versus the person that you know who took action, who started a business, or who changed careers, or who become something that they weren't prior the virus situation. It's the opportunity cost, and the opportunity cost is much higher than the cost of taking risks. The cost of, people usually said you have some savings, right? The right thing is to protect them and not taking risk, or be very careful, because this way you're not going to lose money. Not saying that doing nothing with your money, just being in the bank, you still lose money effectively. So this is something that you should think about. In action, it's also in most cases wrong decision. This is why it's so complicated. People usually pretend to be the binary choice between two options, one of which always gonna be the right one, and the other one always gonna be the wrong one. And that's completely wrong. There's so many different options, and one of these options might fit more towards your final goal, and the other one might fit more towards something else. Let's say you want to become rich. That's why you go to study economics or business or finance. That looks like a right decision, right? But then halfway through you realize, I can become rich by doing something else which I like more. So the first decision that appeared on the surface to be the right one, and will be the one that will get you to the end goal, was not the one that you actually end up taking. And this is something that a lot of people do not understand. There are many ways that you can get things the right way, and you can screw your path to success in many different ways. How many people have essentially ruined their careers by just making the wrong turn? Trying to, let's say you're a singer or you're an actor and you decide to launch clothing brand or some bullshit product where people saw that like bad quality, bad reviews, no one liked it. You essentially ruin everything that you have built previously. Similar case with a lot of people who launched their crypto fake scam projects. They build up their career on something, right? Whatever, they got popular because they did like good analysis or predictions about the markets, people trusted them, and they essentially capitalized on it. So I spent the last 4 hours digging through the Wall Street expectations, predictions, and estimates for the crypto market. If you hold some crypto, I bet you wanna hear this, and what I found out will shock you. First of all, two top firms on Wall Street which have been the most accurate so far in their predictions, being on the bullish or bearish side: AllianceBernstein, which had some correlation with Nancy Pelosi, and on the flip side you had Standard Chartered. So both of them, their analysts are still seeing Bitcoin going to 150 up to $200,000 by the end of 2026. And according to them, regardless of who is going to be the new Fed chair, they said that the pro-crypto policy will eventually shift, that will get escalation when the Clarity Act is signed, when the banks cannot postpone, reduce, or limit on or off-chain yields. Remember, there are many projects But people are interested. They're buying into the project and they receive particular yield just by holding the coins of the project or staking it on this blockchain. So this is very important for developing of the DeFi space. This is something that has been a bottleneck for the reversal of the crypto, according to them, because there is a major unexplored market. Remember, we had NFT pushing the crypto cycle to new all-time high. Why? Because it was new unexplored market. We saw the same thing happening with the metaverse, right? As crazy as it sounds, the new unexplored market of the metaverse, selling real estate in the metaverse, having big companies like Adobe or Nvidia or Lego, they already purchased lands in the metaverse. So this actually pushed crypto back in the new all-time high cycle. So this is what is going to be. It's no longer the technical breakdowns. It's no longer the inflows or outflows of the ETFs. Second important point over here, Bitwise and Galaxy. Their prediction is breaking the 4-year cycle, something that I already mentioned in the previous videos. This is already dead. Because if before the cycle was based on lack of adoption in the institutional side or on the government side, this is no longer the case. Government already created a Bitcoin National Reserve. Also, big institutional banks are offering their clients to purchase Bitcoin through the ETFs or Ethereum through the ETFs. Third important element over here is that a lot of these institutional investors, investment banks have been staking up crypto on their own balance sheet. For what purpose, we still don't know. Also, the biggest banks have been building own blockchain systems using own cryptocurrency. So some people are saying they're building their own stable coins that are related to the bank themselves. So they're going to use it probably for transactions, some internal use. But this is a sign that DeFi and on-chain platforms and the whole ecosystem will eventually play out in real life. Second, Bitwise and Galaxy also see the connection in the volatility between the Mach 7, the technology stacks, the AI stacks, Nvidia, and their consolidation that is matching the sell-off in crypto. They're saying that effectively crypto is AI stocks without the AI. It's looking like Nasdaq without all the big technology companies. So effectively, the matching price action has been accelerated on crypto. If Nasdaq is down 3%, crypto will be down double, and vice versa, because the volatility has been evaporated at this point. Third main important element and metric Wall Street looks very closely. Remember, Wall Street is not throwing darts at the board. They're not guessing. It's no guessing over there. They're looking at the surveys. So the broader surveys Wall Street run show up that 74% of crypto holders still in Bitcoin, with experts like this in CoinDesk, right? They're viewing the current dip as cautiously constructive. What this even means? They're thinking that this is effectively a bull resumption setup. They're seeing that some of the OG crypto holders, the people who have had their wallets untouched for the last 10-15 years, some of them have been taking profits, but they just took profits from the top of their portfolio, 3 to 5 to 10% max. They didn't liquidate the entire crypto. What this even meant that these people said, okay, the market looks like it's going to take a breather. The market's going to sell a little. I'm up substantially. I haven't cashed out for the last 15 years. Let me take some chips off the table. So these people took some chips off the table, and surprisingly, 2 days ago, someone actually sent to the original wallet of Satoshi Nakamoto 2.5 Bitcoins. And the speculator said, okay, this is the second wallet of Satoshi. He's transferring from one account to another, which makes no sense. But the main sense here is that when you have shift from one wallet to another, when you have active moves, there is 100% something coming up very soon. These people are not moving funds or crypto from one wallet to another, from exchanges or off exchanges, if there isn't a very strong action coming very, very soon. a lot of these people have been staying put for 10-15 years, so they have no issues staying and waiting much longer. But when you see some of them taking profits, a lot of the market actually use this as a negative catalyst to dump the market overall. Fourth important element here based on the surveys. According to these surveys, the sentiment and the views of investors who are still holding and who are still down, majority of which are down, institutions, investors, they're seeing and they assume that no major black swan event is coming around the corner. They are optimistic and bullish for the second half of 2026, and they're seeing this as a bigger breather for the market, which allow the market, remember, Bitcoin to hit these levels from current all-time high of 126 to 150, which is not so much, it's another $24,000, to the absolute top of 200, some people calling for 240,000. You understand, if the market wants to do the new all-time high of absolute peak of almost $250,000, it needs to dip more, right? You understand, the bigger the dip, the bigger the breather, the bigger the liquidations, the bigger the potential upside could be based on something known as elasticity, right? Think about elasticity. The longer it pulls, the faster it stretches and expands. So if you really believe in the surveys and if you really believe in Wall Street expectations and predictions, you should understand that these people have no better options to invest. If they believe that the AI bubble is very close to its peak, if they don't see better opportunity to invest, when you see that stocks are falling alongside gold and silver, and the new Fed chair will make the dollar great again, the only options for institutional investors still will remain crypto. When you consider treasuries likely won't be as attractive opportunities for institutions anymore. Let me know what you guys think about this. So in the last 48 hours, probably a lot of you missed my previous memo. Crypto recovered 14 to 15% versus the gold and the silver only 1.3%. Why is this? Well, like I said, if you missed the memo, you probably wonder why. Let me explain. In the last 48 hours, we had over $310 billion that was essentially bought off the dip on the crypto market, which inverted the patterns, and now the market will liquidate around $2 trillion in short positions. But why the gold and the silver didn't move? Why the recovery didn't appear the same way on gold and silver, where they're much cheaper? The gold is cheaper, the silver is cheaper. There was even greater dip earlier prior on the silver, around 40%. So this means that the people who are more bullish, people who are always bullish on precious metals as a safe haven, they didn't buy the dip this time. Why? Two possible scenarios. They either run out of money or they're extremely already concentrated in precious metals, meaning, you know, we can speak whatever you want for diversification, for hedging, but you cannot just simply hold one or two separate assets. You need to have a very diversified portfolio, considering that the market is not yet decided. Are we going to go into the recession, or are we actually going to persevere? Pay very close attention to the numbers. And these numbers are already in the past, so this already happens. We're not speculating, okay? So in the last 48 hours, we had a sharp intraday recovery from the sharp dip in the crypto markets. Very importantly over here is that the strong rebound on the crypto market appear only on the crypto market. Sure, the stock market is closed on the weekend, but remember, the futures market is open. This also indicates that on Monday morning, the gold and silver will have a chance to recoup the losses. Remember, I was talking about yesterday the levels of 5100 in gold. If the gold doesn't break the 5100 throughout the next trading week, well, gold most likely will be in trouble. And if the gold is in trouble, we don't really worry about silver, because silver will fall even more. The net recovery window, look at what is happening on the crypto market, was between 14 to 15%. And remember, people were calling out the end of crypto, the beginning of the cold bear cycle of crypto, which is not happening because I mentioned last week that the 4-year cycle for crypto is no longer a thing. People are no longer following it because the Bitcoin and overall crypto market cap has become mainstream. You see Fidelity, you see Schwab, you see banks are offering clients to actually buy or invest in crypto. You also see the biggest asset managers, right, buying into the ETFs, Ethereum ETF, Bitcoin ETF, Solana ETF, AVAX ETF, right? This is very, very important. The current levels for the crypto recovery hover around 2.3 and 2.4 trillion dollars. It's very important because all these monies, as you probably understand, this is not the average Joe is buying the dip. This is institutional investors. This is Wall Street. So why Wall Street, instead of buying the silver dip, which if the biggest gap down 40%, if you're bullish, there is potential biggest gap up if you believe that it will go back up again. But they're not betting on this. Wonder why, right? Same thing with the gold, right? Why they're not betting that the gold will go back up, or why they don't hold on the previous price target, it's $10,000 by the year end. If we believe, think about it, if the gold now is around 5,000, 4,800, 600. But if you truly believe that the gold will go 10,000 by the year end, you're looking at crazy percentage upside. And if you truly believe, why Wall Street is not buying it? Because the likelihood of Bitcoin surpassing the previous all-time high are much lower, right? How likely is Bitcoin to surpass 121,000 in doubles to 240,000 versus the easiest goal for gold just to make it double from 5,000 to 10,000? It's much easier. But people are not betting on the easier part. People are betting on the more hard and complicated part, going from 70,000 Bitcoin, 72,000 to back to previous all-time high at 121,000, and then doubles to 250,000. Remember, Tom Lee from Fundstrat still holds his price target for this year between 240,000 and 250,000. We're not talking about Ethereum. I'm kind of bearish on Ethereum, so we're not gonna focus on this. Now let's look at the recovery process in the gold market. Let's look at the spot gold. So the experience dip that we saw on February 6th, which effectively was on Friday, hit lows of 4,600, lows of 4,600 as well. Very important is that the recovery was not that big, it was around 3 to 6%, but this particular dip, right, was not something that a lot of people were waiting to buy into. There was no interest, right? If you look at the charts, we saw that there were a couple of green candles, but there was more than red ones. And we saw that we failed to break the previous highs, or at least to reach the previous highs. Remember what I mentioned? If we couldn't hit the previous highs going up, make a lower high from the previous high, the likelihood is that we're gonna go lower. And next time when it goes up, it's gonna go even lower than the previous high, and then it's gonna go lower high, lower low. This is what Wall Street expects. And if they see this weakness, like I said, gold has next week to break the 5,100. If it doesn't, most likely the Wall Street will set up the computers and the alternative trading systems, ATS, the computer trading, the algorithm trading, to most likely flush the prices. Remember, there are a couple of important levels of support that you want to look at: the gold 41, 4,200, and then if it goes below that, we're looking at 3,800, possibly 3,400 if we're having a major, I would say, rotation. This is a very important term on the markets. So we didn't see the recovery that people were expecting. We didn't see people buying the dip as we expected. And if we move to silver, things are looking a little more uglier. Lower interest, right? Spot prices, again, much lower, greater dips. We saw 7 and 10% sell-off on the silver market, but the reversal was not there. Lower volatility, lower interest, 48 hours recovery was partial, very partial performance, similar to the crypto markets, but with a lower volume, much less lower leverage positions, which, as you're probably aware, when you see a lot of leverage, this means individual investors, because they place a small capital, right, and they borrow against a small capital so they can have larger positions, so they will be able to capitalize on the small price moves. Big investors, they don't use leverage, they just have a lot of capital that they can operate with, because it is expensive to borrow. And remember, when you borrow, when you trade on leverage, a small moves, sometimes 0.5% can liquidate you. I'm talking about absolutely everything to go bust. This is why when you're big institutional investors, you want to make sure you have room for mistakes, you have room for errors. So if the market goes against you, you're not going to lose your investors' funds. Where individual investors, right, they don't have much to lose, especially if they trade with some international overseas brokers where they allow them 100x, 500x, crazy leverage. Don't do this at home, kids. So that's what I'm seeing over here. We're having a sharp reversal on the crypto market, and again, seems like the worst is already in the past. I don't know why there is a slowdown on the precious metals market, considering the negative beta I've been talking about. So a lot of people saw that the main function for which they're buying gold and silver doesn't function. It's no longer hedge. It's no longer negative beta. When the market crashes, gold and silver crash as well. So why would I buy gold and silver when they crash as well, and they crash even harder? If I had S&P 500 on Friday sell-off, I will be down 1.7%. If I had the gold, I will be down 8%. If I had the silver, I will be down 12 to 15%, right? What's the point? There's no point. Also, let's not talk about how illiquid some of these spots could be, and let's not talk about how the volatility disappears overnight sometimes. When the market decides that, you know what, they don't actually fulfill the need I had for hedging. So be very, very careful. So guys, this is my last warning. The most bearish plausible scenario that the market is preparing for is that the nominated for Fed Chair Kevin Walsh marks the top of the bubble in gold and silver, leading to multi-quarter correction driven by tighter than expected policy. Leading to multi-quarter driven correction. Do you understand this? Second, third, fourth quarter, lower highs, lower lows, lower highs, lower lows. This is what the market is preparing for. This is the most bearish scenario. Also, they're expecting a very strong dollar on top of the liquidations of the long positions in the precious metals. What the Welsh nominations actually means for the market? Well, Wall Street is preparing for the market quickly reprice the very, very bearish on the stocks in crypto and reprice very bullish on silver, gold and other precious metals. There will be a completely 180 degrees reversal on the sentiment, and the current hedges that people explore precious metals as hedges will no longer be the case. The debasement trade will be over. What this even means, not only for America, but also for European Union and BRICS. It's a checkmate. When the dollar becomes, again, the most powerful currency, when the gold is no longer needed for hedging, well then all the leverages of other countries simply disappeared overnight. The dollar has already bounced on the news today, has already become more and more stronger against the euro. This particular part of the reversal is the first indicator that we're having found the pattern of the dollar and there is a new pattern building towards the previous highs. Wall Street also expects that after the new chair steps in, dollar is not only going to reverse, but will again become dominant power and build the new year-long highs. This will be a major tailwind for the metals. A more independent and less politicized Fed means that the Federal Reserve will be allowed to make decisions, right? But remember, Donald Trump is selecting this person. So again, the decisions still will be more or less discussed prior announcing. Price action and technical bear case for the gold. Today, gold had one of the worst single-day drops in decades. This is not just today. Looking at the price action, for the last 12 years, the gold hasn't seen a single day drop between 10 and 12%. This means that we had hit the inflection point of volatility of gold. So far, the gold was making a moves, but was not as volatile. This 10-12% and around 30-40% in silver indicated a completely break-even point where things are already inflexing on the opposite side. Even after 60-70% gain over the past year, which is a classic blow-off top reversal pattern, there is still chance for even greater sell-offs than the previous very strong consolidation that happened throughout the last 3-4 years. Which means that people who are currently up maybe $300, $500, $600 and they're happy and they're looking forward for the long run. I went on Reddit, I sneak on Reddit group for gold to see how people are actually replying to this particular price. Actually, people said, I'm not worrying about. I'm buying for the long run. Which long run, my friend? Second problem over here, the silver. After the new chair steps in, silver will experience greater sell-offs than the current one we saw. So far, silver has been more extremely hurt, 30-40% a day. This is again single day major declines in decades. Even though silver has been up between 150-180% year over year, right? But this is exactly the profile, the trends, and the pattern if you really follow and try to make sense of the patterns of the volumes and the institutional ownership at the same moment. What this means for the silver, this is the exact profile that tends to unwind hardest when sentiment flips, which means the weakest hands in precious metals are actually holding the silver. They're the one who will throw the towel first, and they're the one who will be shaken first. Third main issue and part of the most bearish case for precious metals. A prominent technical bear case now after this particular sell-off today. We're seeing new 30-day medium averages based on volume. We're seeing a completely new Fibonacci retracement building up. If gold loses the 5,000 area and silver loses the $100 area, downside targets could be 4,500 for the gold and 4,300 for the gold, which this is not even the most bearish. I read even bearish scenario from some of the analytical firms on Wall Street who are looking to low 4,000, 4,100, maybe under 4,100. For the silver, they're looking at around 93.70 or 80, which again, this is not the most bearish. I look at earlier people looking at low 50s. Some people even speculate under 50s, and this is very realistic. A lot of people, if you just go back 8 months ago, silver was doing nothing, 43, 45. Gold was 28, 2,900, something like this. No one was looking forward for this. So this means that they're not going to be ready to look down to the previous prices when things happen, right? No one is ever prepared for the price action, regardless what kind of experience or knowledge they got. So these are three main components that consolidate and construct the most bearish case that it is very plausible to happen, simply because the person who was nominated from President Trump will most likely be selected, and the person is known for his views on the market, and Wall Street knows what to expect. This is why when this nomination came, all the big Wall Street firms, investment banks, and family offices, they start building a new thesis for the precious metals, which will be the bearish thesis, of course, bullish thesis for crypto and stock market. Okay, they flipped the switch. They didn't wait, how the market will react. Nobody cares. They already sold, probably, most of these guys. Considering that the biggest bets were actually on perpetual futures, so they have to sell. They cannot hold them anyway. So this is why, till January 30th, pay very close attention. It will only get worse and hard for you to understand and navigate through these particular scenarios, because they will be popping up every single day, more and more articles how the new Fed chair will be focusing on improving the dollar, which is good. I'm bullish on the dollar anyway, and will focus on making the inflation remain at these levels, not pushing the inflation lower, which will completely change the Fed policy and the overall economic infrastructure.
Why am I making more money waitressing than I would make using my college degree?
Do you know that when you overestimate yourself, you're always giving yourself the highest possible chance of success?
I barely have a life. I have 2 days off and I work Wednesday to Sunday, doubling just to pay my bills.
What am I doing wrong? I work every day and I'm still broke.
Most of the people who you know today, they overestimate themselves, okay? They simply said they're the best, they have a super skills, they have a superpower, they compete in different tournaments as a professional athletes, they compete in different businesses, they compete in different careers and walks of life, and they succeeded. Even though all the odds were stacked against them, most of the people didn't even have a college degree, but they still found careers in area where the college degree usually is a requirement. What this actually means? Being able to utilize self-delusion. You think that you're the best. You think that you know something that other people don't. You know that you can actually persevere failure after failure. Something that a lot of people do not understand.
Like, I have a decent job, I make some decent money, but I live out here in Cali. Like, bro, as soon as I get paid, I have all these bills stacked up, bro, that shit wipes me clean. Like, fuck, I got no money left over.
The people who are taking the biggest risks early on in life were people without sufficient preparation or knowledge. What this means, they didn't know what they're risking. You don't really know what are you risking, and this is why people used to make poor decisions. This is why overestimating yourself only works for people who are really ready to put up the work. You may not have the experience, you may not have the odds stacked in your favor, but you're still able to put up as many efforts, as many tries, as many hours into it over and over again. You are eventually going to win. Because when you try enough times, you are increasing your chances and odds for your success. You probably heard the overnight success people claiming for other people because they didn't spend the hours of work, hours of failure, hours of tries until they actually achieved and matched the results that are publicly announced. This is why self-delusion. Sitting here, let's say today you want to build some mobile app, you have no coding experience, you have no knowledge, you just watch a couple of tutorials and you learn how to build a mobile app using AI. This is a big achievement. But a lot of people, regardless of how easy you can make building the app process for them, they're not gonna take the step because they know they're not coders, they're not engineers, they're not technicians, they're not tech savvy. It's also pretty boring for them, and as a matter of fact, they don't really have anyone who is an engineer. So that's pretty far away from their regular circle of interest. But this is why you have to be self-delusional. You know what? I am going to build a app in my area of interest, which could be whatever, sports, hobbies, and I'm gonna build the app like a professional engineer. I'm gonna watch tutorials, I'm gonna take notes, I'm gonna backtest. Even if there is something I cannot do by myself, I'm gonna hire somebody to fix this part and I'm gonna make the app work perfect. I wanna make sure that the app will be better than any other app in the same industry built by engineer. Okay? On the surface, this looks like delusional. How are you gonna find time to do it? It will take you a lot of time, first of all, just to watch the tutorials, then to take notes, then to install the softwares, then to learn the actual schemas, how to connect different platforms, how to actually compute, backtest, right? You have to create different accounts. It's a system. It's like learning a completely new language. Most people will say no. They will say no for them, and they will say no for you. you're not going to be able to do it. You're delusional. You think you can do it because it sounds fun, it sounds cute. Every new business idea sounds fun until you actually start working on the business idea. And you start failing, and you start getting errors, and you start losing money because testing, especially on the AI, it will require certain funds that you can propel your idea. You have to backtest either the payment functionality or the API keys or the video generation or the actual storage of the data, the authentication, like so many different elements that you want to make sure that are superior, because you're self-delusional and you believe you're going to build a extremely professional app without being an engineer. You know what's funny? If you go online, right here on YouTube, and try to search for people who built and currently monetizing app, people who come from completely different niche, people who were finance, people who were in athletics, people who were in whatever, hotels, hospitality business, they built an app and they're currently monetizing it. Why? Because they were self-delusional. They believed that they can actually build and be equal, not equal. They believed they could be better than all the people who spent years working in Apple as an engineer, in Google as an engineer, in Microsoft as an engineer. But if you're not self-delusional, you don't really put yourself ahead of the game. If you almost didn't have the same take, like I can be the first online provider of connections from the satellite, provide satellite internet, provide satellite connection, right? And I can have one of the biggest, the widest coverage. Anyone from any point around the world, regardless of how remote, low or high it is, we have access to internet, right? Send satellites here, send the satellites there. We have to mention also that there is a drawbacks and there is a downside. And if you fail self-diluting yourself, you're falling from 50 feet, my friends. Because when you pump yourself so fucking high, you realize that you're putting yourself on probably the highest possible level in tier, and you're going head to head with the big boys, with the experienced people. And if you win, well, you're definitely gonna win big. Maybe it could be this one big bet that you won and you're set for life. But if you're wrong, if you really overestimate yourself, it's gonna be very painful. This is what Charlie Munger actually mentioned, that he didn't like the style of Elon Musk. He said, quote unquote, Mr. Musk may not always be wrong, which intended that most times people who are overestimating themselves are wrong. Why? Because you realize that when you say and you realize that you overestimate yourself, you think that you possess something that you most likely, you're certain you don't, right? It's like you're going on the field track and you're gonna run and you're gonna compete with other people. You had no preparations, right? Everyone else is like athlete, they train for like 2, 3, 4 years, and look at them. And this is the moment of self-delusion. You can think that, I am natural born talent. I don't need to train, I don't need to prepare. I can even run with jeans and I'm gonna smoke these people. The self-delusion is a real key of unlocking different results, good or bad, but definitely different. Because I run the same structure of data between people who are realists, people who are pessimists, people who are optimists, and people who are who are over-delusional. So the people who are realists, they have capped results. They are realists, they said, okay, I can achieve up to here and that's it. Nothing above, it's my territory. The pessimists, they're going halfway through, they go even beneath, they always assume that they're going to be last or second to the last. They never achieve anything in life, they usually work, these are the people who are like, find one job after university and they work throughout their entire life in the same job because they think that no one else will hire them. That's why they never quit or leave. And of course, the optimists, like I said, they're doing a little bit better, but still mentally, they kind of put the limits on themselves, not on the achievements. They said, no, my IQ, it's at max. I cannot really even think about something more. That is my place, that's my spot. And the people who are over optimistic, over delusional about themselves, about their achievements, these are the people who are actually go beyond and above. And don't think that when they achieve something crazy, they're not surprised. They're surprised from themselves, but they're not showing it. You don't think Elon Musk was surprised when he actually succeeded and shipped Tesla? He was surprised. He was like, damn. You don't think that he was surprised when the actual Falcon, the first Falcon rocket was successfully launched and came back to the Port Canaveral? He was not shocked. He was shocked. He was, oh man, oh, this actually worked. Crazy, right? He was not like, oh yeah, next one. No, because these things are not happening on a common basis. These things were not successfully achieved by people with experience, people who work at NASA, people who work at Boeing, people who are rocket science, rocket engineers, etc., rocket designers. No one of these people even thought that this is possible. This is why you have to think about self-delusion as a key for unlocking different results. For all the people who bought gold at $5,000, you need to see this. There are a couple of important Wall Street indicators that are showing that there is a possible chance for replication of one of the gold crashes from the past. Gold has a couple of different crashes, but the most severe one appears to be the crash around the 1980s. This pattern from 1980s is very similar to the current pattern, and the reasons for the crash in 1980s, it most likely will be the same now in 2026. Very important elements over here. So if you look at the numbers, the prices of gold and silver have completely mirrored the price action in the 80s. They had a 30 to 70% plunges after the rally, something we saw 2 weeks ago. Also, we saw that the liquidity was crushed, which meant a lot of people got scared and didn't want to buy in the dip. Second important thing is that the reason for the big crashes in the 1980s was the Federal Reserve. There was a change in the Federal Reserve, and surprise, surprise, the Federal Reserve will get its new chair in May. So this is very, very important, and it's kind of weird that no one else pays attention to. It's very obvious that something big is coming and something it is going to change. It's no longer be the same as it is right now. Here is the brief introduction and historical elements. First of all, in 1980s, there was a big bubble worldwide economy, right? So people were trying to hedge against potential turmoil, potentially losing on their savings or retirement. Gold at this very moment became $850 per ounce, which at that time was at all times high. Something very similar, currently gold is, or it was a month ago, at its all times high. Why it was? Because people were what? Again, afraid of big world turmoil. They were afraid that the dollar will continue losing its value. They were afraid that the economy will change substantially and the stocks will crash and the crypto will crash. And this is why people bought gold and silver. They bought the gold and silver for the same reasons in the 1980s. But what happened next? It's mind-boggling. The gold fell from $850 down to $297. This was 65% crash. I want you to picture this, right? You put $100 and effectively you're losing 65% of your gains. And this is not because there's something wrong with the gold. This has to do with the people investing in gold and silver, because they always artificially increase the price. They don't increase the value of the gold and silver. The value of precious metals is constant, doesn't go up, doesn't go down, regardless of the demand, regardless of the supply, regardless of the actual physical findings or non-findings. The demand is kind of constant and it's not actually growing if you pay very close attention. Because there's a recycling period where a lot of the old jewelers, if we spoke about physical, because a lot of people would try to make the case that there's more demand for jewelers and this and that. People are melting old jewelers, old gold, old silver to make new stuff. So it's kind of a recycling theme. You don't really need so much more demand or so much more materials to build brand new gold items, right, or silver items. Second important element over here is that the market crashed in 1982, 2 years after the new all-time high, simply because the Fed chair, which was Volcker, he hiked the interest rates 20%, which effectively destroyed overnight the price of gold and silver. He effectively made the dollar great again, right? Which is something that's going to happen very, very soon. And he sparked a 20-year bear market. And this is a 20-year bear market in particular about gold and silver. Sure, the stock market also suffered, but the stock market recovered fast because there is an actual business behind the companies who people hold the stocks from, right? There is a reason why or if some of these companies will recoup the losses, but there is no strategic or psychological reason why if gold and silver fell 65% or more, you will be expecting something to recover. There's no earnings that you can track. There is no production that you can track, especially people who are just betting on the paper, right, in the futures market. All these people will most likely be liquidated, right? These people are effectively losing almost everything that they are invested in. And if we go back to the people who are producing and manufacturing, for them, it's actually favorable gold and silver to crash because the prices will become lower. When the prices become lower, they can actually buy more and produce goods with the gold and silver, and then when the prices rebounds, they can actually charge much more because the upside is greater. If you produce something when you purchase gold at, let's say, 3,000, and then the gold goes back to 4,000, you're still selling the same jewelry for the same price, 10K necklace, 15K bracelet, but your cost basis is 1K, 2K lower. So you actually make more money. So I genuinely believe that people who are dealing with the actual day-to-day business from the industry, from the physical gold and silver, have even greater interest than Wall Street to see gold and silver prices crashing. This is very important for their also averaging down the cost basis. They will be actually able to produce even more, which, as you may have guessed, will reduce the prices. When you have more suppliers selling the same bracelet with the same design, right, the prices will go lower. But that's not really a big thing, because if you really think about the cost basis also will be lower, right? So if lower cost basis, if you don't produce something unique, something custom, right, the prices will also kind of go down. The market will price it down, but still you will be in better position because lower price always locked up less capital. When you have less capital that is locked and more capital that is free, available to bounce off if something went wrong, well, it is always good for the business. This is how you stabilize the market, and this is how things should work as well on the real estate market. The real estate market hasn't crashed since 08, 09, and this is the problem. The real estate has been going up and up and up and up and up, and people couldn't afford the real estate. This is why the real estate also should crash and should be re-evaluated from the banks who gave up the loans, from the developers who built the buildings, and from the landlords who are actually lending their properties. The market should be repriced with the current wage growth, which is slowing down. The wage growth is slower than the inflation growth. This is what actually makes people poor. Inflation can go as high as it wants as long as the wages are growing higher than inflation. If inflation goes up 100%, but your wage growth is 150%, you ain't gonna feel any difference, right? Sure, you will spend more money for less items. Physically speaking, you will go with one big bag to buy a TV. That's something you usually buy with, but it's a small pocket of change foldings, right? So this is what I'm trying to explain. Everything should be repriced to the fair value, and everyone will benefit from it, except the speculators. But who cares for the speculators anyway?
So there's a nationwide shortage of technicians, automotive technicians, no matter what brand it is. People just don't want to do this anymore. And I'm going to show you right now why there's a nationwide shortage of automotive technicians, especially at the dealership level. Let me show you exactly why. So this right here is the labor time for removing an HVAC assembly, the heater box inside the vehicle. We have an evaporator leak and the AC doesn't work. And this is the labor time from, I believe, All Data. Pays 13.5 hours. See that? 13.5 hours labor to remove the HVAC assembly. And then this is the warranty labor time from Nissan. 4.8. They want me to do that HVAC assembly for 4.8 hours when All Data is saying that it takes like 3 times as much as the warranty time, 13.5. So many of you may not know how technicians get paid. We get paid by the job. If a job pays 2 hours, then we'll get 2 hours no matter how long it takes us to complete that job. Our hourly rate may be $40 an hour. We may get paid $40 an hour, $50 an hour, and we'll only get 2 hours worth of that time to do that job. If it takes us 3 hours, then we'll still get 2 hours for that. So this is exactly the reason why nobody wants to do this anymore.
Well, this is probably one of the examples where the real suffering for doing the work of the people who were doing the actual technician work actually comes into a full circle. They don't really enjoy doing the work anymore. They don't really getting paid enough to do the job anymore. And it is kind of a perfect storm for the AI, perfect storm for the EV vehicles, because as we all know, the maintenance of the vehicles is much lower, and the EV vehicles require much less parts, considerably less parts. So understanding that no one wants to do this job is just one of the examples where people kind of calculate, is my time worth more keep doing the job or doing something else? Do I really enjoy, or do I really feel appreciative, right, by doing the service? Because you understand, this is not an easy job. You should really know the cars, you should know the parts. Some of the vehicles have parts that are very hard to find, which means you as an expert, you should source the materials, you should source the replacement. In some cases, they should order, specific part to be made.
This is why Ford can't get anybody to work on their cars. Now last week the Ford CEO came out and said he had no technicians to fix all of his broken cars, and that's why it takes a minimum of 2 weeks to get your car looked at a Ford dealership. Now I already knew this was true because every time I call my local Ford dealer, they tell me they don't even have a transmission tech. And they gotta send every transmission job an hour out of town to the next nearest dealership that has a tech that can do that work. Now the Ford CEO states that there's over 6,000 bays in Ford dealerships without technicians, and they can't find anybody to fill those roles. And his attitude toward the whole situation is that people should be wanting to fill these roles and wanting to do these jobs, and he just couldn't understand why he can't fill them.
There are famous YouTubers here on YouTube who are buying cars, like luxury cars, and they try to fix the car, but the headlight is $2,000, and you cannot find the $2,000 even if you're willing to spend. So they have to 3D print the headlights, they have to 3D print the parts, but you still have to have a very deep knowledge of how this particular part works in the connection with the overall system of the vehicle. So like I said, these people are experts. They're like doctors for the cars, right? And when you see these people who are doing diagnostics, right? When you see these people who have a very niche and very obvious, knowledge that is in demand. Everyone almost has a car. Everyone almost every day drives. So their knowledge will be in demand.
There's a shortage of technicians. They have 6,000 empty bays, and he understands why now. So here's your answer, dude. This is why.
This is why. Your answer is because you charge an insane door rate. Technicians don't take home even a third of that usually. You make junk vehicles. And your labor times suck. They're usually less than half of what it takes to do your job.
Yeah. So take into consideration that we have to buy our own freaking tools. That's one. Two, your warranty times are shit. If an engine replacement pays 25 hours under customer paid, and then we go do it under warranty, it's freaking 10 hours. So you're screwing us up. You're supposedly helping out the customer at the cost of the technician's paycheck. So yes, that's the freaking reason why, not because your other stupid reasons that you mentioned.
Right. That, and on top of overcomplicating simple things that you've had for years that have worked well, you constantly reinvent the wheel, model to model, year to year, making repairs more lengthy and difficult for technicians. That's why everybody's leaving the industry. Pretty simple.
If you guys fix your reasons why there's a shortage of technicians, there wouldn't be a shortage. So this has nothing to do with colors, white or blue. If the pay was fair, and everything else that comes with it was fair, then there wouldn't be a shortage on any freaking industry.
The end.
Adios, mofos.
So what's going on? Today I'm going to talk about Toyota, and yeah, there's probably a quality issue there, but there's really a technician issue there. There always has been. The last few years have probably seen it at the worst it's ever been, and it's just going to keep getting worse, which is possibly better for technicians in the long run, but I really don't think so. So what's happening? So in my neck of the world, Canada, Toyota at the moment has such a backlog on training that they don't have their certified Toyota master techs. And what's happening is, not only is there really no new apprentices coming into the industry, there's a brain drain right now. So as it stands, Toyota is so far behind on training that they're all starting off at the bottom. So let's put it into levels 1 to 4. Everybody's at level 1. They have a backlog of 4 years of training, which tells me that there's nobody new coming into the industry, but also tells me that there's not enough master certified techs, and this is how I come to that conclusion. So in my local area, the dealership has lost almost all their master Toyota techs. They got maybe 2 guys left, and that's a brain drain. They probably lost a good 40 years of experience in a matter of a year. That's huge. You cannot replace those numbers in training, and it takes years. It takes years to make a master Toyota tech. It is what it is. So what's going on? So the one guy I work with, I'll tell you what he made to the industry, and Toyota and the dealership owners screw over technicians. So put this scenario in there. The one guy he was pretty much a master tech, left because the Toyota engine recall on the Tundras. The hours were great, and then they continually dropped how much he's making, to the point where here in Canada, Ontario, he said they were making 16 hours on this warranty job. At first it was higher, and then they just keep lowering it.
The question is, would AI be able to replace or fix some of the vehicles, or interchangeably, do or get the job done? We all know in the beginning of production of Tesla Model 3, there was a major issue with the efficiency of the production, because Elon Musk said that 80% of the production was done by robots. Then he removed majority of the robots. He left around 25 to 30% through the production process field work by robots, and the remaining part was actually completed by humans, which removed the bottleneck and improved the efficiency and the production levels. So my real honest question here is, would this be a bottleneck for the production? Would this be a catalyst for the EV market to get a complete adoption? Looking here in New York City, I would say maybe 60-70% of all the cabs, Uber, and other taxi-like companies are using Tesla, right? We're seeing more and more delivering vehicles from Amazon being EV, right? Some people already claim that USPS has used some EVs as well. So obviously the EVs are, taking bigger and bigger portion of the auto market, being on the personal or commercial side. The question again remains, what these people will be doing if they're not mechanics anymore, and would the AI or somebody else be able to replace these jobs? Because like I said, this is in demand. The cars will be around forever, and there will be more and more vehicles that are on the older age side, which means more replacement, which means harder to find parts for them, which means these people, their expertise will be sick, in my opinion. If you don't believe me, just go on the government website for auctioning out a lot of the old vehicles that government use for police cars, some of the security vehicles, some of the army vehicles that are selling. You will see that even the government doesn't want to fix the old vehicles. They're just going to buy a brand new fleet of them. And you can go ahead and take a look what specific models are always part of the auctions, right? What specific models are usually, have more issues in the description. So you will get an idea which models are more faulty than others, right? So it is really, really interesting to see how the development will proceed with these people. I'm more interested to see how these people will make ends meet than interested what is going to happen with the actual technology and the service providing side of the game. number one reason why people struggle to build wealth is that they don't understand the time value, which is part of the financial engineering theory. The time value is the basis. So the time value of money is important because essentially means that $1 today will be worth more if you invest the $1 today versus having the $1 tomorrow. For two simple reasons. First of all, if you have the dollar today, you can take a position, make a decision, and invest the dollar. The dollar can start compounding, start appreciate, and essentially start benefiting from the appreciation of the asset that was allocated towards. The second point why $1 today worth more than $1 tomorrow, if it has been given to you, is the inflation. Every single day, the dollar in form of a cash is essentially losing value. It's losing buying power. So effectively, if you want to purchase these sunglasses, right, you like this pair of sunglasses, you kind of wait for discount or for promotion or for some certain sale. Let's say the retail price of these sunglasses this year in 2026 is, let's say, $250. And you wait for promotion and you don't see the promotion, or when the promotion actually is running, you don't have money to buy them. You wait and it's next year, it's 2027. The retail price of these sunglasses could be $300. Okay, so the retail price is essentially going up, and even if you get some deal, some discount, you still gonna be paying more if you purchase the glasses back in 2026. What effectively actually happened, I can give you also another example. I bought this watch during the summer. That's Omega Swatch 1965, just a random purchase, and I haven't looked at it. Last week I was planning to sell the watch because I don't really use it, and I look at on the site of Swatch, the price is already up. It's like $50. So the inflation, this is a real example, has played out. This is not a limited edition watch, right? You cannot buy it online, right? You have to sneak and wait on the lines in the stores, in the retail locations. Still, it's not a limited edition. So if the watch value appreciate without the watch being effectively more valuable from the summer I purchased it, this is your example of how the time value of the money is very, very important. So because I purchased this watch during the summer, instead of having the $300, I bought the watch. So if I waited now with the $300, my $300 could be worth $280, $285. This is what these $300 could buy right now, because the prices are even higher than the summer. If you go and try to buy the grocery and you fill up your basket or your cart with the same groceries, I bet you will not be able to fill the same amount or same type of groceries. But because I put the $300 into something, right, this something now at least will give me back the $300, simply because people cannot buy it from the store and they cannot buy it on the retail price I bought during the summer. It's a very simple, I believe anyone can understand and comprehend this very simple example. Another example I gave you with the glasses, same thing, right? Procrastination plus time value equals usually bad deals. You would hear from time to time people say, the person who is more patient, who can wait longer, gets the best deal. This is not usually the case. People who waited, imagine you were born in 2005, 6, 7, during the big blowout on the real estate market, right? You were thinking, okay, I'm gonna keep waiting to get the best deal. You know, when the banks take possession of the properties who have been returned from the owners, right? And you will be expecting to make a short sale, buying the property directly from the bank. Never happened. People who were waiting for the best deals, they never get into. People who were waiting for the Bitcoin when the Bitcoin dropped from 12,000 down to 5K, they never get an opportunity to buy it back at that price, right? So sometimes things are overdone, but usually they're not. This is why learning about time value is very important, especially in times where the inflation, it simply has no dips. Inflation is either consolidating at a very high rates, even now, regardless of the reports of the CPI, regardless of the real inflation, regardless of the reports about the core inflation, everyone agrees that inflation is much higher than the reported number, which means that the amount of money that have been printed, which is substantially larger than combined goods and services provided versus the money in circulation, means that inflation has peaked so high and has consolidated so high that it can't really fall that low where it was before, because the economy has grown and outgrown the previous economy. And when I say economy, you can simply speak the money in circulation, the GDP. You can speak in terms of money that are coming from the tariffs, right? The revenue that the government collects from tariffs. And the economy has outgrown a lot of the previous numbers. But remember, the money printer and all the money in circulation that was added didn't actually have equivalent in goods and services. So you got more money, but you have the same amount or a lower amount of goods and services, which essentially meant that people have more money, there's nothing to buy. This is also something what happened during the virus situation. A lot of people got stimulus checks, but there's nothing to buy. Everything is out of stock. So this is why understand time value, apply time value to your own personal financial planning, and understand when is the right time to do the move, when is the right time to wait, when is the right time to be active, when is the right time to sit in cash, and when is the right time essentially to reduce the amount of cash in your pocket. Because like I said, if I had the $300 right now, I have already lost 15-25% probably of buying power. But because I have the watch or I have something else, I have the glasses. This is why sometimes when you get a deal on something that people usually buy, right? Let's say you find an amazing deal on water bottles, right? You get like very nice branded water bottles, maybe 24, 36 pack, and you buy them all. Everything that you can buy. Why? Because first of all, you can always resell it. People always gonna buy water. And the second of all is worst case scenario, you're still gonna get used of them instead of you buying the water for yourself, paying full price later on when there is no sale. I was watching Mark Cuban. He said that every time when he goes to shop, to the groceries, whatever is on sharp discount, everything that is over 50% off, he said he buys as much as he can buy, and he store everything. And they asked him, but why? You're so rich. He said that's effective savings. If you can buy something in the very moment that you would usually buy throughout the year, and it's 50% off, you effectively save 50%. Why wouldn't you buy it? This is again a billionaire's mindset. It's not we try to be cheap, we try to be stingy, we try to play the game. No, it's the numbers. At the end of the day, if you save $5, you essentially have $5 more in your pocket. Pay very close attention. The people who invested in silver early on during the previous hype cycle waited 13 years just to break even last month. This is your big cautionary tale over here, because a lot of the people who currently talk about precious metals investing, hedging against the balancing of the US dollar have no real perspective on the historic run-ups in the precious metals. Remember, these things are not getting more valuable. No one is actually looking to buy more, to hold more, to produce more jewelry or produce more electric batteries with more silver, etc. Right? The idea over here, which is the same concept that aligns with palladium, same concept aligns with gold, is that everyone is kind of scared of the inflation, which of course it is a big money eater, wealth eater. But read this with me, and I want you to think about it, okay? You can even pause the video and read and comprehend and even probably take some notes. Silver prices peaked at $50 in April 2011. So the idea over here is that the current peak that we saw right before the dip last week, which erased gains for these 2 weeks prior, is something that always happens. That's not a one-time phenomenon. The same people, which are institutional investors of course, who are pumping are the same one who will correct the price in the very moment when they feel that economic policy or development is more predictable. After Coinbase reported earnings and surprise losses, Wall Street simultaneously turned extremely bullish on crypto market. Their expectations are out of the box, numbers that you haven't heard recently. Look at this. We're looking at Citi base case scenario, not extremely bullish, not regular. We're talking about base case scenario for Bitcoin price target for the 12-month horizon will be at $143,000. And this is a completely, regular, normal adoption prices related to institutional or government adoption, holding periods, national reserves, etc. Also, they have another more bullish case scenario at $189,000, which effectively signaling very strong institutional demand and potential ETFs filing for the other coins as well, not only for Bitcoin. We saw already with Ethereum, we saw already with AVAX, we saw with Solana. Very important, Goldman Sachs also is lining up with bullish expectations for 2026 regardless of the current price action. They're noting something very interesting. They said that the main constructive obstacle for crypto so far has been, again, a regulatory burden, which no longer be the case simply because we're very close to signing the Clarity Act, which will remove the bottleneck for crypto moving forward. This could actually be the last step, the last big hurdle on the legal side for crypto, stopping it to make new all-time high. Also, very important, a lot of these analysts on Wall Street are very comfortable with Bitcoin upside potential and looking at prices nearing $200,000 per one Bitcoin, and all this happening in 2026. These milestones, of course, are consensus. This is not out of 100 firms on Wall Street, 2-3 which are known to be bullish on crypto to be giving, bullish expectations and high price targets, which will not be ethical, of course, and will not be a good base for comparison. We're talking about consensus, which means all the firms that are known to be successful in the markets, they have successful track record for many years. Their consensus, they all agree that there is a bullish 2026 ahead for crypto. They're focusing not only on the prices, but let's look at the exact coins and what is the date by date or month by month basis where the big moves are expected. So first of all, we're looking at Tom Lee. We all know he's big on Ethereum. He is expecting Ethereum to range between 7 to 9,000 in 2026. He was wrong. For the beginning of this year, he was expecting very strong January, but January we had a tailwind that was not related to crypto, basically all the markets down. So this was not something that could have been predicted. But he's looking at least this range to appear, or these levels Ethereum to be reached by 2026 in the $7,000 to $9,000 range. And Tommy has been very successful by it, right? Also, ARK Invest, Cathy Lee, they have been very bullish on crypto overall. They have been discussing new strategies and they're kind of shifting towards on-chain infrastructure. So they're kind of trying to find the new 10 baggers, right? Coins that most people do not know about it. So they will be betting on coins that are part of the infrastructure that soon will be used, right? So far, no one's actually using it. Third important element over here, there's a new narrative that shifts around the ETFs, right? After we saw the Bitcoin ETF approval, then we saw the Ethereum ETF approval, then we saw Solana, then we saw AVAX, right? So this is opening a brand new door for liquidity pools, which means that every coin and all the teams who are working behind these blockchains and the coins with the blockchains, they are incentivized to grow the infrastructure and the systems bigger and bigger. They have more interactions, they build on chain, they offer different gaming projects, they support different financial products as well. So this is good because this will allow a lot of these investors to actually see perceived value and intrinsic value, which will reduce the sell-offs. Because now a lot of the coins are, 100% speculation, because they're not really backed by some actual revenue that could be tracked. They're not actually backed by, FDIC insurance. They're not actually vetted or tested or audited by the SEC. So all these things are kind of in the air. But when you see some of these companies who are, let's say, deeply involved into the government of financial systems, let's say, for example, XRP. Let's say XRP is used in financial transactions within the banks, internally or externally, right? This is some validation. Let's say if the government uses particular coin, uses the technology behind the company who created the coin, created the blockchain, then there is intrinsic value. It's obvious intrinsic value, right? So this is why 2026 will be very, very important. And a lot of people who now are very negative, they don't really see, they cannot see what is behind this red wall. Third important element over here, the clarification around the price targets. I think this is something also very important. So first of all, where the 200,000 or 150,000 price target will actually be coming. So analysts from Wall Street are matching two pieces together, which first of all will be on the legal side, high liquidity and rate cuts. On the other side, they're looking for Clarity Act and additional realization of the Bitcoin as a store of value. This is two elements that should play out. And Wall Street thinks that if this actually happen, Bitcoin could propel to $200,000 and Ethereum towards multiple thousands. Okay, they don't give you the exact number. Remember Tom Lee looking at the range around 7 to 9,000 or 6 to 9,000. They're also agreeing, but they're a little bit more skeptical to Ethereum. They're afraid to give you price target. But you probably wonder why they're so okay to give you the $200,000 price target for Bitcoin, right? This is something you should really think. Try to read between the lines. Of course, nothing is guaranteed, but if we see all these to-do list check marks appear, right? We have the Clarity Act signed. We have all the Bitcoin and other cryptocurrency systems being validated, implemented, and used not only on the private side, but also governmental and let's say institutional. And last but not least, we want to see the new Fed chair actually supports the Bitcoin. Because we already know and we heard that he's against de-dollarization trade, so effectively he's against gold and silver. So the question is he going to be pro-Bitcoin? Because he is going to be pro-dollar. This is the second and last thing that you want to pay very close attention to. So the people who are buying silver and gold at top prices were expected to lose the most money, but there are people who are going to lose even more money. People are selling their gold to buy more silver because the silver is cheaper and they speculate that because there is a larger upside, they're going to have last opportunity to make the most money with the small capital they already had. Whoa, look at this. Currently, why the both precious metals fell from the recent highs is because people, the smart people, are taking profits. Retail and other investors have been selling and taking profits when the silver and gold prices surged. Not gonna be waiting for $10,000 speculation. Not gonna be waiting for $1,000 silver, $5,000 silver. People are smart. Also, very important, the physical silver demand has remained the same. Physical demand for gold has remained the same. It's not less, it's not more. Pay very close attention. People are making predictions that the usual volatility that pushed the prices not only for gold and silver, but also for Bitcoin previous cycles will not be here because the gamble community has shifted towards betting on Kalshi, betting on Polymarket, betting on what's going to be the weather tomorrow. All these people who were looking for places to gamble their money, now they have plenty of options. They have sports betting, they have whatever, online casinos whatsoever. This means that the liquidity, in other words, the money that are needed for crazy rally in crypto, crazy rally in gold or silver, crazy rally in the stock market, are currently allocated elsewhere. So think about it. The strategy, that's what really blows my mind. Some people think that if they had, let's say, $5,000 in gold, right? but the silver is cheap, it's $50. So they think that, okay, the silver is cheaper. I'm gonna sell my gold, I'm gonna buy more silver, and the upside for silver is greater. How great? I don't know. But remember, we already saw blow off top. We already seeing struggle for gold to break the 5100. We already talked about this. I explained to you Friday, Saturday, Sunday. This level is unbreakable. Looks like. Look at the chart. Same thing happens with the silver, and there is a very interesting, important chart that shows you gold to silver ratio, which effectively represents the interest in the price action in real time between both precious metals. This gives you, probably, if you are of course intelligent enough, everything that you should know and understand about the interest, the volatility, and the money involved in the daily transactions. This has nothing to do with the actual physical gold and silver. Pay very close attention. The volumes of trading on Cauchy poly market has been increased. It's increasing month over month, not only volume wise but dollar wise. This is the validation of what I just explained to you. People who are usually pumping, creating these crazy meme coin rallies. We saw this with NFTs. Do you think that people who actually push the NFTs to the moon were people interested in NFTs? No. They were the same people who have some money on the side, looking for ways to gamble, looking for ways to try their luck. And this was one of them. They bought probably at 2000, something that we talk about the fair value over the weekend. Go watch this video of gold. And they were saying, okay, probably I'm gonna sell it 2500, 2700, 2800, right? I'm gonna make $300, $400, $500, $600, whatever. These were not people hoping for, $10,000 gold. These are not people hoping for $1,000 silver. So this is why now they moved from gold and silver, they moved from crypto. This is why crypto is struggling to recover back to the all-time high, right? Because there was a major allocation of funds. Cauchy got certification. Poly market is working on getting certification, becomes legal, right? So you understand that the more opportunities, the more buckets there are where people can dump their money, then gamble their money, risk their money, the less of each bucket will be. If before there were only two buckets, you got stocks and you got crypto. The old school casino gambling, it's over. Just look at Vegas. Vegas, if there was a chart of Vegas, decline, tourist attractions, revenue from gambling, revenue from the hotels that are relating to the gambling revenue, everything is down, and it's gonna keep going down because it's over. People are done with old school gambling, right? People prefer to lose their money gambling something different, and I totally understand it. I personally have never, go to the casino and gamble or playing on the slots. It's nonsense. I would rather buy, crypto and lose money on crypto than lose on the machine, right? That's why I'm trying to explain to you that there is a shift in demographic structure, demographic group of people who pushed the prices of gold and silver, who pushed the prices of crypto, who pushed the prices of NFTs, who pushed the prices of meme coins. But these people will not show up again to push the gold back to the previous levels, will not show up for the gold or silver or crypto to push the prices back high. The only thing that could actually happen for all of these scenarios to repeat themselves is to have major issues with Cauchy, with poly market, where these platforms do not pay. Remember, there was a guy who supposed to make over $1 million betting about will US invade or occupy Venezuela before December X, and something happened. The guy didn't win. The poly market said this was not occupation or invasion, right? So the guy didn't win. So if there is certain problems with payouts in these platforms, this is catalyst number one, where people say, screw this platform, they don't really pay. Let's go back to the old school, crypto. Let's go back to the old school options, futures, probably gold and silver. But unless this happens, I don't really see a reason for people, to choose to go back and dump $5,000 to buy a gold, futures or spot or whatever. Or they're gonna go and buy silver, right? When the silver is like stuck. The silver is stuck at these prices, there's no inflows, It's very slow mover. I also show you. If you're 100% interested in precious metals, you can just use a chart that shows you the ratio between gold to silver prices to understand what is the interest. People use similar chart that is Bitcoin to dollar, Bitcoin to Ethereum, Ethereum to Solana, right? You can compare similar investing asset classes that perform in the same period, which could be month, week, 3 months, year to date, and you can see the price action correlation in between. That will give you an idea where are the money coming in and out, right? This is really helpful to understand. Otherwise, you're just throwing darts at the board and you don't really understand what's happening. For all the people who cried earlier that they cannot simply own or buy SpaceX shares prior to the IPO and make tons of money, well, this might actually be your closest possible exposure. Bloomberg reports that Elon Musk considers going full IPO M&A, merger and acquisition between SpaceX, Tesla, and XAI. This will become a gigantic company, and this will give you a completely different exposure. If you look at the price action for Tesla today, the market wasn't happy, was kind of confused. But the idea of merging these three companies, it gives you a hint of Tesla is no longer a car company. It hasn't been a car company ever since start building the new upgrades and the whole software and the batteries and the whole charging systems, right? You do understand that the car is what people actually associate the brand with, but there is a software associated behind Tesla, and the software was the main driver for robotaxi, the autonomous vehicles, etc., etc., etc. The recurring revenue for all the people who in the future will be purchasing these vehicles and will be putting these vehicles to work while they're not using the vehicles as a side hustle business, Uber, Lyft. This is why this is your second validation over here that if this merger actually happens, you're going to have, probably not clear yet if it happens and how it will work, but if you currently hold Tesla shares, it will be very interesting to see how the price will actually fluctuate when the shares and the company merges with either or both companies, XAI and SpaceX. If you really understand, this will actually rebalance the value of Tesla, because the valuation of Tesla, if you look at the last 6 months trading sessions and what is the 30-day moving average, you will understand that there is a very high volatility, similar to the Bitcoin's volatility, similar to the crypto market volatility in Tesla stock. But when you actually have additional companies who support the more predictable revenue from SpaceX, the problem, of course, will be the XAI, which burns cash, and the social media business. It's really hard to maintain unless you're able to accommodate a lot of advertisers. This is why you saw today Meta stock popped, probably the only one from all the earnings reporting companies. Even Apple, who beat and destroyed earnings, it's barely up, like 0.20, 0.28. It's nothing. Only Meta actually saw the biggest growth. Why was that? I had to double check. The main reason why investors are still bullish, not only on the current representation of Meta, but also for the future, is that, remember, the Meta business is ads. And now, because of the AI and the super intelligence team, they can optimize ads, they can place more ads, they can make the ads more flexible, they can make the ads cost a little bit more for better performance of the usual users. So if before the same big companies who have budgets, let's say 10, 20, 50, $100 million per year, running the old models without the AI, without optimization, without the best cap expense right on this particular cost acquisition per client, this is now much more accurate. It costs them a little bit more, but it brings them much more business, supposedly, allegedly. So this is why people are bullish, because the models, the AI models, will get better, which will make the business of Meta much, much more profitable. Sure, they're hemorrhaging money like crazy, and they're planning to spend another $150 billion on AI this year alone. This is very interesting, because if we go back to the biggest M&A, if it happens between Tesla, SpaceX, and XAI, well, this will give a massive leverage, and also will give a greater probability for the performance of the stock, net worth of Elon Musk, of course, and will give a cushion of sustainability. If they have a bad quarter of sales of Tesla moving forward after the M&A, well, some of these missed opportunities or misperformance of the estimate of the earnings could be offset by very good performance of the SpaceX. Maybe he actually be able, as his main plan is of course to utilize XAI to become the one shop up where you will be able to buy stuff, hire people from here, being able to do absolutely that people are actually doing on the Chinese one-stop shop apps, right? They're using the apps for absolutely everything, for dating, for work, for social media, for entertainment. So the main concept here is that these three billion-dollar companies will add a separate value and will contribute with different qualities to the total valuation of the company if they go under the same ticker symbol. It is much better when you have a company with predictable revenues, which is the SpaceX, which majority of the revenue comes from government contracts. Then you have more and more predictability from the electric vehicle revenue from Tesla. And then don't forget, we do have XAI getting better and better. Considering the AI models, the grok, the value there will not only be perceived if there are a lot of advertisers and advertisement revenue, like people will be measured the success on Meta, but also the value over here could be coming directly from the performance of grok. People using grok for coding, people using grok for generating images, content, and the subscription model that is coming. Most likely it will go higher. We already have people who are paying the max top performance model from grok, top tier, $300 a month, if I'm not mistaken. So you do understand that the conceptual wisdom over here, people who are familiar with the AI industry, is that there is a direct comparison with some of the most profitable so far AI models, the Anthropic models, the Claude people, the revenue they're generating, the Replit, the OpenAI, right? All of these are kind of in a very close tier. Each one has a specialization in different part of the market, where some of them are better in content, other better in text, the other are better in actual video production or code-based software. The main idea is that if X is able to improve and keep building upon the current model and have a lot of people who are praising people who are coding on a daily basis, right? They're engineers, they're praising the model, they're praising the efficiency and the quality of the actual code and the answers. This is something that will add additional value and will help bring the valuation even higher, because you don't really expect Elon Musk to fail in general or in either of those ventures, right? You don't. Me neither. So worst case scenario, at least maybe 2 out of 3 companies will become super successful. Which 2 of these 3? Definitely, in my opinion, SpaceX will be the one, because there's no definitely real competition. No one has actually cracked the code aside from them to build the reusable rockets and to be able to deliver the space station, all the contracts that they have on a daily basis. They work with NASA, etc., right? And don't forget that there is a Starlink that no one yet talks about, and how Starlink will completely change the internet infrastructure around the world, and will provide the surveillance, and will provide the different services, something similar to Palantir. It might be in the future in direct competition with Palantir. Who knows what's coming next? But this is why you don't really have the exact expectations, because there are so many different pieces, and it's hard to collect and assimilate all the pieces, trying to make up the case for something that is one directional bet, right? I understand that. I do have a hard time also figuring out, but this might actually be the biggest IPO if it actually happens. If you bought silver over $130, or if you bought gold over 5,300, I'm sorry, I apologize, but things are about to get even more interesting to the downside. Look at this. If you look historically, history always repeats itself. Like it or not, believe it or not, it always happens. Silver crashes, looking historically, 1980s, 2011, 2026. Do you see some potential collusion, some potential relation? Look at this. There is a match between each of these crashes. There is a precision element involving part of the economy which always breaks or changes, which triggers always the same crash in precious metals. But I mean, let's look at the numbers. First of all, there is a sequence between the leverage positions, which are people who are buying with borrowed funds to go long on gold, to go long on silver. I don't have $100,000, for example. I believe the gold will go to $10,000 this year. Well, I'm gonna go long, but I don't have the money, so I'm gonna borrow the money from the broker, from the bank. I'm gonna borrow from third party, whatever. Same case with silver. So many people are blindly bullish for no reason. The problem is, like I mentioned, is that if you look back at the historical path of precious metals, economy, and the Federal Reserve policy, you will get an idea what the heck is actually coming on the market very, very soon. First of all, the people who are trading with leverage will get liquidated. They will be the one to actually trigger these forced liquidations. Second thing will happen is, of course, the Federal Reserve will come up with emergency meeting. You know what they actually did in 2022 during the banking crisis, right? They're going to come up with special meeting. What they're going to announce on the meeting? Well, we're going to improve the dollar, because the dollar is the actual sustainability of the US economy. Strong dollar supports everything. Job growth, wage growth, and wage growth will catch up with inflation, which, as you may have guessed, will increase the buying power and will increase the buying power of the US dollar. Look at this. The shock that has been seen for many, many years usually starts with around 30 to 50%. Then there is a calm period where everyone thinks the market will recover, everything will be good, everything will be fine. People, actually, some of them are buying the dip. Some of them are saying, you know, that's a buying opportunity. Go look at the precious metals bulls on X. Regardless, what happened next? There's another major plunge. And this plunge wipes out not only the dip buyers, it actually wipes out a lot of institutional investors who were staying put, but they already had such large positions with concentrated bets plus borrowed funds. So they're kind of the worst position possible, because you risk someone else's money, betting on someone else's thesis, and then in the end, when you lose, all the bankers are getting paid. Remember, the bonuses are coming regardless. They're getting also 1% from the money under management, regardless of the performance. So you understand who is actually the actual loser in any case possible. It's the individual investors, the people in the retirement funds, which fund actually invest in precious metals, right? Pension funds, these people. But let's go through the actual mechanics. So I want to make sure you guys understand step by step how this actually works, or how this actually have worked out in the past. 3 separate crises. First of all, silver hit $50 in 1980s. Okay, everyone was, woohoo, $50, unfreaking believable. I'm gonna buy a car. But in April 2011, silver effectively dropped to $49.80, and this was already kind of a small hidden sign that something is wrong, because silver was consolidated at this $50 range for a very long period of time. People were kind of treated silver like a stable coin, like it's not gonna move, it's not. And when the silver broke under 50, people, well, what went wrong? You know, something is off over here. Fast moving forward, the silver went to $121 in early January, right, last month. And people had the same hype mentality, you know, the same hype that was when the silver hit $50 in 1980s. The problem over here is that right after this $50, the silver had 60 to 80% crash. Which, if you compare 1980s, go to $50, everyone is happy, everyone is bullish. 2026 January went to 121 or 126 depending of the chart, depending of the country where you're looking at. Then now we're waiting for this potential crash, which is, if we replicate the same identical, could be 100 to 150%, and this happens in months. Sure, as bearish as I am, I don't expect to drop 150% immediately or right now. But there is a two-way scenario where it drops one time substantially, which is 25 to 50%. This is plausible. Why is that? Because the silver already dropped in one single trading session 40%. So if the silver dropped 40% in one trading session this year, 2026, it's just show you what is possible. So if this is the case again, this means that we might see 20, 30, 40% or even 50% in one day, and then we might see a small drawbacks, 2-3%, 1% down, 3% down, 1.5% down, little by little, but it would genuinely, you will feel the trajectory. Then there will be people who will be looking to buy the dip, right? Remember, there are people who have to average down, people who bought at 120, people who bought at 100, people who bought at 90. So if these people are not buying the dip, they're going to stay with average price of 120, which I don't know how many years these people have to wait to break even. If I was one of these people, I would be very pissed at least, or maybe angry. Because the other people who bought at 50 before the previous crash down to $18, they waited 15 years to break even. So let's run the numbers. This particular dip in 1980s was identical, 25-50% with the one that we saw in the end of January for 40% for silver. And this happened intraday session. This was not a couple of days. We're talking about intraday session throughout the day. Same thing happened over here with 40%. Well, open interest is the next thing that we're going to compare. Open interest back in the days 1980s was lower, right? Because the trading volume was lower. The amount of leverage was smaller and also harder to get to obtain. But now, it's much easier. People borrow left and right. So it's not so closely comparable. But you can still look that open interest hit all-time high for each of the precious metals. $200 million announced equivalents, which probably you understand that this is much out of the demand zone, right? With net longs, people who are going long on borrowed funds, 4 to 5x, and currently 35 to 50% of the futures, which I'm trying to give you like a simple explanation, or trying to give you a better understanding what this even means. This means that a quarter of the holders are not using their own funds to purchase or bet against or bet on these particular precious metals. They're using leverage. This means that this quarter of a percent, you can say 25% of the holders, if the market crashes again, this 25% will be the first one to be sold because they're going to be forced liquidated, which means 25% crash. It's pretty likely if we have the same setup. The question is what's happened after 25% crash? Because then, the next people who are holding with their own cash, institutional investors who they hold with their own cash, they're going to decide risk management procedures. Don't forget that also a lot of people trading with algorithms and with computers on Wall Street. They're using alternative trading systems known as ATS. So they are programmed usually to obtain very strict risk management. So this means that the assets they hold, if they drop 0.3, 0.5, 0.7%, they have to trim the position. If the assets drop 3 to 5, they have to trim even more. So if there is like a 10, 15, 20%, who knows, they might actually liquidate the entire position. So this is why you want to study the history. History is giving you very good idea what you could expect in the future. More than 57% of all homes sold throughout 2025 has already lost value, on average between 8 to 10%, meaning anyone, whatever they paid cash or took mortgage on it, they're already underwater. Oh my little friends, there is a new real estate collapse coming in 2026. It's not coming, it's already here. And we're not exaggerating over here. It's a very interesting article that was just released from Bar Chart and alongside using the due diligence of Wall Street Journal. And if you could look at over here, the market hasn't seen such a big slide in pricing for the last 14 years. Even right after the financial crisis in 08-09, we haven't seen such a big steep slide. So pay very, very close attention. We're gonna look the situation through the perspective of the developers, through the middlemen, which are the brokers, the salespeople, and the realtors, and the people who actually consume the properties, which are renters and buyers. Everyone is in such a bad situation. Look at this. So currently, we're experiencing the biggest price slide in areas that were overdeveloped. The most popular areas where a lot of people relocated to from their own original locations. The main data over here indicates that the current price decline is not only bad for people who are currently listing their properties for sale because they wait 120 days. No one actually shows interest. They have to delist the property because they don't want to look bad. Because if you go online and look for a property, either to buy or rent, and the property is over 100 days on the market, you as a buyer or renter, you have a huge leverage over the person who rented out or the developer, right? Because the developer is in such a bad situation right now. Why? The prices to build a brand new building are much higher than before. It costs much more to build the same size of a building. Also, they have to pay higher wages. On top of that, the insurance is sky high. But they don't really care. This has never been an issue for them. They just add this to the price, create a package for either buy or rent, give this to the middleman, which is the broker. The broker looked at this and said, yeah, ain't gonna happen, G. We have properties we cannot rent out. Much better location, has views, balconies, and they're 20-30% cheaper than your current prices. Ain't gonna happen. And look at what the Wall Street Journal actually reported. This is probably one of the most important reports so far. According to Wall Street Journal, the condominium prices in the US in September and October has seen almost 2% decline. And this might not, appears to be a big deal. But this is the biggest decline since 2012. And we're talking about right after the housing bubble, when everyone was thinking, oh, this is probably the best time to buy. The market has bottomed. Everywhere there is deals. You can find, duplex, you can find triplex, and people were not quite interested. But over here, things are getting even more interesting. Zillow, on the flip side, is putting out a report which shows that the people who recently purchased condos, they just bought a condo, and the price of their condo that they purchased is already down 10%. So people who recently purchased a condo, most likely they're, if they paid cash, it's kind of okay, to see a short-term decline in value. But if you actually got mortgage and you have some crazy interest on the mortgage, and you're not only losing money by the value of the property going down, but you actually feel that you're overpaying for something that might see even greater decline. So according to Zillow report, 10% of the condos are now currently valued under the sales price. And this, what does it mean? This means that owners currently are underwater, and they will be stuck with this property for whatever the length of the mortgage is. If you rent it out, who cares if you rent it out, right? Not to mention that if you're an owner, the HOA fees are going higher, the property taxes are going higher, and like I mentioned, the developer costs, even the developer cost is not gonna go low. It's gonna remain steady. The only thing that could actually go down could be the demand for a certain period of time. Because when you have an overdevelopment, the supply and demand equation changes in favor of the people who consume. Right? This is not happening quite so often. What else is happening over here? So according to the same report, the HOA fees currently sit at around $4,000 per year on average. So just think about it. Regardless of your crazy property taxes, right? If you buy a condo, you have to put on side on average $4,000 per year. And this is maybe not a lot. For New York standards, of course, not a lot. Their condos here in the city, like, they have like $6,000, $8,000, $9,000 a month HOA. So this $4,000 per year, it's not a big deal, but obviously for Florida, I don't know, it might be a game changer for a lot of people. Because remember, a lot of retirees are moving to Florida, right? So they don't have like crazy amount of savings. So any changes in the predicted expenses or cost of living that they did when they retire and they move, they said, okay, this is our fixed cost, fixed expenses for living. You know, we know exactly how much we're going to spend a month for this or that, how much we can afford. And when something like this changes dramatically, you know, this can push a lot of people in a very, very bad place. Don't get me wrong, I love Florida, I love Miami. Definitely a very nice place, better than New York City, but you cannot hide the fact that probably they will be the one hit the most with all this steep price decline. We're about, maybe we finally are about to see some very reasonable price decline, because people have been speculating for many years. A real estate bubble is bursting, a real estate crash is coming, and there's so many people are praying every year, right? Because they simply cannot afford to buy anything, and they hope for this crash, and this crash never comes. And hopefully, you know, we might actually experience one of those. It will be good to reset the market, to reset the prices, to give some leverage to actual users, right? People who are really struggling to find a place to either live or buy. Second important part over here, the prices of the buildings from 2024 currently are worth less. The building built in 2024 versus the buildings built in 2025. The prices in 2025 are lower, you have less deals, it costs more money to build, versus 2024. In 2024, as you remember, the mortgage rates were at 6, 7, 8%. So no one was buying on the higher mortgage rates when the buildings were cheaper to build. Now we have a lower mortgage rates. The buildings to be built for the builders is more expensive, but also the prices of the properties are lower. Do you understand what kind of mixed reality we're living right now? According to Zillow, 85,000 listings in September 2025 effectively has seen a sharp decline and reduction of the listing price. Effectively, anyone who listed a property throughout the year and expected to get different prices either for rent or essentially to sell the property has to reduce the price. A lot of people actually completely delist the property, send someone to take new pictures, because now the AI can identify if you just repurpose the old pictures. And if you ask Perplexity, let's say you want to buy this condominium over here, currently listed for let's say $150,000, figuratively speaking, and they release the whole property with all photos, the Perplexity can tell you, you know what, the same exact apartment was actually listed for $240,000 just a month ago. So effectively, just based on a visual search of the images and replication of the same exact listing, all the information, they're trying to erase the information, erase the old listing, erase all the data, and release the properties with lower prices. This changes also the graph that you will see on Zillow. Remember the price history of the property, when was acquired, what pricing, what was the most recent price cuts or price hikes, or what was the price that the property was acquired prior. All this information is simply erased when you take a new pictures and create a new listing. Sometimes they even change some of the information or structure the information in a way in which that the bot will not identify that this is the exact same property on the exact same location in the exact same building. We're talking about actual panic mode for a lot of people. Second important element over here, something that we haven't seen since the 08-09 financial crisis. we're having a shocking demand crash. No one is actually looking. Why? Because first of all, they were very, very scared that the prices will go higher. They got scared that they're gonna get fired because of AI. They didn't want to take mortgage, so they said, you know what, I'm just gonna rent. And this created, as you can see over here, the lowest level of demand that actually peaked below 1.4 million in November 2025, which was down 2.5% month over month, which effectively means that all the people who are delisting the previous listings, right, they're not just going to give a small discount on the previous listing. They're going to give a sharp discount because they're not just competing for clients, they're competing with other builders or other developers who are effectively looking to find somebody to live in their building, right? The bloodbath continues. According to Zillow, listings saw 26.9% cut in late 2025. So going closer and closer towards the end of 2025, they were already looking for escape valve. You know, not gonna be surprised seeing the usual 1 month free, 3 months free, 4 months free, just to get you to sign the lease. And because these leases usually duration have 12, 24 months, depending how panicked they are. Because even if they lock a lease for 24 months on much lower rate, right? Nothing that they were expecting to offer this property for, it's still better for them because, like I said, a lot of people speculating for recession. And if recession actually hits, believe me, these people will be the first one to get hit. Of course, after the commercial real estate.
It's clear now that an employee is just one of thousands in a number on an Excel spreadsheet, as easy to remove as hitting the backspace key.
I don't know why you're not panicking. In 70 years, $100,000 will be worth only $10,000. And this is with average 3.4% annual inflation based on the last 5 years. And this is the most average low ball scenario. If we go the realistic expectations, which essentially means that the inflation will be even higher than 3.4% per year, this means that we might actually see this $100,000 melt buying power to $10,000 in halfway through time, 35 years, 40 years from now. Why are not you panicking?
Imagine working somewhere for 38 years and waking up to an email at 5:07 in the morning letting you know that you don't work there anymore because your job's been eliminated as part of a layoff. One person doesn't have to imagine that. Adam Bernard, a 38-year employee of General Motors, whose job was eliminated last week as part of a large layoff at GM.
You should be panicking. Your kids, you put $10,000 every single year, for example, in your kids' account, grow compounding without paying taxes or with specifically tax executed strategy, limiting your tax exposure. And in the end of the day, after 30, 40 years, they're going to wake up, they're going to think that they have $1 million, but they're only going to have $100,000. They're only going to have $90,000. This is why you should start panicking right here, right now. This is not some fugazi metaverse expectations, simulations. We run the numbers based on adjusted inflation with an average of 3.4%, which was the average inflation for the last 5 years. And it's not going to remain at 3.4% because the Federal Reserve will continue printing money. Don't ask me why, this is a very long topic for a completely separate video. But they're going to print more money. Printing more money will increase the money circulation supply, which will increase the amount of money versus all the products and services provided into economy, which will create the balance of the services versus the actual paper value of the money, which will push the inflation even higher. More money will be worth less. This is why we meant that if the inflation is higher than 3.4% every single year for the next 30, 40, 50, 60, 70 years, well then you don't have to wait 70 years to see the buying power of 100K going down to 10K. You may be waiting 30, 35, 40 years to realize that, you know what, the prices are absolutely sky high. You still get the 100K, you still have the 100K in your account, but the 100K can only buy $10,000 worth of items. Imagine if today you could buy, let's say, some small very old house in the middle of nowhere, some small city in some, not so expensive state, out of the borders of the downtown for 100,000. In 30, 40, 50, 60 years, you may only be able to put a down payment for the same amount because it will be equivalent to only $10,000. This is why people should start panicking now, immediately. Okay, you should understand that the cash, what was looked at always a reserve, which was always looked as a backup plan. If your investments are not performing, if your job is not giving you a raise, if let's say the assets that you have, that you inherit, are not increasing in value adjusted with the inflation, well, definitely you should look into plan B. Well, a lot of people still don't understand this. They're looking, the market is choppy, the market is going down, their friends losing money on the markets, they're looking, the crypto guys are losing money, they're looking at the people who bought real estate, and after they bought the real estate, after they set up all the legal, the paperwork, they work with brokers, they find tenants, they fix everything, and then they finally decide to do the math, and they found out that it will take them 25, 26 years actually to make some money, not crazy money, right? And not to mention that the usual appreciation of the real estate is taken away from the property taxes, which are increasing every single year. So the little appreciation that you're going to get, even if you have bought the property for 100,000 and after 5 years this property worth 200,000, you make 100% on your original investment. But guess what? The property taxes for the last 10 years have increased 25%, right? So a quarter of your unrealized profits, the upside of 100k, goes straight towards your property taxes. Then don't forget, you also have to pay taxes on the gains that you have on the real estate property. So you have all these hustles and bustles, you have all this work, physical, time-consuming work. You're involved in huge liability, right? Sure, the tax advantages of owning real estate are outstanding, unmatched, of course. But at the end of the day, you don't really make crazy money with real estate. And this is why a lot of people now trying to sell their properties. Everywhere I've seen, you just go on the websites that are selling businesses, or their people list their businesses for sale. You could see people who own multiple locations. And not talk only about real estate, we're talking about people who own vending machines. People are selling the whole chain neighborhood route that they own with vending machines. Like for example, you own 5th Avenue, like 45th Streets, you have vending machines throughout this path. It's all yours. You want to sell everything. You want to liquidate everything. You go and see people sell home service businesses with multiple locations. They have built infrastructure. They have people who they service like regular clients. People want out and probably wonder why. Right? The same exact reason. When you realize that you're trading your time for money that are not actually getting more valuable but decreasing in value, well, you kind of put in the position that you exchange something for something else that loses value over time. So effectively, you are the end user, the end loser in this formula. So what people actually do, think about it. I'm gonna give you a very easy, simple example that you will be able to comprehend, right? A lot of people are using their checking account to pay off their credit card, right? But the checking account has no yield. You don't get interest on the checking accounts usually. Even if you get some, it will be the lowest possible. The smartest decision, even though might not make a huge difference, but it will make some difference, is that instead of having a checking account, you can have a savings account. In your savings account, you pay off your credit card with your savings account. If you have, let's say, $10,000 in your checking account that you only use for paying off your credit card, right? If $10,000 sits in your checking account, you will be getting $1, $2 per month interest. If you put the same exact $10,000 inside the savings account, you will be getting $15 to $30 a month. You see what kind of a difference? You still use your savings account to pay off your credit card, but you're getting $50 to $20 to $30 depending of the APY that you're getting every single year, right? In your percentage interest, right? This is very, very important because a lot of people do the same exact thing, which effectively they're not only missing out on the opportunity, to recoup most of the interest, but they're also missing out on the opportunity to not hold the cash inside the checking account. This is very, very interesting. And a lot of people do not know that you can use the savings account and paying multiple times a day, a week, a month, because there is a special, limitations of moving money in and out from the savings account. But when we're talking about paying off your credit card bill, this doesn't really count towards. This is why you need to understand that. Why would you leave a free money on the table? Knowing that if you bank with the same bank, and if you have checking account and savings account with the same bank, why would you keep majority of it inside the checking account? That doesn't make any sense. There is a major paradigm shift that is happening as we speak. And the problem over here is that a lot of your friends and people that you know from school or probably you work prior with are currently in a very, very bad position. You probably have friends who used to have a very successful business, which is currently or recently closed. Probably had a lot of friends who had a very good profession, they have a very good career, outlook, who were recently fired, right? And this paradigm shift represents the second part of the equation, the people who do not see this paradigm happening, people who really oversee the linear progression of the economy. They were preparing themselves academically and business-wise for an economy where everything was going to progress in a linear way. You get a job, you get a degree, everything is kind of more or less predictable in the future. If I want to start a business, I know exactly what I should do and how the business will grow. If I want to buy the house, I know how to get the house, the mortgage, how to get funds, how to manage the mortgage, so on and so forth. Same thing happened for the people with a career. They kind of prepared themselves for careers in a linear economy where they didn't expect the next paradigm, which in our case, we're talking about the AI revolution happening, or didn't believe that it is going to actually happen. So a lot of the people that you currently know, friends, family, are secretly broke. And things are not getting better. You just look around. You just look around. Think about people around you. It almost felt like during the last 2-3 years, everyone was kind of doing fine. Everyone was kind of doing okay. It has always been people who were doing better, making more money, growing their net worth, whatever. But almost like overnight, in the last, let's say, 24 months, everything snapped. Almost everyone got poorer. And the people who are doing well now are doing exceptionally well. And the gap actually expanded, right, in the levels that probably haven't heard of. And this is not only coming from the paradigm of economic non-linear development. We're talking about a shift where the skill set combined with lack of preparation for adjusting your not only mindset, but adjusting your skills and adjusting your knowledge base plays a determinational role. People who cannot adjust cannot survive. It's very, very simple to say it, hard to execute it, but I believe the hardest part is actually to see where the problem actually lies. Because like I said, a lot of people who were doing very, very well, they think about the last 2-3 years, people around you, your very immediate circle, doing some e-commerce, reselling some clothes, doing some Amazon, having some physical retail location. I guarantee you most of these people have either closed or lost business 20, 30, 40, 50%, and very soon they're gonna close, especially people with high-paying jobs previously. They're the first people who were found themselves not needing, right? The people who are making 150 account manager, 150K, 200K, 300K account managers, all this date sorting, filtering, input lead generation positions who were essentially paper holders, completely are out of their mind, right? Imagine you graduate 8 years ago, you spent 6 or 7 years, you already seeing yourself to become a VP in whatever company you're working, and now you're out on the street. Why? The paradigm shift is happening. And this is not some science fiction. I want you to really understand the concept, because when the paradigm shift happens during the first revolution, moving from actual horse carriages towards automobiles, right? The second revolution coming from actual plugging the engineering skills of the humans, a lot of people if not most of the people, have no clue how this actually works. They didn't have idea how the car works, the combustion engine works. They didn't have idea how the electricity works. They didn't have idea how Nikola Tesla actually built the AC and how he converted and actually destroyed the DC of Edison. A lot of people weren't so sophisticated and weren't so interested in learning anything outside their original skills by training, whatever they learn in school, whatever they learn in universities. This is what they lived with. No one was actually going out of their way to learn something else on the side, or at least not deeply enough. You had some surface knowledge. Back in the days, people didn't even know where this country or that country outside the US actually was located. So you need to understand that people who lived with this mindset, they had to learn. And the good thing is that there was no distraction back in the days. People had nothing to do. You go to work, you finish work, and then nothing to do. Most people had no televisions back then. Then when the next revolution came, yes, some of them have radio, some of them have televisions, but still the distraction was not at the level that it is right now. So this means that people have actually focused strict plan of execution or learning some of the skills. This is why a lot of people actually found jobs. When the US Steel was actually started and executed, a lot of people learned how to utilize steel, how to build bridges. A lot of people without engineering background learn how to do engineering, right? So this means that anyone can learn everything, regardless of the type of paradigm shift that is happening around the world. But a lot of your friends, I already guarantee you, they don't want to learn AI. They hate AI. And they secretly hope that AI will give up, AI will disappear. They secretly expect this is going to be just another bubble and everything will simply go away. I hope Michael Burry also hopes for the AI bubble because he's betting big against the market. But again, if you just hope on one thing, you're not really hedging, you're not really risk adjusting your bet. You should always prepare for the opposite. You should prepare yourself for being right. You should prepare yourself for being wrong at the same freaking time. What this means? Well, you can still hate the AI, you can still hate all the technology, you can still hate any tool that replaces the human skill that you previously possess, but you should also simultaneously prepare yourself to utilize the skill either for yourself on your personal life or utilize the skill to save it as a service. And I'm not just picking up stuff from the air. I got plenty of calls from different banks that I have business accounts with, right? And I got plenty of calls. And all of the banks, when we have personal meeting one-on-one, they said, why don't pick up the phone? Why we cannot reach you out? I said, I already have an AI agent that filters and sorts out all the calls. Not only this, I have disabled the voice call. Why is that? Because the AI agent filters all the calls, and before the voice calls actually leave a small transcript on the phone, and this transcript can give a false directions to the AI agent. Can say, oh, this is the information you requested. You can just click here and find the information you requested, and the AI agent might get confused. They might click on links that shouldn't click. This is going back to the example. Regardless of what you think about AI, regardless of what you think about your current, financial or career path, you should hedge every single bet and prepare yourself to take part in the paradigm shift. Otherwise, you're going to be left behind the paradigm shift. You're going to be left with people who didn't believe in cars replacing the carriages, didn't believe that electricity will replace the gas swamps, didn't believe that the actual guns will replace the bows and arrows, and the people who were, not optimistic, didn't hedge their bet. No one said anything about them in the history. They were simply erased from the history. Replaced. Technology results, the results from all of these technological innovations replaced anyone who was skeptical of. Think about all the people who were writing articles in 19s that the internet is the next fad, the internet is the scam, it's nobody's going to be using. Same people who are talking that no one will ever own a personal computer because it doesn't make any sense. These people simply were washed out of the media, washed out from the social media space, washed out from the history because they were so wrong. Then ask yourself, do you want to be washed out from the history or you want to take part of the history? of this paradigm shift. Think about it. Go read Oscar Wilde. Right? You know what he said? In the end, everyone else ends up being somebody else. There's only one thing that could and most likely will destroy your life in real time. I'm talking about professional or simply mental. I'm not talking about any of the addictions people talk about, substances whatsoever. I'm trying to explain to you that if you really think about it, right, in the road of the line, you understand that there is only one thing everyone overlooks. And this one is the feelings. Have you ever heard someone on Wall Street getting rich out of feelings? I feel this stock is a buy, and then they lose absolutely everything. No one gets rich off feelings. This is just the professional side. What about the personal side? Well, people are eventually getting weaker. They have a blurred, perception, or they cannot analyze 100% accurately, non-biasedly, particular situations. That's why they lose. They have been taken advantage of. You will always lose. This is not some theory, speculative judgment, personal experiences, or caveats. This is 100% accurate, back with the data. Run the freaking numbers. Every time when you use the feeling for something, you lost. And the person who used the hardcore data won. A person who used even analytical sense, sixth sense, which is not the feeling. Sixth sense is based on previous experiences. I feel that X is going to happen because previously this and that happened, so I have a sixth sense that this will happen. Okay, it's still backed by particular data or previous experiences. Something that people call, experiential data. When people talk about feelings, I have a feeling I have to go out tonight. I have a feeling I'm gonna be lucky. I'm gonna play the lottery. I have a feeling this stock will go to the moon. All the people who have feelings use feelings, they lost everything. Nobody won anything from feelings. I'm speaking to you because 90% of the team here it's men, right? So we don't really benefit from it. I don't know what it's like to be a woman or what they benefited from the feelings, but for a man, you just cancel it, bro. Just cancel it like a Netflix subscription. Forget about feelings. It completely ruins you. Business, so the same feeling. How many startups felt that this product or this service will be super popular? Remember last year they launched some of these wearables that you actually put like a necklace with a camera, and they run a couple of influencers, this and that, because they had a feeling that this is going to be the next hype, the next high tide of the tech. And it took only one tech YouTube influencer, Marcus Brownie, to destroy the brand and company product, and everything went nothing. Again, they had a feeling. They didn't have hardcore data. They didn't utilize, some beta testing in Asian countries 3-4 years before they actually launched the product in the US. Again, if you have feeling about something, you are going to lose against absolutely everyone who you betting or competing with, who is using something else than feeling. He's using insider knowledge. He's using sixth sense. He's using other people's experience. He's using even rumors. People using rumors are partially, somewhat, in some sense, 5, 10, 15% truth. Still, it is more hardcore data than you having the feeling that something, it is going to work out. Biggest nonsense. I've seen people losing everything. People buy house in good area and they have the feeling that this house will appreciate it. Why? They cannot find comps, but they just have the feeling that it's going to work out. 3-4 years down the line, they try and get out. You ask them why, they have no answer, right? Because I asked them clearly, why are you buying the house? Because they had a feeling to buy the house. Understand? You cannot make financial decisions based on feelings. I've said this many times. And looking even more clearly on the personal side, people lose even more. Because on personal side, people don't know how much they can actually lose, right? If you really think about how on the financial side, people know how much they can lose. I have a feeling this stock will go to whatever. I put 100K. I know if I'm wrong, my feeling was wrong. I lost 100K. But on personal site, the stakes are very, very different. People don't know how much they're actually betting, right? So they don't know how much they're gonna lose. People lose time, years, dating someone, going out with someone, because they had a feeling that someone is something special. And it isn't. Go read Oscar Wilde. What he said, in the end, everyone else ends up being somebody else. Whatever they said, whatever they show that they are, in the end, they will be somebody else coming up on the surface. So it's all some sort of a lie, especially on the personal side, and I would say personal life. So this is the risk that, most of you are going to take. Like I said, if you bet something on the market that something is going to happen, you're just going to lose the money. That's okay. But on the professional side, you bet this person is for real, legit. Some people fall in love, they get married, they buy houses, they split wealth, they transfer everything, they have kids, and then in the end, everything goes nowhere because they just had the feeling that it's going to work out, but they didn't have data. They had core data to justify the decision. That's all it takes, to make it or break it at the end of the day. Because you don't really get the idea of owning something like this just by having the feeling, right? That it's not really how it works. You don't get to own something this outrageous. You don't get to be outrageously successful if you don't give out something that is bet and backed by data. Just think about why Wall Street doesn't use feelings or even their sentiment analysis that analyzes the most popular words on Reddit in the retail investors group. Even their sentiment analysis is not what people think is going to the moon, but rather what people talk about the most, right? The specific counter that counts how many times this company was mentioned, how often this company was mentioned. There is a specific chart which indicates how is the search queries, is the type queries for this particular company continue to go higher or they go lower, which means are the interest, this particular keyword is going higher, is going lower. And I explained to them very clearly. They don't understand. They keep doing the same freaking mistakes. Because data is boring. Data cannot give you feedback. You can look at the data, you can try to analyze the data, but if you cannot have a back and forth with the data, if data cannot speak to you in some way, people choose to base the decision based on feeling because they feel that the feeling is telling them something. They feel that they have this, weird monologue with the feeling that I have a feeling this is going to happen. Something is telling me this is going to happen, which is weird. And remember, weird things don't produce good results. That's why all of them lose everything. Let me give you a little rant about American Express. Take it from someone who has traveled around the world, used different credit cards, have over 10 different credit cards, and consider himself a very financially literate individual. So pay very close attention. The worst and probably one of the biggest downsides of American Express is that American Express, it's not accepted everywhere. There are many, many different merchants, especially big purchases sometimes online. You try to input your American Express credit card, it's not working. They don't accept it. Pick a different payment method, which is a big, big downside. Second important issue that I have with American Express is that they have a large spending limit and they have a small rewards. They have one of the smallest rewards. Spend $3,000, get $200. Deposit $20,000, get $200. Something like unusual, something that is not working for anyone. Doesn't make any sense. Third big issue with credit cards of American Express, of course, is that they don't actually credit your cashback points or rewards immediately or after the transaction is posted or after the next week or 2 weeks. No, you have to wait the whole billing cycle. So every time when you spend money, you have to wait 30 days to collect your rewards back, which is ridiculous. One of the slowest old school systems, which kind of link with the next part, which is a huge, huge downside. There is no inside the website or the app of American Express way for you to track how much money you spent and how closer you are to actually qualify and receive your bonus, talking about the sign-up bonus. For example, you get American Express blue cashback preferred, which I have. And you should spend $3,000 in the first 6 months to get whatever, 200, 300 hours. Each offer is individual. Well, if I want to see how close or far away I am from the bonus, I have to reach out to the Associated American Express every single time, and I have to ask them, they have to compute. I ask them why this is not a function on the website or on the app. They said, no, you have to manually compute your spending every single day or week or month to figure it out how close are you to the actual bonus. Can you imagine? 21st century, you have to go and manually compound. Today I spent $12 at a burger place, and yesterday I spent $11 at the subway, the public transportation. Can you imagine every single day going back and forth until you actually come up with $3,000 number? It's one of the worst. So American Express is unusual and different in a very negative way. Everything is different. Everything it's negative. It takes a lot of time actually to earn the rewards. It takes a lot of money to earn the rewards, and in the end the rewards is so freaking small, it doesn't even worth the time and effort to do so. Fourth important element, customer service. Every single time I have reached out to the customer support, all the individuals, it might be my personal luck, all the individuals have no clue what they're talking about. They don't know the products, they don't know the services. Many times I called them asking them for a particular service information, they say something, and further down the chat they say something different. And I said, what happened with the first thing you said? They said, oh, my mistake. I didn't know. It doesn't work like this. We changed the system, some nonsense. Customer service, I don't know. Are they working with interns or whatever, right? So bad customer service, bad products. The product is bad itself because the product is not accepted everywhere. The product doesn't actually fulfill the need, right? You want to buy a big purchase. Let's say you have some categories in your American Express credit card with high, let's say 6% on grocery. This particular card has 6% on grocery and it's capped at a certain amount, right? Let's say you try to spend this on something and you don't really get the rewards because the merchant doesn't accept American Express, because American Express charges a fee that is too high for the merchant. So it's not worldwide accepted, which is super duper annoying. Fourth important element over here, why this is such a bad card. I want you to understand that this card doesn't offer superior benefits to any other mid-tier cards, right? You can use, in the same sense, you can use Capital One Saver, you can use Capital One Quicksilver, you can use Chase if you catch some of the categories, Freedom, Unlimited, you can get the 5% cashback on groceries, which is almost the same. But all of the other cards are not coming with annual fee. This particular card comes with $95 annual fee, which it really nothing unique comes with a card to justify this annual fee. For example, there are other cards which you can actually benefit from something that comes with the card. There are perks that have significant commercial value. You can exchange them for something. Let's say some card comes with $200 credit for towards vacation, $100 towards public transportation, $50 credits towards Uber, $100 credits toward Airbnb. Things that when you actually use and combine the value to, they actually outpace or outnumber the annual fee. This card doesn't come with any of those. The only benefit of this card is the 6% grocery cashback. But when you see that you don't really get the cashback, the next day, the next week, the next couple of weeks, it kind of doesn't make any sense. Remember, you don't always get the full cashback of money you spend. Sometimes, they don't really count some of the stores. Because remember, when you use any of the credit cards which come with higher, grocery store spending cashback percentage, anything above 3% is considered higher cashback amount, right? Always these credit cards come with special terms. They don't include Target, they don't include Walmart, They kind of wonder what stores are kind of left inside this actual category when you remove the biggest ones where people shop the most, right? For a fact, you can get, Lidl, you can get Audi, some of the other good stores, which is beneficial, of course. But like I said, if you're not able to see for which stores you're getting the 6% cash back immediately, or which is normal. Every single bank, credit card provider, it's offering you cashback points, which convert into dollars immediately after the transaction is posted. So you spend $50 a day on grocery, and when the $50 actually posted, you will see 2-3 days after, you will see the points and the rewards in percentage wise, right? You can exchange them, you can use them. It's very easy, very smooth. That's not how it works with American Express. It's super annoying. You have to wait 30 days, and then you have to wait for them to actually distribute each of the purchases into different categories. And then they have to see which of these purchases are actually approved to get rewards and cashback, and then they're going to distribute you the cashback to you. It's mind-blowing. It's unusually uncomfortable to walk around with this card. There's no support. You cannot change anything. Like with other cards, I can just call, make some changes, do some, flexibility improvements on either the status or either the system. Right, but with these cards, you can't really do nothing. All the people I spoke to, they have zero to, at most like base knowledge, something that I can check with Grok, and Grok will give me the same info about the card. It's simply ridiculous. Again, I'm 100% honest over here. I would not recommend any of the cards of American Express. The whole system is designed differently in a negative way. It makes it very hard for you to use it and to extract value out of it. That's my opinion over here. Here is the simple test that everyone should run on themselves. Let's say the place where you live. You can be in the mountains, it can be in the city. You like walking every single day. When you have a free time, you like to go out for a walk. If you live in the mountain, you love walking or hiking 2 hours in the mountain. If you live in the city, you like spending 2 hours going on the stores, going to the mall, whatever. But after these 2 hours, you always feel that your legs are tired. You always feel that your legs hurt. This is the moment when you're gonna run the test. It's a common sense. You cannot fake it. So if you go on Zillow and do the exact same exercise, you're going to get the most search query cities. In our case, we have most people look for Miami, New York, and Beverly Hills. So this is obviously the hottest market. Let's keep this question and let's see what actually people are looking for the most. In Miami in particular, the hottest market, and so far has seen the biggest price decrease. Some people actually delist the listings. If you watch my previous video, report from Zillow actually indicated a lot of owners who had their properties listed on the market for over 120 days. They, instead of adjusting the price on the real listing, they decided to delist the listing, send somebody, take new pictures of the listing, and then relist the property with new photos. So in this way, when you go on listing, for example, you ain't gonna see the price history and the fluctuation. So if you go down over here, right, usually you will have a chart with the story of the property price, the historic price move. It went up, it went down. You can actually see what is the market in the area. As you can see over here, the price in this particular example over here, right, we see that the price actually has come down 8.3%. And this is a property for rent, right? We have adjustment of the pricing for the property for rent, and we have adjustment of the pricing of the properties for sale as well. As you can see over here, the property was actually listed for sale and was listed for sale 46% higher, which you see there is no comparable evidence over here on the previous pricing. The public tax records since 2022, if you scroll down, if you go even lower, so the first time when this was actually established was 2007. As you can see over here, the price was $372,000. Scrolling all the way back to 2024, the property tax assessment was $480,000, which is, I would say, not a huge assessment, around $100,000. But as you can see over here, we have a tax assessment that was much lower in the years between 2008, 2009, which was between the financial crisis, which was normal. Even in 11 and 12 and even 13, the property was having a tax assessment under $200,000 all these years, as you can see over here. So this again explains how you see they start adding this 10% annual 10% bump of the assessment of the property. 2020, this is the virus situation. The property has seen 4% decrease of the assessment. People take advantage of it, and then we continue with this 10% bump since 2023, 2024. So very important over here, like I mentioned, the property jumped from sale to rent. And you see what was the prior event? The listing was removed. This is exactly what I was talking to you about, right? A lot of listings are simply removed for a variety of reasons. But according to the most recent report from Zillow, most of these listings are removed from one main reason, which is usually if the property sits on the market for over 120 days, it simply looks bad. It looks like a bad deal. Probably something is wrong with the property, wrong with the actual prices, wrong with the neighborhood. Something is wrong, right? There's no demand at this price. So instead of them adjusting the price and making the price cheaper, either for sale or rent, it's still gonna see that the property has been already still 120 days on the market, and then adds more days even on the lower price. Then when you look at the price that, let's say it was listed for rent for $5,000 a month, and then you have sitting 120 days, no one rents it out, and then the price is actually decreased to, let's say, 4,500. The price is lower, but the days are actually keep mounting. So it might be 150 days and it's 4,500, and people are getting even more scary that this might not be a good deal or something is wrong with the deal, because the price might be going lower and lower, close to the actual market price, which is a good deal. But then people look at the days on the market, they said, oh, this is sketchy, you know, this is too good to be true. It looks very nice. It has sitting so many days on the market. It's impossible for other people to not scoop or take advantage of this deal. This is why the solution, like I said, according to Zillow, is that they simply delisting the listings or delisting the actual photos and properties and create a new listing. This is why when you go down on the listing that we saw, you don't have a data what was the prior information about the property. Why? Because when the listing is deleted and when the new pictures has been taken and you create a new listing without previous history on the record for Zillow, well, they simply can't extract this information and data, because when you upload the new images, the property looks different. Although the address will be the same, still you don't really get to compare the previous pricing. And we can go through the details. We can look at particular neighborhoods. We can look where the price has seen major decrease, right? If you sort over here that are close by you, prices low to high, let's go low to high, or let's say the newest one. Let's see what are the new adjusted prices of the properties, right? Can we see something that looks unusual, right? Because these people who are listing right now, they're already familiar that the market is struggling. They're already familiar that everyone is currently repricing their properties. They're already familiar that a lot of other sellers are delisting their listings, right? So if you see something that really looks too good to be true, something looks that it really do not really add up. I've seen plenty of listings on Miami Beach. Like if you look at Miami Beach, for example, there are plenty of condos that were listed at 200, maybe 190, 220. And now if you look at the actual properties, a lot of these condos are listed for like 150, maybe $160,000. So they see maybe 20, 30, 40% of it actual discounted prices. So if you scroll down here and if you do, let's say up to $200,000, right? Look at what I'm talking about. Look at the areas, right? Look at this 100K, 180K, right? Just zoom in and they will pop up on the side. See 180, one bed, one bath, 140, 170, And all of these, so if you click this, for example, and if you scroll down, currently, you see there is a price cut that happened now in December of $5,000, right? And if we scroll down for more historic pricing, you will see definitely that this has been going places. Are we gonna get this information? Something good. Okay. So the tax assessment much lower. Just look at this. This is okay. Let's assume after the financial crisis of 08-09. Let's look at more recent files. So in just 2012, right, or 13, this was like half the price. The value of the property was half the price. Was $50,000-$60,000, right? So if you scroll down, even when I looked at the base tax assessment was started at around $80,000. So it's not a huge difference. You see that the condo lost 25% of its value. This is in the end of the financial crisis in 2011, which was crazy, right? But the main idea is that a lot of these small condos, one bed, one bath, or studios will be losing much more. They will see even greater price cuts. Even if we scroll down, look at this 175. So if you come over here, let's click on again one bedroom. Are you gonna see a price cut over here? There is no information about price cut. Probably this is something brand new. Just look at this. The estimate from Zillow is 176, which is usually pretty generous, right? Most people are going to lose everything for two main reasons. First of all, they're short-sighted, and second, they're extremely arrogant. In 1980s, people lost half of their retirement and their savings because they didn't understand the knowledge, the price action, the volume, and the interest behind the prices of gold and silver. In 1980s, silver exploded to around $50 per ounce. People were so excited. They were hoping for $100. They were piling in. No one actually did the research or due diligence. What happened was that the crash that followed was shocking. 50% crash, and it happened in just a couple of days. We're talking 3 to 4 days. And people were calmed down. People thought that, okay, this is healthy pullback, the market will recover, everyone needs silver, the same thing that you usually hear, even these days, silver is the precious metals like gold, they're always gonna be a demand or use case. Some people bought the dip, others stayed on the sidelines. In the next couple of years, after this dip, the silver dropped over 90%. This is a number that will shock a lot of people and will hurt even more people, because lack of sufficient knowledge and understanding prevents you from making the right decision, reducing your risk, controlling your position size, not overexposing yourself, because everyone can make a stupid investment decision, but not everyone could put all the eggs in one basket and hopes for the best. In 2011, same thing happened. Big run up again towards the $50 mark. People hoping to break even. People who purchased $50 in 1980s. They waited over 20 years. They were looking at $50 price. They were hoping, they were dreaming one day to sell back at 50 so they can break even. But then the price didn't reach $50. Guess what actually happened? The same crash appeared. The drop was even crazier. Why is that? Well, the same people who manipulated the first run-up, Wall Street of course, were the same people who manipulated the second run-up. The drop in prices made the silver so weak. It created such a slow and thin volume, which chased off a lot of not only long-term investors, it chased off a lot of day traders, swing traders, people who usually create the volume, right? And you probably were thinking, okay, something that happens twice, people will learn. They're not gonna fall into the same trap. But they didn't. Now, in 2026, we had the largest crash sell-off dip in silver on record in a single trading day. We had 40% dip, something that historically happened throughout the period of 3 to 4 days. Now, remember, looking back, every time when there was a sell-off, when there was a pullback in silver, it was not just one pullback. The first pullback was followed by another sell-off, continuations of sell-offs, which in the first case, in 1980s, after the first 50% drop, in the next couple of years, the prices of silver dropped over 90%. You put 100K, you wait 5 years, you have $10,000. How about this? And again, the hopes remain the same. Silver $200, silver surpassed $100, yes, $120, recent all-time high. But the pullback reappeared again. In 1980s, silver hit $50. People were hoping for 400. Silver crashed and then crashed again. In 2011, silver reversed some of the losses. It made its own way towards 50. People were hoping for 50. Silver crashed and then crashed again. In 2026, silver was about $50. Solid trading consolidation, 53, 54, maybe some days, maybe 60. People were hoping for 100. Silver hit 120, but silver crashed 40%. And we're yet to see or experience the second crash that always comes so far, right? If you look at the chart, there's a technical site which usually is created by the machines, by the alternative trading systems, right? Wall Street, majority of the trading is not happening on the actual New York Stock Exchange. Majority of the trading is not happening throughout the actual physical humans executing the orders. They're not placing the orders, they're not analyzing the orders, they're not actually making decisions on the daily basis. What this means? Well, when you remove the analytical side from the human standpoint on the markets, and you understand that the whole trading is happening based on numbers, algorithms, and probabilities, you do understand that people who are emotional, who do not have the sufficient math background or algorithmic trading data that supports the thesis on a daily basis for the prices, the volume, the interests, and of course, the probability scenarios, you lack competitive edge or advantage. And markets are super competitive, and they're not only competitive on the capital side. Most people still think that the people with the most money are the most competitive on the market. But there are many hedge funds and Wall Street firms who close doors. They file for bankruptcy. They had the money though. They were rich, they were having hundreds of millions, even billions of dollars under management. But they still lack the superiority of the trading strategies. They lack knowledge, probability games, they lack very good quantitative trading, they lack technology side of the trading. This is why trading is so competitive, and if you don't have either the knowledge, the skill set, or the actual systems in place, you are the target of Wall Street every single day. You're helping them to buy when they want to buy and to sell when they want to sell. Unfortunately, you cannot help yourself. You can only help yourself by preventing you losing money, which means spending more time working or crafting your own risk strategy that will prevent you from getting your account completely blow off. Let me tell you about the biggest scam in life. When people are poor, all they want is to get rich. When people get rich, all they want is to not look poor. So what they do, they buy all the stuff that makes them look wealthy. Then everything that they want is to protect their wealth. So they hire all the security and they hire bodyguards and they build high fences. They distance themselves from the normal people. At this point, everything that they want is just to have a normal life. It's a full circle, my dear friends. Everything starts from having nothing, being no one, and don't need anything to go back to the exact same spot. Just it takes a whole lot of things to happen to realize it. Just think about it. Why would you need to dream about being rich when you're poor? Months later, just realizing that all you need is to not look poor because you already made the money. Months later, just to realize that everything that you need is to protect yourself. And months later to realize that everything that you actually need and want is to have a normal life. It's absolutely unbelievable how this is true, how this works, and how many years it takes for every single celebrity, famous individual, wealthy individual to realize it. Just think about it. Especially people who, let's say, have a very, very poor upbringing. They did not have money when they were young. A lot of these people peaked in their careers probably mid-age, and there are just a couple of years where these people actually spend money on nice clothes or jewels, and after that everything became normal. Just look at David Beckham. In his early career, everything was fashion, nice clothes, Rolex watches, suits, haircut, hairstyles. Now the guy's like living in like farm. He's like a beekeeper. He has like a small farm with, doesn't care about all this stuff, right? Sure, there's different element of the society where people are groomed and they grew up with nice life, right? They're born in nice mansions, born with private security, they're born with private drivers, private chefs. But I honestly think these people are the least appreciative to all these material possessions. So what does another Ferrari makes difference in your life? Absolutely none. But for normal people like us, everything is the full circle. Everyone wants to be rich. When you're rich, everything that you want is to not look poor because you already made the money. How I'm gonna show the other people I made the money? Stop looking poor. Then when you're already looking rich and you're rich, the next step is how I'm gonna protect myself. Hire the bodyguards, build a high, tall fences. When you start living this life, you realize that that's not what I was expecting. I want to have a normal life right now. This is why people are, firing the security guards. Remember that currently Treasuries has a major pile of gold in Fort Knox, but the reevaluation process of the actual gold, it stays at the levels of $42 an ounce. This was the last revaluation in 1973. There is a process between the Treasuries and the Federal Reserve where they reevaluate the position or the value of the gold. The last pricing or evaluation was at $42. Current prices of the gold is not $42 per ounce. So this means is that if the US government if the President Donald Trump actually want to reevaluate the gold again, which means they're gonna open the books, they're gonna reevaluate the amount of gold times the current prices, and then the Treasury will effectively make a transaction with the Federal Reserve, and the Federal Reserve will give the amount of gold valued at the current prices. Could be $800 billion. This will be free money for the government. And this is only at the current prices. If the prices of the gold per ounce go higher, it will get much easier for the government to capitalize and essentially pay off debt using it. In some way, you had an asset that appreciated, but because it's the government owning the asset, they don't really have to sell the gold to capitalize on the appreciation. It's like, we bought this gold, now this gold worth this much, give us the appreciation in form of a payment, like a dividend type of payment, but we still have the gold and we have the payment. It's absolutely amazing. It's like you're buying a house for 400,000, the house now worth 4 million. You sell the house, you get the 4 million appreciation, but you still keep the house. It's the best deal ever, right? But again, it's a long process, it's not for sure. But remember how Elon Musk and Doge actually went to Fort Knox to see if the gold is actually there. The gold that was on the books, and probably this was one of the first steps to making the step towards this. And this is very interesting because if you really think about it, every time when they did that, they did this 3 times in American history. The gold actually went up, but the dollar lost even more value. And this is good for the economy in some way, because if they're able to clear completely the US debt, right, there will be definitely a short-term storm. This is something that a lot of people are speculating in called reset. But this will clear a lot of the risks associated with government bonds, government debt. Maybe they will kind of restart the interest and the demand for buying bonds, treasuries, etc. Because at this current rates, it is so hard to find buyers when they issue a new batch of treasuries, long-term or short-term, right? Even the bond market has suffered a substantial decline in demand. Also, China dumped a lot of US bonds. So the idea over here is that this is indirectly, if you really think about the practicality, this is some form of a link back to the gold standard in some way. Why? Because you have an asset, which is gold, which appreciates and can always be cashed out by the government holding the asset without selling the asset, right? It's like in some way a money printer which was not producing anything for the last couple of years. The gold has been stuck, at least for the last 5-6 years, no significant appreciation. And this current rally we're seeing for the last year and a half is kind of paying off some future appreciation, and allows probably for plan B, because plan A for paying off the US government was again creating the Bitcoin reserve and pushing the prices of Bitcoin sky high. This is the speculation number 2, where a lot of people are speculating that there is a inherent interest for the US government to push the prices of gold higher, because their reevaluation will give them even more money. So their gold will worth more if the price of the gold per ounce is higher. Like we started the video with, the price of $144,000 per ounce is effectively paying off the US national debt, which is, again, it's not a one-sided thing. There will be a major consequences, not only for the dollar, but you understand that every asset that could be or couldn't be reproduced effectively will change its value, right? Everything that could be printed, everything could be remanufactured, everything that couldn't be manufactured could see even a higher appreciation, like the Bitcoin, right? If you think about it, everything that has a limited circulation supply will have much higher value. Not because people believe so much in it, but there is nothing else to bet on if you see the actual reset. Think about this, right? This is plan A and plan B for paying off the debt. I don't know. It's interesting. So obviously we had a very good day on the market for absolutely everything. No particular correlation why the gold was up, crypto was up, stock market was up. The main catalyst remained the same. There is no current negative bet on the market. This means if the whole market decides to go up or down, everything will go up or down. But I have something very interesting, because my DMs on here on Instagram simply exploded. Let me give you the chart for gold. Let me explain to you what you should watch, because I have a lot of jurors. Very interesting people who are actually dealing with physical gold and silver are more interested of what's coming. Look at this. First of all, very interesting upward trajectory today of the gold. But the problem, as you can see over here, the earliest high of 5,100 was not reached. For our chart, we're looking right here, right now. The highs of today was and it still is at $4,963. What is this telling you? So I put different colors so you'll be able to follow up closely. There are two scenarios. Every time when the new trend is trying to either replicate the previous one or build a new trading channel, you have two options. It's either gonna break to the upside, outperforming the previous one, which as you can see over here, the yellow line, look at the trajectory. The previous highs over here of the yellow one was not reached again. So what this is giving us as a probably hidden signal is that the following move will be down. Do you see where I put the red neckline? So if it goes below the neckline, we're most likely going to see pushing all the way down to the levels of around 4,600. This is around 7% down from the current levels. But this is not over. This could be a good pullback. Why? Because the gold will try another turn to break and go above the previous highs, which as you can see was around 5,100. This is going to be the second try. Usually technical traders will be looking for 2-3 different tries, which means is that if a particular channel is trying to break in or out and on 2 different tries there is no success, the third try most likely will reverse on the downside. Why is that? Because there's something known as double top or double bottom. If you look at over here again on the chart, look at where the blue line that points towards 7.6% down expectation move, right? So this is going to create a inverted W pattern, which is very interesting considering that there might be another additional pullback below this. But this is not the case, because if you look at closely, there is a push. The last 3 candlesticks indicate that there is a push for higher highs, right? Which is unusual. But if this goes below, it will touch and it will create a double bottom. Or for some people looking, because this is 4-hour chart, most of the people will be looking at the big picture 4-hour chart, but they will be trading on smaller time frame. And if we go on smaller time frame, this will look like most likely opening for a new channel, and this will look like not like W pattern, inverted W pattern, because this only appears on 4-hour chart. It will most likely appear as double bottom, which might consider a lot of people that we might see reversal. The problem I see over here is that you see the red neckline. When this falls below the neckline, touches this level of around 4,600 and trying to bounce back up again, if it just touches the neckline and then falls down again, this means that the red neckline will turn the new resistance level, which means is that the lower highs and the lower lows are coming next. And if I zoom out, if we just look closely and try to understand what we might expect judging by the previous price action, we are going to see exactly that scrolling back there was something very similar. So we had this crazy run up over here. This happened in 2024, and I'm going to draw the line for you so you'll be able to understand. So closely, first we were in this channel over here. This channel was consolidation. Then we saw this crazy run up, which created another higher level. Then we had another consolidation for, as you can see over here, from May until September, throughout the whole summer, okay? Then it took a while for the market to decide, are we going to push to another high, right? Then we had another high. But pay very close attention. This was not something that a lot of people expected, because the volumes were kind of low, right? You look at the volumes were not there, which meant that people are falling every single day. Are we going to get better price move, right? Considering that definitely most of these moves were not related to the same price action. So essentially, let me show you very simply what to look at it, okay? I don't want you to become an expert of reading technical analysis, but let's find the differences. First of all, I want to show you the exact same pattern that happened in 2022. As you can see over here, we had a channel which was related to the price action, double bottom followed by lower volume. The lower volume exhausted the buying pressure and released massive selling, which led to complete sell-off, which effectively lasted a couple of months. Try to memorize this particular pattern, this particular channel, and this amount of volume. Now let me show you the current. This is the most current updated momentum situation with gold. Does this look familiar to you? Because it is. We have same time frame, which is 4 hours. We have double bottom. We have volume that after the blow of top, after the 5,600 sell-off happened, the volume is down. And the lower the volume it gets, we already know what happened in 2022. We already knew the price action when the volume decreases, and we already know what is the trading channel. This is why I put the trading channel and try to make it as simple as possible. It is much clearer, not so many indicators, so you're not gonna get confused. Because like I said, I have a lot of people who are dealing with physical gold, and the price of physical gold are less volatile than the actual paper. And these people are really, really interested what is the price or what the price going to be, because it changes their price. They have to change prices of the jewelry every single day. They have to price the labor, etc. Right? So this is what I want you to focus. Look at the volume. Look at the volume underneath. The volume will tell you exactly what is the sentiment. If you see the volume decreases, or if you see the volume increases with major red candles. If you look at over here, we had major spike in volume before the sell-off and during the sell-off. We have a large red candles, and this happening in real time. I believe the latency from the actual central markets is around 15, 20, 25, 40 seconds, depending on your location. But you will be able in real time to justify what could be happening with the price action. Because like I said, currently we're seeing that there is a, I would say, failure to hit the previous highs. I'm not even talking about breaking the previous highs, which in my opinion is showing weakness over here of the market. Why this weakness appear? Well, this weakness appear because obviously there is much more negative catalysts coming around the corner. And it's not only for the gold, and as we already agreed that there is no longer negative beta, meaning there is no longer hedge intrinsic value for any of the market assets, because everything crashes and everything goes up and reverses at the same time. The whole thesis for buying or holding the gold just to protect yourself from a market going bust, it's no longer the case. So this is what you want to pay very close attention. You want to look at the volume, and you want to look at how the overall picture of 4-hour chart replicates the previous price action which I showed you. It would be very nice if you can put them on 2 monitors or split screen. Maybe you will be able to see how similar everything is, because I bet you that most people or most institutional investors who traded in 2022 run up and crash are still in the game. They're still participating in this price action that we're seeing right now. So they're playing the same game. And why wouldn't they play the same game when you already know how it works and you know how to win, because you have edge over anybody else? So this is what I see over here. I see that if it doesn't break above 5,100, it will fall below. It will go lower, 4,800. It might even hit the 4,500, which was the neckline I mentioned earlier. And then I'm going to give you another update, because it will get very interesting if it breaks under 4,500. Then we're talking about completely different levels. We might be looking at 4,400, 4,200. But stay tuned for that.
You're just one mistake, one minute mistake away from sleeping under a bridge.
The quiet way how many people are actually losing their buying power and effectively experiencing this inflationary pricing wherever they go only happens when they try to pay for something, right? The same thing, you don't understand how little you earn until you actually see your paycheck. You see all the deductions, you see all the taxes, right? The quiet way people going broke. And again, it has been happening. This is not a new thing. The thing is that now the escalation or the majority of the issues for people are becoming the money issue, right? Before it has always been like money issue plus something else, like money issue plus something else. Now it's money issue plus money issue. And as you can see, a lot of these people are experiencing almost the same problems. It always comes down from the economic standpoint, where the economy doesn't really reward the people who are working the hardest, or the people who have consistently worked at the same place, putting the same effort, showing up every single day. The idea here is that the economy currently is rewarding innovation, not stagnation.
Can someone please tell me that things are going to get better for the economy, for the world? Just someone please tell me that things are going to get better, bro, because I work from 8 a.m. to 10 p.m., 2 jobs, and I'm just sitting on my lunch on my second job, and I just can't do this shit anymore. I told myself I would never work a second job again earlier this year, but bills are bills. You got to do what you got to do, but bro, I can't keep doing this shit. I'm tired, like everyone else.
I spent about an hour talking to my grandmother last night. She's 90 years old, and she's actually considering selling her home and her property because that's the country we live in right now. She's 90 years old, and she has to sell everything that she's ever earned. That's the country we live in right now. My grandfather was retired from the military. She has her Social Security. They both worked their whole lives, and she can't afford to live anymore. 90 years old. Put money away, did all the things, and now she has to be put in a position where she has to sell her home.
Even if the prices go lower, the wages will not go up. Even if people are rehired, the people who are fired, or at least part of them, they're still going to struggle because the prices will not go lower and the wages will not go up. Every single year, when the prices multiple times per year on certain items go up, your salary doesn't go up, doesn't catch up with the pace of the prices. And this gap has always been the rule. But the prices haven't skyrocketed this high, plus the devaluation or the buying power of your money hasn't gone down that drastically, that substantially as we've seen for the last couple of years. Considering that almost a quarter of all the money in circulation in US dollars have been printed throughout the virus situation, through the distribution of stimulus checks or any of the relief programs.
Out there is wondering how Americans are doing poorly. We are doing poorly. Yesterday, I woke up to an email from my landlord saying, hey, I'm raising your rent. Why? No reason. We already pay all of the utilities ourselves. That is not included in the rent. So we pay for electricity, and we pay for water, and we pay for natural gas to heat our home. And that bill in particular has skyrocketed this year. Every single month this winter, it was over $600. And we do not turn the heat on. We just turn it so that we can survive. We do not turn it above like 60. So we're freezing in the house all winter. Oh, and also I woke up this morning to an email from my health insurance being like, thanks for your payment. It was deducted automatically, except this time the payment was $400 more than it was last month. Sorry? What's going on? So I called the health insurance company and I was like, why did this happen? And they said, oh, well, the tax premium expired. And I said, tell me why that happened. Is that because of federal budget cuts? Is that because of the New York State budget? Where did that come from? And they said, we don't know. You have to call the New York State Department of Health.
I am so sick of how expensive it is to just live. Before I left work, I had to make sure I bought tickets to my kids' musical for school. And I'm going both nights, and then my parents and my husband's parents are going one night, and then we're going as a family one night. So I just paid for those tickets. For all those tickets all together, it was like $62 or something like that, 62. And then I left work, I got my kids to school, I had to get gas. I was on E. My gas light was on. I had busy like for the rest of the evening after I wake up after sleeping. So I was like, let me just do it. It just cost $78 to fill my tank. I do have a like a mid-size SUV. I have a Chevy Traverse. But literally before this day has even started, I have now spent $140. How the freak do you sustain life anymore? I don't know. It's so frustrating how expensive everything is. It's like every time you turn around, there's like something else to pay for. And I know that's being an adult and I know that's life, but it's so frustrating.
So you need to understand that when the velocity of money supply outnumbers the actual products, goods, and services produced from the consumers, well, then there is a natural latency in which inflation will catch up with and essentially fill up the gap. There's no space left behind. And like I mentioned, even if now a lot of businesses are showing up, they extend the working hours. They want to, try to recoup the missed revenue by simply not having enough clients. People don't have enough spending power. They still cannot catch up with the previous pace. You see businesses compare month to month. The sales are down. They're not comparing quarter to quarter. They're not comparing year to date. Because the further back in time you go, the bigger the difference of your revenue or earnings actually comes to the end, right? You realize that you was making personally, or your business was making much more money, much easier throughout the virus situation years, right? And the main concept that you will see is that all these people, they want to work. They're not lazy. They want to work. They want to, be given a chance at least to, use their skills, use their time in exchange for money. But the problem is that the market currently prioritize technological advancements, prioritize AI to get the job done. And this is, no one knows for how long it is going to be. It might end up being forever. It might end up being the new standard. But these people, unfortunately, they have to figure it out the way to actually exchange their current skills and knowledge base with the skills and knowledge base about AI, either working alongside of the AI, improving the AI, or maybe starting their own business. We have seen plenty of stories, people without any prior technological background being able to utilize AI for either improving their own personal or professional lives. So I truly believe that these people will catch up with.
So there's a nationwide shortage of technicians, automotive technicians, no matter what brand it is. People just don't want to do this anymore. And I'm going to show you right now why there's a nationwide shortage of automotive technicians, especially at the dealership level. Let me show you exactly why. So this right here is the labor time for removing an HVAC assembly, the heater box inside the vehicle. We have an evaporator leak and the AC doesn't work. And this is the labor time from, I believe, All Data. Pays 13.5 hours. See that? 13.5 hours labor to remove the HVAC assembly. And then this is the warranty labor time from Nissan. 4.8. They want me to do that HVAC assembly for 4.8 hours when All Data is saying that it takes like 3 times as much as the warranty time, 13.5. So many of you may not know how technicians get paid. We get paid by the job. If a job pays 2 hours, then we'll get 2 hours no matter how long it takes us to complete that job. Our hourly rate may be $40 an hour. We may get paid $40 an hour, $50 an hour, and we'll only get 2 hours worth of that time to do that job. If it takes us 3 hours, then we'll still get 2 hours for that. So this is exactly the reason why nobody wants to do this anymore.
Well, this is probably one of the examples where the real suffering for doing the work of the people who were doing the actual technician work actually comes into a full circle. They don't really enjoy doing the work anymore. They don't really getting paid enough to do the job anymore. And it is kind of a perfect storm for the AI, perfect storm for the EV vehicles, because as we all know, the maintenance of the vehicles is much lower and the EV vehicles require much less parts, considerably less parts. So understanding that no one wants to do this job is just one of the examples where people kind of calculate, is my time worth more keep doing the job or doing something else? Do I really enjoy, or do I really feel appreciative, right, by doing the service? Because you understand, this is not an easy job. You should really know the cars, you should know the parts. Some of the vehicles have parts that are very hard to find, which means you as an expert, you should source the materials, you should source the replacement. In some cases, they should order, specific part to be made.
This is why Ford can't get anybody to work on their cars. Now, last week, the Ford CEO came out and said he had no technicians to fix all of his broken cars, and that's why it takes a minimum of 2 weeks to get your car looked at a Ford dealership. Now, I already knew this was true because every time I call my local Ford dealer, they tell me they don't even have a transmission tech. And they gotta send every transmission job an hour out of town to the next nearest dealership that has a tech that can do that work. Now, the Ford CEO states that there's over 6,000 bays in Ford dealerships without technicians, and they can't find anybody to fill those roles. And his attitude toward the whole situation is that people should be wanting to fill these roles and wanting to do these jobs, and he just couldn't understand why he can't fill them.
There are famous YouTubers here on YouTube who are buying cars, like luxury cars, and they try to fix the car, but the headlight is $2,000, and you cannot find the $2,000 even if you're willing to spend. So they have to 3D print the headlights, they have to 3D print the parts, but you still have to have a very deep knowledge of how this particular part works in the connection with the overall system of the vehicle. So like I said, these people are experts. They're like doctors for the cars, right? And when you see these people who are doing diagnostics, right? When you see these people who have a very niche and very obvious, knowledge that is in demand. Everyone almost has a car. Everyone almost every day drives. So their knowledge will be in demand.
There's a shortage of technicians. They have 6,000 empty bays. And he understands why now. So here's your answer, dude. This is why.
This is why. Your answer is because you charge an insane door rate. Technicians don't take home even a third of that usually. And you make junk vehicles. And your labor times suck. They're usually less than half of what it takes to do your job.
Yeah. So take into consideration that we have to buy our own freaking tools. That's one. Two, your warranty times are shit. If an engine replacement pays 25 hours under customer pay, and then we go do it under warranty, it's freaking 10 hours. So you're screwing us up. You're supposedly helping out the customer at the cost of the technician's paycheck. So yes, that's the freaking reason why, not because your other stupid reasons that you mentioned.
Right. That, and on top of overcomplicating simple things that you've had for years that have worked well, you constantly reinvent the wheel, model to model, year to year, making repairs more lengthy and difficult for technicians. That's why everybody's leaving the industry. Pretty simple.
If you guys fix your reasons why there's a shortage of technicians, there wouldn't be a shortage. So this has nothing to do with colors, white or blue. If the pay was fair and everything else that comes with it was fair, then there wouldn't be a shortage on any freaking industry.
The end.
Adios, mofos.
So what's going on? Today I'm going to talk about Toyota, and yeah, there's probably a quality issue there, but there's really a technician issue there. There always has been. The last few years I've probably seen it at the worst it's ever been, and it's just going to keep getting worse, which is possibly better for technicians in the long run, but I really don't think so. So what's happening? So in my neck of the world, Canada, Toyota at the moment has such a backlog on training that they don't have their certified Toyota master techs. And what's happening is, not only is there really no new apprentices coming into the industry, there's a brain drain right now. So as it stands, Toyota is so far behind on training that they're all starting off at the bottom. So let's put it into levels 1 to 4. Everybody's at level 1. They have a backlog of 4 years of training, which tells me that there's nobody new coming into the industry, but also tells me that there's not enough master certified techs, and this is how I come to that conclusion. So in my local area, the dealership has lost almost all their master Toyota techs. They got maybe 2 guys left, And that's a brain drain. They probably lost a good 40 years of experience in a matter of a year. That's huge. You cannot replace those numbers in training, and it takes years. It takes years to make a master Toyota tech. It is what it is. So what's going on? So the one guy I work with, I'll tell you what he made to the industry, and Toyota and the dealership owners screw over technicians. So put this scenario in there. The one guy he was pretty much a master tech, left because the Toyota engine recall on the Tundras. The hours were great, and then they continually dropped how much he's making to the point where here in Canada, Ontario, he said they were making 16 hours on this warranty job. At first it was higher, and then they just keep lowering it.
The question is, would AI be able to replace or fix some of the vehicles, or interchangeably, do or get the job done? We all know in the beginning of production of Tesla Model 3, there was a major issue with the efficiency of the production because Elon Musk said that 80% of the production was done by robots. Then he removed majority of the robots. He left around 25 to 30% through the production process, field work by robots, and the remaining part was actually completed by humans, which removed the bottleneck and improved the efficiency and the production levels. So my real honest question here is, would this be a bottleneck for the production? Would this be a catalyst for the EV market to get a complete adoption? Looking here in New York City, I would say maybe 60-70% of all the cabs, Uber, and other taxi-like companies are using Tesla, right? We're seeing more and more delivering vehicles from Amazon being EV, right? Some people already claim that USPS has used some EVs as well. So obviously the EVs are, taking bigger and bigger portion of the auto market, being on the personal or commercial side. The question again remains, what these people will be doing if they're not mechanics anymore, and would the AI or somebody else be able to replace these jobs? Because like I said, this is in demand. The cars will be around forever, and there will be more and more vehicles that are on the older age side, which means more replacement, which means harder to find parts for them, which means these people, their expertise will be sick, in my opinion. If you don't believe me, just go on the government website for auctioning out a lot of the old vehicles that government use for police cars, some of the security vehicles, some of the army vehicles that are selling. You will see that even the government doesn't want to fix the old vehicles. They're just going to buy a brand new fleet of them. And you can go ahead and take a look what specific models are always part of the auctions, right? What specific models are usually, have more issues in the description. So you will get an idea which models are more faulty than others, right? So it is really, really interesting to see how the development will proceed with these people. I'm more interested to see how these people will make ends meet than interested what is going to happen with the actual technology and the service providing side of the game. Number one reason why people struggle to build wealth is that they don't understand the time value, which is part of the financial engineering theory. But the time value is the basis. So the time value of money is important because essentially means that $1 today will be worth more if you invest the $1 today, have the $1 today, versus having the $1 tomorrow. For two simple reasons. First of all, if you have the dollar today, you can take a position, make a decision, and invest the dollar. The dollar can start compounding, start appreciate, and essentially start benefiting from the appreciation of the asset that was allocated towards. The second point why $1 today worth more than $1 tomorrow, if it has been given to you, is the inflation. Every single day, the dollar in form of a cash is essentially losing value. It's losing buying power. So effectively, if you want to purchase these sunglasses, right, you like this pair of sunglasses, you kind of wait for discount or for promotion or for certain sale. let's say the retail price of these sunglasses this year in 2026 is, let's say, $250. And you wait for promotion and you don't see the promotion, or when the promotion actually is running, you don't have money to buy them. You wait and it's next year, it's 2027. The retail price of these sunglasses could be $300. Okay, so the retail price is essentially going up, and even if you get some deal, some discount, you still gonna be paying more if you purchase the glasses back in 2026. What effectively actually happened, I can give you also another example. I bought this watch during the summer. That's Omega Swatch 1965, just a random purchase, and I haven't looked at it. Last week I was planning to sell the watch because I don't really use it, and I look at on the site of Swatch, the price is already up. It's like $50. So the inflation, this is a real example, has played out. This is not a limited edition watch, right? You cannot buy it online, right? You have to sneak and wait on the lines in the stores, in the retail locations. Still, it's not a limited edition. So if the watch value appreciate without the watch being effectively more valuable from the summer I purchased it, this is your example of how the time value of the money is very, very important. So because I purchased this watch during the summer, instead of having the $300, I bought the watch. So if I waited now with the $300, my $300 could be worth $280, $285. This is what this $300 could buy right now, because the prices are even higher than the summer. If you go and try to buy the grocery and you fill up your basket or your cart with the same groceries, I bet you will not be able to fill the same amount or same type of groceries. But because I put the $300 into something, right, this something now at least will give me back the $300, simply because people cannot buy it from the store and they cannot buy it on the retail price I bought during the summer. It's a very simple, I believe anyone can understand and comprehend this very simple example. Another example I gave you with the glasses, same thing, right? Procrastination plus time value equals usually bad deals. You would hear from time to time people say, the person who is more patient, who can wait longer, gets the best deal. This is not usually the case. People who waited, imagine you were born in 2005, 6, 7, during the big blowout on the real estate market, right? You were thinking, okay, I'm gonna keep waiting to get the best deal. You know, when the banks take possession of the properties who have been returned from the owners, right? And you will be expecting to make a short sale, buying the property directly from the bank. Never happened. People who were waiting for the best deals, they never get into. People who were waiting for the Bitcoin, when the Bitcoin dropped from 12,000 down to 5K, they never get an opportunity to buy it back at this price, right? So sometimes things are overdone, but usually they're not. This is why learning about time value is very important, especially in times where the inflation, it simply has no dips. Inflation is either consolidating at a very high rates, even now, regardless of the reports of the CPI, regardless of the real inflation, regardless of the reports about the core inflation. Everyone agrees that inflation is much higher than the reported number, which means that the amount of money that have been printed, which is substantially larger than combined goods and services provided versus the money in circulation, means that inflation has peaked so high and has consolidated so high that it can't really fall that low where it was before, because the economy has grown and outgrown the previous economy. And when I say economy, you can simply speak the money in circulation, the GDP. You can speak in terms of money that are coming from the tariffs, right? The revenue that the government collects from tariffs. And the economy has outgrown a lot of the previous numbers. But remember, the money printer and all the money in circulation that was added didn't actually have equivalent in goods and services. So you got more money, but you have the same amount or a lower amount of goods and services, which essentially meant that people have more money, there's nothing to buy. This is also something what happened during the the virus situation, a lot of people got stimulus checks, but there's nothing to buy. Everything is out of stock. So this is why understand time value, apply time value to your own personal financial planning, and understand when is the right time to do the move, when is the right time to wait, when is the right time to be active, when is the right time to sit in cash, and when is the right time essentially to reduce the amount of cash in your pocket. Because like I said, if I had the $300 right now, I have already lost 15-25% probably of buying power. But because I have the watch, or I have something else, I have the glasses. This is why sometimes when you get a deal on something that people usually buy, right? Let's say you find an amazing deal on water bottles, right? You get like very nice branded water bottles, maybe 24, 36 pack, and you buy them all, everything that you can buy. Why? Because first of all, you can always say what people always gonna buy water, and the second of all is worst case scenario, you're still gonna get used of them instead of you buying the water for yourself, paying full price later on when there is no sale. I was watching Mark Cuban. He said that every time when he goes to shop to do groceries, whatever is on sharp discount, everything that is over 50% off, he said he buys as much as he can buy, and he store everything. And they asked him, but why? You're so rich. He said that's effective savings. If you can buy something in the very moment that you would usually buy throughout the year, and it's 50% off, you effectively save 50%. Why wouldn't you buy it? This is again a billionaire's mindset. It's not we try to be cheap, we try to be stingy, we try to play the game. No, it's the numbers. In the end of the day, if you save $5, you essentially have $5 more in your pocket. Pay very close attention. The people who invested in silver early on during the previous hype cycle waited 13 years just to break even last month. This is your big cautionary tale over here, because a lot of the people who currently talk about precious metals investing, hedging against the debalancing of the US dollar have no real perspective on the historic run-ups in the precious metals. Remember, these things are not getting more valuable. No one is actually looking to buy more, to hold more, to produce more jewelry, or produce more electric batteries with more silver, etc. Right? The idea over here, which is the same concept that aligns with palladium, same concept aligns with gold, is that everyone is kind of scared of the inflation, which of course it is a big money eater, wealth eater. But read this with me, and I want you to think about it, okay? You can even pause the video and read and comprehend, and even probably take some notes. Silver prices peaked at $50 in April 2011. So the idea over here is that the current peak that we saw right before the dip last week, which erased gains for at least 2 weeks prior, is something that always happens. That's not a one-time phenomenon. The same people, which are institutional investors of course, who are pumping, are the same one who will correct the price in the very moment when they feel that economic policy or development is more predictable. If it isn't, they don't know what's going to happen. They don't know what new tariffs will be coming in 2026. They don't know what the Federal Reserve will say, what the new Fed chair will say, or what they will do, right? So certainty and uncertainty depends on the pricing of these precious metals. And if you look at over here, people who bought during this hype essentially lost in a period of a week because the silver dropped sharply. People lost so much value of their portfolio and their invested capital that they didn't want to sell, right? If in a span of a week you lose 50, 60, 40, 30%, if you're a crypto investor, you already know how the game works. But I presume that a lot of people who are talking about precious metals are not crypto guys. Why? Because the volatility is not there. People who usually invest in crypto are seeking volatility. They're actually kind of tempted to invest when there is a huge catalyst coming. Even though this usually is like buy the rumor, sell the news on the crypto market, and usually it happens. Remember, so much price action before the Bitcoin ETF approval, and on the actual Bitcoin ETF approval, no price action. We actually had probably 2-3 weeks in a row red days, which again proves the point that this is much more stronger than the usual stock market hype. So I don't believe that people who are deeply invested in crypto are actually the people hopping on the commodities market, right? The idea over here is that there's, as usual, opportunities to scalp, probably, but if you're wrong, if you really don't have stop losses, right? If you really hold, buy and hold, and wait for something crazy to happen, well, you see what happened. People waited 13 years to just to break even. We're not talking about buying. These people bought, went down, and then they wait 13 years to make money. No, these people just waited to have the same money that they had 13 years ago, right? If you put $10,000 in 13 years ago, right, you have to wait 13 years ago, last month, 2025, just to break even on your $10,000 in your portfolio. So this is again very real example what could happen on the market if you don't know what you're doing. And I believe a lot of people who talk very superiorly online about the silver, about the gold, they will be surprised. The question is, are they going to be pleasantly or unpleasantly surprised? Why? I just read the news that the President Trump will not activate and delay the new tariffs that he was proposed to implement in the beginning, in the first days of 2026. What this means? Well, President Trump most likely will do a lot more to make the economy stronger, especially the first report for the GDP, which will again increase even more the odds for rally on the market when the new Federal Reserve comes into play, because the president will select the Fed chair, will tell him exactly what he's supposed to do. He's going to start cutting the rates even more, right? Then things will become much more predictable and certain. When you know who controls the Fed, when you know what kind of economic policy the person wants that controls the Fed, then everything kind of gets predictable. And what I told you earlier, when the market becomes predictable, all of these hedges, crypto, silver, palladium, all the precious metals, will lose the hype. Why? Because there is a gigantic opportunity cost being invested in these sleeping parking places, parking assets, capital, instead of you trying to capitalize on the biggest IPOs this year: Anthropic, OpenAI, SpaceX. And this is just the beginning of the hype, right? So pay very close attention. Don't try to hear what you want to hear and disregard the real cautionary tale, which is effectively part of the history. This is not something that you could speculate. This is something that already happened, and you have the numbers, and you have the dates, and you have exactly what actually happened, the mistakes of the people. So be very, very careful, because like I said, let's say you have $10,000 to invest. You save the and you hop on this rally, and what? You gonna stay on your stop losses for weeks until you hope some of this to recover? No. Not to mention, I don't really believe that a lot of the people who are hyping up or trying to, probably swing trade some of these are using stop losses, which exposing them to even greater losses. Which again, be always very, very careful. I don't care who said what, right? I may like Ray Dalio. I might completely follow his trading or investing strategy early on, but the recent things that he sees on the market, I don't completely agree with him, and that's okay, right? Because I have my own thesis on the markets. So like I said, the same thing for the crypto. Many successful market investors didn't see the crypto being a thing. Remember, we had Jamie Dimon, didn't believe in crypto, didn't believe in Bitcoin, and now Chase is like very involved in the crypto market. They're very involved in blockchain technology, implementation on its own internal systems. So this is the fair value of the gold. Everything above this particular line indicates bubble, and when the bubble bursts, a lot of people will be left holding the bag, trying to calculate or capitulate or write off their losses. Pay very close attention. Very few people understand this. What you see over here is the monthly chart of gold. This allows us to see the actual perfection of the price move, sentiment, and market cycles. Compare the price move from the gold to the overall market, to the crypto market, so you understand how they are moving in or off alignment. Very importantly, the current fair value of the gold without the bubble current evaluation sits at around $2,000. So everything at $2,000, it's a fair value. It provides higher security, right? Meaning everything above it, obviously, it's a bubble. When you look at the chart, you will understand that the gold has been hitting this fair value gap for many years, and there was no particular reason for artificial inflation of the price. When did the price broke the $2,000 per gold? Well, it happens during the Russia-Ukraine war, and this is the only reason where while we have this bubble actually inflated, because people starting from Russia started buying gold for the one reason and one reason only. After the US government imposed sanctions to Russia for starting the war with Ukraine, other countries realized that, if you invest your government funds into US treasuries, your assets could be frozen and you essentially have no access to this capital. You cannot use it. So it's unusable. Same thing happens now with the crypto market. A lot of wallets are actually frozen with particular holdings of coins. So regardless, you might be a millionaire on your crypto wallet, but if you cannot sell, well, you're out of luck. This was the moment when the new bubble was created and the new bubble was inflated. So Russia purchased a lot of gold and starts stacking up a lot of gold for their own purpose and need. They didn't really wanted to pump the price of the gold, because think about it. If you need to buy more gold, you want to buy it cheap. You want to buy it quietly. You don't want to push the prices higher. And this is why a lot of people misunderstood the concept over here. Countries were buying it not because they find it more valuable, but they find it as a safe haven where they can actually store the local currency and hold the local currency's value, because other countries' currencies are not as strong or stable as dollar. A lot of people trying to mock up the dollar that is losing value due to the money printer or inflation. But remember, other countries are fighting with devaluation. Their local currency is worthless in general, with or without printing money. So the other countries have to fight not only restriction, potential sanctions, freeze of their assets, but they also have to fight local weak economies and local currency devaluation. This is why I pull up a chart that very few people understand. That they can actually go so much back in the past and look at where is the fair value. And on trading terms, you always can find a fair value, a particular asset, just using the RSI index, where you have overbought, oversold, and you have in the middle, which is fair value, which finds a perfect balance of all market participants who are bullish and bearish. They place, based on market sentiment, the fair price of the asset, where the asset, should usually trade, no above, no below. This is what we're seeing over here with the gold. And if you look at, there have been many different positive catalysts for the gold, right? That are specifically related to the gold and gold industry and precious metals. This is why we saw this top of around $2,000 was hit 3 times, in fact 4 times. We had 4 different tops of $2,000. And this is a simple indication that people were interested. The first top we had at 2011. So at 2011 it hit 2000, then it pulled all the way down the levels of 1300. So from 2000 to 1300. Why? Because people took profits. There was no particular reason for you to hold gold for the long run. It was a quick swing trade. Then we had all the way up to the virus situation into 2018, 2019. Again, there was artificial sentiment push because the market was crashing during COVID. the economies were closing, and again, people panic, and when people don't know what to do, they buy gold or silver. This was the second time when the gold pushed to 2000, and people were so hyped. I remember this very well. But because, like I said, people who were buying it, they were speculators. They were not people who were actually into this market. So then, if you look at over here in 2021, they sold most of it. So everything that pushed up the gold prices actually was dumped again on the market for the same reason, speculators. Because then the Bitcoin pumped, we had 63,000 new all-times high, and then the markets kind of dumped. Remember 2022, everything again dumped. Was one of the worst crypto bear markets, and then look at what happened in 2022. We had again gold pushes back up to the same levels of 2000. So this was the triple top pattern. A lot of people then were kind of wondering, okay, 3 times the gold hits 2000, cannot break above, something is happening. Again, why is that? Because the same people who previously go in and out for the same reason of either the market is crashing, something bad is happening, or I don't really know what to do, I'm just gonna stay safe, I'm gonna park the money into the gold and silver. There were no new money coming in. The countries were chilling. Russia was not buying, China was not buying, everyone was just chilling. But then look at what happened on the 4th try. Again, when was that? Elections, right? The elections reappear in, this is in 2020, I think it's 2024. The Russia-Ukraine war appeared, right? This is the end of the mandate of Joe Biden, and Russia actually invaded Ukraine, and the market kind of crashed. Not so much, but a lot of people were not, pretty sure what they're gonna do next. Crypto didn't react in any way. First of all, there were speculations that they're gonna the Russia and Ukraine, they're gonna be using crypto for transactions to receive donations, to raise money for the war itself. But then people actually pointed out something very interesting, is that they actually start stacking up gold, and then China follow suit. They also start stacking up gold, and then we saw little by little countries around the world, big countries with local economic issues, BRICS countries, they start also stacking up gold. This is the moment when you saw this crazy push bubble, and I'm calling it a bubble because this is institutions and countries buying the gold, which means is that if you as an individual, buying at these levels, hoping to make quick profit, yes, it's possible. But think about if these countries simply decide not to own it. So all this crazy run up could go that easy, that big on the downward trajectory, because all this gold price comes from the gold purchases, right? And this we're talking about the actual sentiment, because a lot of the countries were purchasing the physical gold, which sure, it helps the actual spot prices, but this is not really what drives the prices, because the sentiment changes very fast. They cannot dump 3 tons of gold on the open market, or simply liquidate it. But the main idea here is that the sentiment changes faster than the price. It's not price changes and then sentiment changes. The price follows the sentiment, and sentiment changes very fast. So this is why you need to understand that everything above this level presents a substantial risk. This most likely will play out in a negative way. The question is when, and the question is, will institutional investors be able to kind of avert this particular crash? Because sure, they might be buying the dip, but which dip you're buying when gold falls from 5,000 down to 2,000, right? That's the biggest question over here. The way how Apple made their first dollar in sales and the way how they earned their first $1 million in sales was the same exact way. I hope this rings the bell, right? This gives you an idea that if you cannot make your first dollar in your business, could be a startup, could be a service business, could be something physical, it's a simple indication that you lack sales skills. There's only 2 things that could be wrong when you start a company and things are not going smoothly. First of all, of course, the product or service sucks, it's not something that people need or doesn't really solve the problem better than everything else that exists. Or second, you lack sales skills, right? That's what I said. If you can't make a single dollar from your product, if you can't convince people to give you $1 for whatever you're exchanging for the $1, well, you cannot make $1 million. And this is how simple it is. This is why I brought you the example of how Apple made their first dollar sale. They use the same sales channel, sales funnels to make $1 million. The first $1 million and the first $1 were earned through the same exact sales channel. It was not some crazy marketing advertisement campaign. It was not crazy tech. It was not hiring BCG, Boston Consulting Group, or any of this advisory McKinsey to help them to build sales funnels and strategy. No, the same way how you earn your first dollar, it's a repeatable process to $1 million. The only thing that changes is the scale. You're no longer selling your product or service to Peter, Jim, and Tom. You're selling it to the corporation A, B, and C. The volume and the sales skills is what gets you from point A to point B, and you cannot skip a single step. Just think about it. If you cannot get a single dollar, how you can actually make $1 million? How your business could sell a product or service equivalent to $1 million when you cannot move a needle to get at least $1 worth of revenue? You cannot. This is why negotiations, this is why sales skills, this is why you will see companies having the top engineers building some of these new tech startups. You have experts in marketing. But when the sales are not moving, they're willing to give out equity to the salesperson. Someone shows up, becomes co-founder immediately, top sales AP, right? Shows up everywhere, know how to present the product, know how to get clients, right? You give them budget, you give them everything. Sales skills, I would argue that today are the most important skill. It's no longer coding or engineering. It's no longer product or design. It's no longer being strategist or project manager. No. The only person who matters is the person who actually can get sales, who can get your product or service in the hands of the users and can get the money of the users in your hands. This is the person that you need. Because you will find every single day. I was watching a statistic yesterday from Bloomberg. In December, there were submitted 70,000 new apps in December alone, last month. And I was also looking that less than 0.5% of these 70,000 apps are earned around at or above $100. Do you understand the difference? This is telling you, and I hope you understand and rings the bell, that anyone can build any app, website, service. Anyone can start any business, offline and online. Anyone can use the AI tools at least to be able to build something that is working. Anyone can do verification, build and attach Stripe accounts. Anyone can use AI avatar to create art and commercial, but no one can get sales. No one, regardless. Even OpenAI, even big companies, Anthropic, Claude, they cannot sell their product. That's why they pay influencers to plug their product into the videos, right? If the product was so good, back in the days, people were saying, why you don't see commercials for Porsche? Why you don't see commercials for Lamborghini or for Mercedes, right? Because people said the product is so good, it doesn't need to be advertised. People know about it, people want it. Well, it's no longer the case because there is a huge saturation everywhere, especially in technology where the barrier to entry is non-existing. Like I said, people quitting their accounting job and building like a small payment processing app for like a tips or something, and they're uploading it on Apple Store and they're charging people. They try to charge people, of course. Like I said, building is one thing, selling is a completely different thing. So if you're planning to build an app, if you're planning to start a business, if you're planning to create a startup, sure, you need an engineer, regardless of what you know about building AI. Because I built plenty of apps, I built also extensions, and I'm not an engineer, and I had pretty hard time figuring out learning. It's a very steep learning curve. So first of all, you need an engineer, someone in-house, co-founder, who can actually inspect all the code, fix all the bugs and mistakes, and make sure everything works smoothly. And of course, you need somebody who is able to sell. It will be absolutely amazing if you're the sales guy, if you already had experience selling, because the sales skills are very obvious. No one can question the work of the salesperson in the startup as a co-founder. When the guy shows up and shows the receipts and shows clients of $100,000 of revenue this month alone, well, no one can question the skills and the contribution of the startup, right? This is why you need these key figures. You need a salesperson, you need an engineer, and definitely if you have a marketing guy, it will be good, right? Because marketing is very important. Marketing takes a lot of time and takes curation. So the person who is in charge of marketing should be online all the time, should be aware of what is trending, what is working, what isn't working, and what new tools other marketers are using. Because the plethora of different AI avatar apps, but because you have a marketing expert in your team, co-founder, he knows that this one works and this one doesn't. He knows that this one gives you more credits and this one doesn't. He knows that this one actually have glitches and it cannot produce text and there's always misspells in text, while this one actually gives you crisp, clean, and accurate description inside the actual video, right? So this is why it is very hard to start a business alone. It is very hard to be in charge of everything, of building, promoting, of inspecting, of negotiating with the influencers, with creating budgets, right? Creating marketing campaign. It's very hard when you're the one who has to do all the job, and you're the one who has to inspect your own job, right? And you're the one who has to make sure that everything is afloat and everything works. You have to keep checking the systems, is everything operating accordingly. And it's also double the competition and the hardness and the challenges when you're not a coder. This is not your by training. You're not a marketing expert because you just learn from internet, right? And on top of that, the worst scenario is that if you're not a salesperson. Because I said many people are very good in sales. They sell like garbage products or service, but they make money. And people wonder, but why people spend so much money for this nonsense product? Like, just look at the brand selling like a fake leather jackets for like $2,000, and people say it's a faux leather. Normal person will pay $2,000 for a faux leather jacket? Because they're extremely good in sales. They're extremely good in building the brand. They're extremely well of crafting the hype and holding you accountable of buying it, so you want to be on top of the hype. You're not going to be left behind. Okay, that's what I was trying to explain. You don't have to be the smartest, you don't have to be the fastest, and definitely you don't have to be the person who can do multi different tasks at the same time. You only have to be aware what is most important in the startup, what you could do the best, and who can do the rest. This is it.
Why is everything so expensive? Why am I making more money waitressing than I would make using my college degree? I barely have a life. I have 2 days off and I work Wednesday to Sunday, doubling just to pay my bills. At 22 years old, all of my bills are in my name. I have no help. How are y'all affording housing? In Myrtle Beach, a 1-bedroom apartment is $1,500. How are y'all getting insurance, going to the doctor, getting medicine? And then some of us are trying to be TikTok influencers. Who knows where that's going to get me? Me and my boyfriend are saving, but we barely see each other during the week, and it feels like we're working our off for nothing. Do we need to move somewhere for a better job opportunity that we don't know about? Do any of y'all really know what you want to do with your life right now? It is so scary being in America right now.
You know, honestly, it is really hard to think or say which is worse, to be broke in your 20s or broke in your 30s. You know, looking all the stories of, having this very hard life, a lot of these people are struggling. You need to understand that it is not only one cause of all this, very bad labor market, very bad inflation. There are multiple different, negative impacts that happen not only in the US but around the world, and they all happen at the same time. Sure, you can go that route of, conspiracy, that everything was kind of planned and kind of structured, but generally speaking, if you want to stay more objective and just stick to the facts, it is very, very bad luck. Bad luck for this generation. I would say bad luck for even previous generations, and I really don't know what is going to happen with the future generations. Because sure, there is a small segment of very, very young people right now that are doing very well. Are they lucky that they're just teens now, when the AI is booming and they understand AI the way the previous kids understood video games. We're about to find out. But
what am I doing wrong? I work every day and I'm still broke. Like, I have a decent job, I make some decent money, but I live out here in Cali. Like, bro, as soon as I get paid, I have all these bills stacked up, bro, that shit wipes me clean. Like, fuck, I got no money left over. Making $100,000 a year doesn't get you anywhere nowadays.
Hi guys, I'm really stressed today. I just went to the grocery store, bought 10 items, and it was $80 freaking already. I literally have $10 left on my account. So a little backstory. I got laid off from my job a month ago, and I've been applying for jobs months before I got laid off. Sent out hundreds of resumes already. Applied to hundreds of jobs on the internet, remote and on-site. Tailored my resume to every position that I applied using ChatGPT. Went to only a few interviews and still nothing. Like, what the f is going on with America right now? Like, it's so freaking hard to live here.
I do understand that there is a very strong and powerful segment of life where if you're born in the right time, the beginning of the bull market, 40, 50 years ago, when you were born during the baby booming, right, you made tons of money without knowing anything more specific, more niche than other people. You just born in times where the economy was booming, everyone around the world, there was no longer wars, the inflation was very low, the federal interest rate was close to zero, the houses were at $150,000, everything was affordable, people were traveling and having a good life. Well, this was simply luck. You cannot choose when to be born, or what kind of economy live through, right? So I genuinely believe that if you want to stick to the facts, it's a very high chance that your life will be determined by luck, in which times you were born. You could have been born through the First World War or Second World War, right? It's not good.
Y'all, I just went today and got my driver's license renewed, my car tags renewed, picked up 2 prescriptions, and got a few groceries. To say that I'm completely broke now is an understatement. So I'm going to have to go home and start selling off my furniture to be able to live the rest of the month. I mean, that's just, it's unbelievable. And my heart hurts today. Truly hurts for people who are not able. And really,
bro, the cost of living is insane right now. Like, what are we doing? I swear before COVID in my area, $20 an hour was like, you balling, you good. Now people that making $20 an hour, I'm like, man, how are they surviving? Like, this is insane. Fast food places are paying $20 an hour now. So $20 an hour is the new $10 an hour. Obviously, all of this is relative to where you live. So my $20 an hour where I live in Northern Virginia, maybe your $16 an hour, or maybe your $30 an hour. It all really depends on where you live. Like, I can't be the only one that sees this stuff. Like, I can't be the only one that understands what's going on. And it honestly worries me that there's some people out there that make less than that. Like, think about the people out there that's making minimum wage. Like, probably have to work 2 or 3 jobs just to make up for, a livable income. It's insane.
I'm just mad. I'm just mad anymore. There's no reason for me to be like, yay, America, like, we're so great, we're so free, we're so powerful. I'm starving. I have to go without so that my kid can maybe have Pop-Tarts once a month. Shouldn't be that way. We shouldn't have to go like, let's see, we haven't had meat in a long time, because guess what? We can't afford it, okay? But yet we're the ones working every day to make this country go round and round. But we're not worth being able to have decent food, or the amount of food that we need to have one of our family members go without. I'm done. I'm done. I'm so done. It shouldn't be this way. And I know that it's not just this way for me.
Living in America is freaking ridiculous right now. 2 to 3 grand on average. You need to make 2 to 3 times that. $9,000 a month. How many people with regular bachelor degrees are even making that? No one.
How do y'all enjoy your weekends when you're broke? Am I the only one saying this? But like, you ever work all week, you realize you ain't got no money, then the weekend rolls around, and you think to yourself, I can't enjoy it because I got no money to do nothing. I remember in the summertime, one time I was like, getting ready to go get gas to mow my lawn, and I realized I was broke and had to like take money off my overdraft, my checking account, just to buy fuel for my lawnmower. But I'm like, I just want to be able to enjoy my weekend and feel like I got a few extra dollars, or like when I'm mowing my lawn, I want to take pride in that. But I can't explain the feeling that you get when you're broke on a weekend. You just almost feel guilty.
You could have been born through the Shakespeare's times, right? Where people had a life expectancy of 30 years, right? So again, the foundation, it's always luck, and then you should see, what you can actually do with your luck, what you can do with the current assets that you possess. You might be artistic, right? A lot of people utilize this. You might be very hard-working individual, very good in physical activities, right? Because people are praising side hustles. Side hustle means just another job. And people who work multiple different jobs, they don't get wealthy over time. They get tired over time, right? So you don't really get to find a solution for your issues or problems financially. You kind of try to patch certain financial gaps, try to pay off some of the bills, try to keep up with the inflation and the cost of living, but you don't really find a solution for your problems. So if you want to be objective, we're having a very, very bad luck at this very moment, right? Because we're still in process of changes. It's not, all settled down, and now people can actually, start to look around, try to find, okay, where the wind is blowing, how we're gonna actually build up the new careers, or reclassify, or at least respecialize our skill set. Things are still moving left and right. You don't really know what to learn. What if the AI bubble bursts like never before and no one wants to touch AI for the next, let's say, 5 years?
Okay, so when exactly did middle class just become pure survival mode? I'm talking like the hunter-gatherer stage of humanity. Because think about it like this, just one mistake, one minute mistake away from sleeping under a bridge.
The quiet way how many people are actually losing their buying power and effectively experiencing disinflationary pricing wherever they go only happens when they try to pay for something, right? Same thing, you don't understand how little you earn until you actually see your paycheck. You see all the deductions, you see all the taxes, right? The quiet way people going broke. And again, it has been happening. This is not a new thing. The thing is that now the escalation or the majority of the issues for people are becoming the money issue, right? Before it has always been like money issue plus something else, like money issue plus something else. Now it's money issue plus money issue. And as you can see, a lot of these people are experiencing almost the same problems. It always comes down from the economic standpoint, where the economy doesn't really reward the people who are working the hardest, or the people who have consistently worked at the same place, putting the same effort, showing up every single day. The idea here is that the economy currently is rewarding innovation, not stagnation.
Can someone please tell me that things are going to get better for the economy, for the world? Just someone please tell me that things are going to get better, bro, because I work from 8 a.m. to 10 p.m., 2 jobs, and I'm just sitting on my lunch on my second job, and dude, I just can't do this shit anymore. I told myself I would never work a second job again earlier this year, but bills are bills. You got to do what you got to do, but bro, I can't keep doing this shit. I'm tired, like everyone else.
I spent about an hour talking to my grandmother last night. She's 90 years old, and she's actually considering selling her home and her property because that's the country we live in right now. She's 90 years old and she has to sell everything that she's ever earned. That's the country we live in right now. My grandfather was retired from the military. She has her Social Security. They both worked their whole lives. And she can't afford to live anymore. 90 years old. Put money away, did all the things. And now she has to be put in a position where she has to sell her home.
Even if the prices go lower, the wages will not go up. Even if people are rehired, the people who are fired, or at least part of them, they're still going to struggle because the prices will not go lower and the wages will not go up. Every single year, when the prices multiple times per year on certain items go up, your salary doesn't go up, doesn't catch up with the pace of the prices. And this gap has always been the rule. But the prices haven't skyrocketed this high, plus the devaluation or the buying power of your money hasn't gone down that drastically, that substantially as we've seen for the last couple of years. Considering that almost a quarter of all the money in circulation in US dollars have been printed throughout the virus situation, through the distribution of stimulus checks or any of the relief programs.
Out there is wondering how Americans are doing poorly. We are doing poorly. Yesterday, I woke up to an email from my landlord saying, hey, I'm raising your rent. Why? No reason. We already pay all of the utilities ourselves. That is not included in the rent. So we pay for electricity and we pay for water and we pay for natural gas to heat our home. And that bill in particular has skyrocketed this year. Every single month this winter, it was over $600. And we do not turn the heat on. We just turn it so that we can survive. We do not turn it above like 60. So we're freezing in the house all winter. Oh, and also I woke up this morning to an email from my health insurance being like, thanks for your payment. It was deducted automatically, except this time the payment was $400 more than it was last month. Sorry? What's going on? So I called the health insurance company and I was like, why did this happen? And they said, oh, well, the tax premium expired. And I said, tell me why that happened. Is that because of federal budget cuts? Is that because of the New York State budget? Where did that come from? And they said, we don't know. You have to call the New York State Department of Health.
I am so sick of how expensive it is to just live. Before I left work, I had to make sure I bought tickets to my kids' musical for school. And I'm going both nights. And then my parents and my husband's parents are going one night. And then we're going as a family one night. So I just paid for those tickets. For all those tickets all together, it was like $62 or something like that, 62. And then I left work, I got my kids to school, I had to get gas. I was on E. My gas light was on. I had busy like for the rest of the evening after I wake up, after sleeping, so I was like, let me just do it. It just cost $78 to fill my tank. I do have a mid-size SUV, I have a Chevy Traverse. But literally before this day has even started, I have now spent $140. How the freak do you sustain life anymore? I don't know. It's so frustrating how expensive everything is. It's like every time you turn around, there's like something else to pay for. And I know that's being an adult and I know that's life. But it's so frustrating.
So you need to understand that when the velocity of money supply outnumbers the actual products, goods, and services produced from the consumers, well, then there is a natural latency in which inflation will catch up with and essentially fill up the gap. There's no space left behind. And like I mentioned, even if now a lot of businesses are showing up, they extend the working hours. They wanna, try to recoup the missed revenue by simply not having enough clients. People don't have enough spending power. They still cannot catch up with the previous pace. You see businesses compare month to month. The sales are down. They're not comparing quarter to quarter. They're not comparing year to date. Because the further back in time you go, the bigger the difference of your revenue or earnings actually comes to the end, right? You realize that you was making personally, or your business was making much more money, much easier throughout the virus situation years, right? And the main concept that you will see is that all these people, they want to work. They're not lazy. They want to work. They want be given a chance at least to use their skills, use their time in exchange for money. But the problem is that the market currently prioritize technological advancements, prioritize AI to get the job done. And this is, no one knows for how long it is going to be. It might end up being forever. It might end up being the new standard. But these people, unfortunately, they have to figure it out the way to actually exchange their current skills and knowledge base with the skills and knowledge base about AI, either working alongside of the AI, improving the AI, or maybe starting their own business. We have seen plenty of stories, people who without any prior technological background being able to utilize AI for either improving their own personal or professional lives. So I truly believe that these people will catch up with, because if you wait for the economy to fix itself or fix your life, you're gonna be waiting forever, unfortunately. The illusion has become real, and the more real it's becoming, the more desperate they want it. Genuinely ask yourself a question. When was the last time when you ran out of money? When was the last time when you thought that you have to change something, right? When was the last time when you saw someone that is doing very, very well and you kind of promised to yourself that you can also do well and you're gonna find a way to get things in order? You know how people say that you have to save money for your retirement because the life will simply get more expensive, the inflation will go higher, and all of your savings will shrink their buying power. Well, I run the numbers for you, so essentially you will know exactly how much more expensive the current items that you're buying, such as bread, coffee, chocolate, how much more expensive these items will be in 20 years. Guys, it hasn't been that clear why some people are making money now in this current economic cycle and why others are struggling to make even a simple wage. Why? Most people currently are struggling to understand the value. Why a PhD professor in some of the biggest Ivy League schools is making less money than OnlyFans creator? Because the value provided from the OnlyFans creator is valued much higher. People are willing to pay more for more days in a row for the content creator versus paying for school, university, college, etc. This is a very drastic example, but this is probably the clearest example to understand that if you want to make money right now, you have to understand what is the value that is in huge demand, how to learn to provide this value, how to price the value, and how to deliver the value. I gave you this crazy example because this is the actual truth. If you look at the stats, the OnlyFans is one of the fastest growing company, which means forget about what is the actual industry behind it. Think of it as an operational business. OnlyFans employees are the creators. So if you have more and more employees, more and more people signing up for the platform to work for the platform, this boosts the revenue. And these people are, fighting to join the platform. It's not like the platform is reaching out to them, which means that the opportunity that provides is matching the huge market demand. Okay, we're business people. We don't engage with what is the niche, what is the industry. We don't be judgmental. Everything that grows fast, that has a huge demand, that has a gap up opportunity, we want to learn from it, right? And there is no marketing, they don't promote, they don't run ads, right? When you have a business that grows so fast, without marketing, without paid ads, without CGI, without absolutely anything, anyone even, promoting it, we have to join, versus every other business that spends billions of dollars destroying its margin, especially the e-commerce brands. We make $50 million this year revenue. How much profit, guys? 4 million. The margins 80%, 40%, 60% of the margin goes straight to marketing, ads, content creator, brand deals, whatsoever. So you need to understand, to identify where is the value now. Where is the value now? Can you learn the value if you don't possess the knowledge? And can you provide the same value, more niche, more detailed, to differentiate yourself with anyone else who is offering this service as an individual or agency. And this is how you are staying away from people who can't realistically make any wage in this economy. Because the attention economy is shocking for a lot of people who simply thought that the business will go as usual. When people started searching information on the chatbots, no longer in Google search, all the people who have been collecting passive income through blogs, writing articles, affiliate marketing inside the articles, posting products, making reviews, recommendations, they saw their traffic that has been absolutely steady growing for the last 20 plus years going completely down. And all their blogs, all their articles, nothing has been ranking. So this again was the wake-up call that all the businesses from the previous decade at least are no longer working. And these people have to adjust with providing value. What was the value? Well, they came up with extensions. Extension that summarizes YouTube videos. Extension that summarizes or make recommendations of articles. Extensions that give you faster answers to the questions that you usually search. Instead of reading a 5,000 word blog post about the top credit cards in January 2026, you're going to use a small extension or a small summarizer on the side giving you 5 points, 5 cards, the most important line, what is the bonus, the requirement, and when is the final date you can apply it for, right? This is something that Google search came up with, which is an AI summary, which destroyed all the paid Google ad space, because the first line will always be AI summary, will no longer be the paid ad that will show the closest possibility of answer or thematic reply of your query. The business is changing even for the big guys, even for people who used to make tons of money completely passively. So if these people who used to make $100,000, $200,000, $400,000 a month just by people having going to their sites, naturally getting traffic from Google, they lost their revenue, most of it. Then you kind of wonder where this leaves you, a person who didn't make this much money, who was actively, who was earning active income. This is the moment when you have to go, and you probably start from the get-go alongside these guys, and learn how to identify the current demand for particular value on the market, how to identify where to deliver the value from, what the value requirements are. Right? This should be a metric in a way in which you can measure the value that you provide, and then you should be able to price the value accordingly, according to the market. Because now with the AI, the tools that people produce are very, very similar. They use the same prompts, they use the same chat GPT or GPT LLMs. They're using almost the same UI, user interface tools to create the visuals. They're using the same marketing channels. So the market is kind of saturated unless you go into a niche that is not sexy or popular. The niche that is kind of forgotten from the general public. It's pretty known from the experts, but they really don't want to get into this, right? People who are scouring the daily volume of the keyword search, they know exactly that some people are looking, for example, the top chimney cleaners, right? No one cares about this, but they know, they have the data, the geeks, they know exactly what keywords for what kind of businesses, products or services is currently in huge demand, but they don't really, they just prefer to do something else. They don't want to focus on this particular product or service. So what is the clear path here? Clear path will be, of course, to find and partner with some of these people who have the data, know how to analyze or identify the incoming trends, and you are going to be the builder and the promoter, right? You're going to be the person who constructs the tool and promotes the tool, and your partner will help you identify what kind of a tool is needed on the market. Sure, you can do it by one-person business, but I believe it's too much work, and definitely you're going to burn out. You need a partner, and you need one of these people who have the data, who's knowledgeable, to scour the net, find something that is just popping, and you can make a very good partnership. This is your very easy step to move away from just shooting in the middle of nowhere without particular target, without goal, without knowing exactly what you're trying to achieve and who you're trying to serve or provide value with. Finding value and finding who to offer this value is the two-step process, which it's easy, right? It's like looking for someone that you can, let's say you replace tires. You drive around the city, you look for somebody who stopped on the side who has like a flat tire or something. This is how easy it is. You know your value, you replace tires, and you find somebody to offer the value which has a flat tire and you don't have spare one. This is how easy the process could be broken down into two steps. But people get, crazy focused on 17 different businesses, 12 different niches, try to identify something that is already so much saturated. Forget about it. Getting an average inflation rate that we had for the last 20 years. We took the same exact average increase year by year and we applied this and we got the final results. So a bread currently is selling for around $3. In 20 years, the expected increase in price of a bread will be 64%, or essentially $4.92. It's not as crazy as it sounds. A lot of people probably expected that bread will cost around $9 or $10. Let's see a bottle of water. So a bottle of water will effectively sell at 64% as well. We took in the average. Currently, a bottle of water is around $1.50. We're talking about 500 milliliters. In 20 years, the same bottle of water of 500 milliliters will cost you $2.46. Again, not crazy difference, right? It's not something that will break the bank. Chocolates. A chocolate bar today is selling on average around $4. And we're talking about 180 grams, 200 grams, depending of the brand, depending of the chocolate. But this is an average. Applying the same 64% increase, this will give us $6.56. I would say this is probably the most noticeable. Simply mathematically, the higher the original price, the higher the percentage increase will be. If you look at we started with $3, then we moved to $1.50. So the lower the initial retail price at the current economic situation, the smaller the difference it is. So this is why we're seeing that the chocolate from $4 actually has an increase of $2.56 versus we saw the original, the bread with $1.92, and then we have the water with effectively with 96 cents difference increase, which again, greater the price, even if you have the same percentage increase based on inflation, you're still going to be paying more for more expensive items. This is why I see a lot of people sometimes are buying more and more Rolexes, more and more like jewelry, more and more cars that are limited edition, not the regular cars, because they will simply most likely either appreciate from the demand or appreciate from the inflation. Even if there is no such a demand for, let's say, SLR, McLaren, Mercedes, not so many people looking to buy the car, because the car is limited edition, point number one, and point number two, because the value of the money is going down, and the car, because it's limited edition, count as an asset that generates appreciative value. This still means that the value of the money will decrease based on time value. And the last example that I pull out is the coffee. I believe most people drink coffee. So currently we're having a cup of coffee selling for around $5. Average cup of coffee, I don't know, 200 milliliters or so. We're having $5, no brands. Price in 20 years will be $8.20, which it's a lot. It's the biggest increase in this particular product category we picked. It's $3.20. Like I mentioned, the higher the price, the higher the original price, the higher will be the bump based on the same 64% increase in inflation. But you need to understand that there are people today who are paying $10 a coffee every single day, every single cup of coffee, not day. I think there's a couple of brands who are selling, small coffee for like $8 or $9. So it's not a game-changing stuff, right? I believe a lot of people, when you click on the video, expected to see some crazy numbers, maybe $20 coffee, $10 bread. You probably expected $5 small bottle of probably expected $10 for a small chocolate bar. But again, this is estimated progression of the inflation based on average that we saw for the last 20 years, adjusted with the next 20 years. Maybe I missed some of the more or less popular products that you guys usually purchase, but I believe this is something that applies to most people. Most people eat bread, right? Regardless of the form or shape, most people, if not all of them, buy water. Maybe some people drink at home, I don't know. Most people buy chocolates for themselves, for the kids, and for girlfriends as well. And almost everyone I know personally drinks coffee. So this is the prices. Next 20 years, I think we don't have to worry about that. Let me know if you want me to make next 40 or 50 or 60 years. What the heck could actually happen? And this is a rough estimate if we presume the Federal Reserve will print the same amount of money. The Federal Reserve will follow the same exact cycles of quantitative tightening and easing, right? Which most likely ain't gonna happen because they already finished this year with $40 billion fresh cash printed out of thin air. So they're gonna most likely continue. If you look at the chart of the Federal Reserve printing cycles, every new cycle they print more money. So these numbers, I would say they are conservative, but the ballpark will be somewhere around there. So we ain't gonna see some crazy numbers. We ain't gonna see bread at $20 or at $10 a small bottle, or chocolate at $20 or coffee at $20 a cup. I don't really see that happening. But of course, the deviation probably will be ballpark of what I mentioned, with a greater probably estimates of the upper echelon. You might see maybe $1.5–2 more expensive than the prices we predicted. When was the last time when you promised something to yourself and you didn't follow the promise? So you think you're broke? You have to look at the people from the Federal Reserve. They're getting paid little to none. The starting minimum salary is $36,400, which is basically around $3K a month. The crazy part, the minimum requirement to get hired is that you have to possess a PhD in economics. Let's run the numbers. You have different pay grade. There are people who are exempt and people non-exempt from overtime. It's very, very strict. So let's run the numbers, and I promise you, after watching this video, you're not gonna feel the poorest guy in the room. Let's run the numbers. So first of all, you wanna go to federalreserve.gov careers-salary. If you scroll down the careers and the open market positions, we're having two separate categories. You have a grade FR and you have a grade WE. So of course I have to Google it, right? So the difference between the FR and the WE is the expertise and the usual work that is required or part of the daily duties of each of these positions. So basically the first one, FR, are normal positions that are in office, white collar, economists, research assistants, etc., right? The second, the WE, are non-exempt, which essentially have a different ranks. These are more you have a tech support, that kind, more broader positions. A lot of these positions do allow you to have overtime, but as we saw, there is a minimum and there is a maximum. It's very crazy that they put the actual range. So if you see the lowest pay over here, the minimum will be for the lowest grade FR-16, which is $36,400. If you're in the same grade of education, of knowledge, of expertise, your top maximum is only $44,000 per year. Don't quote me on this, probably some cashier in Target makes this much money without possessing PhD, which is crazy. In the next level, you got like 3K higher base salary, and he got around 16K higher upper maximum. To scroll down, remember all these positions require for the FR require PhD in economics. Why they require PhD? Because they want to make sure that you possess advanced skills and knowledge in the industry. Not to mention, you have to have published papers, you have to be cited, you have to have papers that are on the current economic issues, something that is currently important, currently trending. You cannot post a paper on why John Maynard Keynes was pro-government to essentially step in when the economy is going bad, right? You cannot write something about historic events. If we scroll down, you will see that the top highest level, the highest grade, the person who possesses the most knowledge, probably years of experience, the base is 150,100, and the absolute maximum this person could be paid is 295,000. This, in my opinion, sounds normal to be the base salary for everyone working in the Federal Reserve, right? When you hear the Federal Reserve, you know these people kind of important. They work with very important data. They have access to very important economic data, advanced knowledge, right? You would think that these people, you know, because they have to have superior knowledge, they have to have superior skills to analyze the data, predict the future of the economic cycle, make plans, and based on these plans, they create a economic policy, and then we have the FOMC meetings and so on and so forth, right? The decisions about the interest rates, the quantitative tightening, easy. I'm not going to be boring you with all this information, but this, in my opinion, should be the base salary, 150. And there shouldn't be an upper maximum, because remember, this is not a government institution. The Federal Reserve, it's a private institution. It's not government institution, which means that the pay should be very well, right? As a private institution, the pay grade should be higher. The conditions should be much more flexible. It's not like you're applying for government position, which is very, very hard, very, very strict, The pay is going to be always low because, you know, the government has a lot of employees, you know, has budget to follow. If you scroll down to the second types of positions in the employment wage structure, which is WE, the more broader employment, like tech support, etc., the base is higher. They're starting at 40,300 with maximum of 66,200. Maybe 2-3K, 4K difference, not a big difference. The absolute max and top you can earn is actually lower. Starts at 120, and the upper limit is 197,000. Which again, this is very little money. I don't know how much work it is. In fact, to be honest, might be little work, might be chilling most of the time, and have to do, maybe you have to crunch the numbers once a month. But again, by default, I believe not only me, but a lot of you expect these guys to be making lots of money, at least on paper. Because if you look at the bottom of the report, it says the last updated is November, 21st of November 2025. So it's just recently updated. I cannot imagine what were the salaries prior to the virus, and probably much lower. Very interesting. So this is why don't feel poor regardless of the job that you're working. Don't judge people, seeing them with suits, with nice clothes, you know, going to work with briefcases, etc. Obviously, you don't really know who makes the big chunk of money, right? You might be thinking, imagine you're working, whatever, some of these operators, some of these how we call, like the mobile operator plans. You go to Spectrum, let's say you're working Spectrum, right? I don't know what is the salary. You make like 90K, something like this. Overtime, promotion, bonuses, you sell some phones, etc., right? And you're traveling in the subway, and next to you have some guy, 3-piece suit, you know, you have a winter coat, briefcase, working in the Federal Reserve. You may be thinking this guy's making $500,000. But de facto, if the guy is like the pay grade, like the first pay grade, the level of actual advancement of knowledge, this person, unless he's at the level 6, you will be making more money than him. And this is where people get things wrong. They think that it's a lack of time. I don't have time to do it. A lack of skills. I don't know how to do it. People say that they have lack of patience. I cannot wait to get rich. I cannot wait actually to start a business, to build, to grow, to expand, which it's all kind of fake excuses of simply not spending enough time to make the strategy that applies to your own life. Because you can always find time, because you can always get inspired by looking someone else's business. Think about a lady last year. She was selling air in cans. You open a can, like a small, soda can, and there is nothing inside. She made millions selling nothing. There was a guy 4 years ago. He was selling on iTunes 3 minutes and 50 seconds a song that was nothing on it. You listen, empty sound. It was something like Calmness, named Calmness, and you play it and it's nothing. You have to pay for it, like $8, $7.99, something like this, and people bought it. The guy made millions. If this example doesn't give you the wake-up call that anything could be bought and sold, if it's an original idea, and if you find early adopters, which is two key concepts, very simple. If you break down what the business is, first of all, original idea, something that you sit for the first time, you're kind of curious, it's kind of cool, it's not your thing, but you're very, very interested to see how it works or how it feels or how it tastes if it's a food. So you spend money. This is how all the garbage sold on TikTok works. I was so curious. I see these people, building businesses from nothing on TikTok Shop. And I asked Perplexity, why the hell people buy all this crap, right? It's absolute garbage. Like, why would you buy shoes for like $8? The shoes is the most important item that you have. Your feet might hurt, you might get hurt, you might slip, you might fall. Always buy, if you're going to spend money on something, always buy nice shoes. Nice, comfy, very good materials, breathable materials. Don't spend, tons of money on jackets and sweaters and stuff that you can just wear a couple of days here and there. Shoes, you always wear shoes. And then I asked Perplexity, why people buy all this crap on TikTok Shop? Let's go back to the question. Perplexity said that the gamification on TikTok makes people to fall into the trap of having fun, funny video here, funny video there. In between, there is a stupid product that is stupidly cheap. So in the same sense of being gullible and being brain rot to keep scrolling, in the same sense, people follow the trajectory of, that's a funny item. Let me buy this stupid shit, right? Because it's stupidly cheap. So the whole sense of let's sell something stupid to people who fall for stupid jokes, for item that is genuinely has no real application or quality checks, it's absolutely mind-blowing. And I'm not cheating on the entrepreneurs who are making money out of it. Shout out to them. These people are working. They don't wait for stimulus checks. But the main concept is that I'm giving you this for an example to understand that you don't have to be the smartest. You don't have to come up with something brand new. You don't have to offer supreme quality, right? You don't have to build the actual product. These people are not building the products. Everything is coming from China to begin with, right? So business these days, especially in e-commerce, you are the middleman. All of these people are the middlemen. They're not manufacturing, designing the products. They're just selling the products. So this makes your job even easier as an entrepreneur in 2026 and forward. Because a lot of these businesses require marketing skills. Essentially how to market the products, how to present the product in a form of entertainment. 99% of commercials from the creators on TikTok represent the products in an entertaining way. They don't present the products in a salesy way, not how usually the old commercials used to work, right? So this makes your job even easier. If you're good in sales, you can start as a salesperson until you actually generate enough capital to start your own business. But there is no drawbacks. learning this skill will never hurt you. Learning how to sell, it will always help you. It will always help you in your business side, in your personal life. Learning how to sell will teach you how to negotiate. Even when you record a one-sided video, like me recording right now, this helps you to create your own profile, to lay out your thoughts, organize them in real time, and being able to deliver a message that will reach out to the other part of the camera, right? This also helps you not only to express and send the message, but also helps you to answer questions that people might have. They haven't asked you yet about that, but you already know what they're gonna ask you, and you're gonna over-deliver. You heard that the biggest companies in the world believe in over-delivering. Meaning, when you buy a product, you expect the product to be this much good, probably 5 out of 10. The best companies believe in over-delivering. You receive the product and product is so good, the product is like actually 8 out of 10, 9 out of 10. And people are so passionate. People thinking, oh my gosh, this product is so good. They probably gonna raise the prices soon because a lot of people like myself will find out that this is underpriced product. So people will go immediately and buy even more. This is how you get repeatable customers, repeat orders. And the repeatable customers or pitching your current customers is the easiest customers or orders that you're going to get because people already know you. They know the product, they know the service, and they trust you. Every time when they try something new line of products, new colors, new shapes, they're buying the trust. They don't buy the actual new design. Think about Apple, right? You don't really care. If I ask you what is the difference between the latest iPhone and the previous iPhone, I bet you most people will have no clue. So why people spend more money every single year on new device or every 2 years on new device? Because they buy the trust, because they don't have to study what is the memory, what is the camera, what is the chips, what are the processor, what are the new apps included in the software, what is the new iOS. No, they buy the trust. They go out and they install the latest upgrades because they buy the trust. They trust in Apple. This is what you probably have to understand. Building the sales skills, generate capital by selling someone else's products if you don't have capital to begin with. After you generate capital, you start your own business. You're selling your products by yourself. You're starting yourself, one business, one person. And then you hire other people. You teach them how to sell like you. And this is how you automate your business. No PhD required. So major trading indicators are flashing big red flags for potential crash in gold and silver. Pay very close attention. The speculative bubble, in particular in silver, indicates 264% year-to-date surge when the prices hit $100. This does not indicate the $120 price level, which at this point is unreachable in a very short term. Very important that over here, the supply and demand is no longer on the table, which means that the technical terms, both trades, couldn't be predicted as precisely as on the fundamental level. This is why Wall Street predicts a snapback to at least $50 and strong consolidation at these levels. Kicker over here is that usually Wall Street is wrong, and it's wrong on purpose, because they're not really gonna give you how low it go or how high it will go. Remember, they have to make profit. They have to be always at least 10 steps ahead of you. So what this even means, they most likely are pricing it to go even lower. Who knows, maybe $40. But they wanna make sure that they will be able to sell enough before you start selling. Because when they start dumping pieces by pieces, the prices will go lower and lower. So for example, if Wall Street is doing the calculations, let's say we want to sell $100 million at average price of, let's say, 45. They're telling people that it could go down to 50. So when they start selling at 50 or 60 or 55, every small chunk of silver that's dumped on the market will cause lower price. So when they get all the silver sold, they're going to take the average price of all the chunks executed on different prices. I sold 10 million at 65, I sold 50 million at 50, I sold 45 million at 55 as well. So then you take the average and then you get the price. Second important element over here, the big people who push the prices of gold and silver up have taken substantial profits, 25 to 26%. We're seeing that already has been taken off the table, which indicates that the dip 40%, a single dip that we saw in silver, was not something that was manipulated. People just took profits. And why the silver didn't recoup the losses and went back to 40%? Because these people didn't buy in. Again, this is on the fundamental terms. This is why we said technicals, you cannot judge anything, because people who jumped on the rally are not following the actual technical trade. They don't buy on support and resistance or selling on support and resistance. They just follow their own profit-taking strategy. Third important element that over here flashes the red lights is the macro headwinds. They're changing. Like I mentioned in my previous videos, first of all, gold and silver no longer play the role of a hedge. The gold is falling, silver is falling, stock market is falling, crypto is falling. So what it gives to buy gold and silver when everything falls, and when anything goes up, it also goes up. So it doesn't make any sense. Also, it's very illiquid, right? It's not as liquid as the stock market. So the geopolitical calmness, right? There's no longer escalation, war situation, gives a dollar edge over the gold and silver, adding a small bonus with the new Fed chair, Kevin Walsh, who will be stepping this summer, right? And don't be so naive to think that everyone will be waiting, holding their gold and silver until the new Fed chair to see what's going to happen. No, people are smart. People are going to anticipate the move, okay? Anticipate the move, meaning they're going to take action prior to see what actually is happening. Don't be the last person making the decisions about the market. Well, maybe this will happen, and you're going to be left in a very complicated decision-making situation. Very important also over here, Donald Trump is focusing on improving the value of the dollar. This is why he created Bitcoin reserve. This is why he's focusing on crypto. He also have its own crypto form, right? So he has personal direct interest of pushing towards crypto, not gold and silver. And crypto, it's not an enemy of a dollar. Just think about it. Wow, if you think about it, right, gold and silver are not favorable in competition with dollar. This is why it will set the stage for a completely new flip. And remember, if the governments, which are the main driver of the rallies of gold and silver, stop buying or start lagging their reserves, you might see some of them releasing, because remember, all of these other countries, they have very, very bad economies. They have bad currencies, which are usually devalued. They have bad inflation, right? So all these other countries, they're holding the gold for security reasons, which means is that the first issue that they have in their country, financial crisis, recession, anything related to security risks, right? They will dump gold and silver, so they will be able to get probably dollars which hold their value and will help them to resolve the issues. This is why something a lot of people do not understand, that a lot of countries who purchase gold and silver are not like you individuals buying it, so I will protect my investment and I'm gonna make money. The countries are not looking into the gold and silver as making money. They're looking at it in a way in which they provide a securitization of their own currency, point number one. Because like I said, if you have like some currency that no one accepts, that devalue, depreciates, just look at how many countries around the world have, see either hyperinflation, people walking with 2 bags of paper money that worth like $1, right? Or countries have seen like their local currency depreciates, right? The reason for it is that many of these countries may mostly rely on international trading agreements, and most of the international trading agreements are pre-signed for many years ahead in US dollars. Remember, there was a major push for canceling the US dollar in some of these trading agreements between China and US, between China and Saudi Arabia for oil. The idea was to weaken the power, the influence, and the value of the US dollar. It's fair to say that most of this actually failed, and the reason for it is that a lot of these countries will be causing even greater risk and exposure to risk for themselves, right? On paper might look good, we're more independent, we're using our currency, but then don't forget that everything is a loop where using your own currency on paper looks good, but in real life, if you cannot really exchange or improve the value of your local currency by improving your local economy, you're kind of shooting yourself in the foot. So pay very close attention. These are three major headwinds which Wall Street technically sees that will play out very, very soon in 2026. Unfortunately, the world has turned out to be like a bar. You know how in the bar you need to take the attention of the bartender to serve you, right? This is the number one skill that you want to learn. Moving on forward, you need to learn how to take attention. If you don't know how to get attention, you're not going to be able to get clients for your business. Complete professional success depends on attention because we live in an attention economy. And on the personal side, things are completely matching. It's the same experience. It is very hard to get attention as an individual to find a partner, find a girl, find a wife. You need to learn somehow to start getting attention. You do understand that you're actually making Wall Street every single day rich, right? You do understand that if the individual investor is not on the market directly or indirectly through the pension funds, Wall Street, to be able to make money, has to trade against Wall Street. And when you put all the smart guys in one room, no one will bet anything because they all know the game. Whoever speaks first, whoever acts first, loses. Some people get attention by being crazy. Other people get attention by being creative. You know, they throw a bucket of painting and they start moving the colors. They're very creative. They dress colorful. They have some skill. You need to find a way to get attention. Other people play dumb. They go on the streets, they make jokes, they make sketches, whatsoever. Everyone, in some way, found a path where they're gonna attract attention, which later they monetize. And when I speak about monetization, I'm not only speaking about finances. Monetizing the attention could be in a favorable way in your personal life, right? Let's say, as a man, you understand that everything is a numbers game, right? The more women you met, the greater chance to meet the right one, right? Where for the women, the equation works against them. The more men they met actually works against their interests and their image. So you need to understand what game you're trying to win, what are the rules in this game, and how you can apply your personal character. I'm not talking to you to be fake. I'm not talking to you to be somebody or trying to be somebody that you're not, because you're going to lose this game. You see this every single day. So many people are so obviously fake, and they're fake and they copy other people. They are ingenuine and they lose the game. They fail and they disappear from the social media or from the public scene. This is what you have to break down the process into small steps that you understand. You compact the process with genuine moves, exactly who you are and what works for you, for your own goals, and then you get things accomplished. This is why you see very, very successful people are speaking about success, that everything somehow happened very easy for them. Somehow they became very successful. They're very happy. One business, second business, third business, serial entrepreneurs. And everyone wonders, I can't even build a single business. This guy or these people have built multiple. Why? Because they were genuine to themselves. Look at Elon Musk. He could have you know, buy 17 islands in the Bahamas when he sold the PayPal to eBay, not bothering about building electric vehicle cars or space or Neuralink or the underground tunnels, but he was genuine to himself. Okay? He was genuinely interested in all these weird technologies that didn't exist. This is why he's so successful. I bet you now understand that you need to follow your passion. Stupid cliche, but this gives you unfair advantage because you can proceed following something that you like and enjoy much longer than following something that you don't, right? So many people know that the people on Wall Street are making the most money, but everyone knows that the job sucks. Everyone knows that it's very stressful. These people actual life is miserable, right? Their colleagues are fake. The job is kind of dissatisfying. It's kind of artificially processed, right? You don't really feel that you create value. You just feel that you process information online and you extract value from this information before everyone else on the market. You make tons of money, but I guarantee you these people do not feel fulfilled at the end of the day. Everyone knows that these people make money, and again, smart people say, it's not for me. Smart people. Everyone knows the truth, but the smart people say, you know, this is not my genuine character. This is not really who I am, right? This is why the really, really successful people, they make their life very easy. It's very, very easy. Like if you have fun, I watched Jake Paul a couple of weeks ago, like interview, short interview. You can say whatever you want for him. The guy made tons of money. And he made tons of money by having fun, playing dumb, stupid sketches, stupid videos, you know, skits, boxing. He basically made his own life very easy because everything that he did was something that he liked doing. He liked making jokes. He liked making feel stupid, the stupid guy on the video or the stupidest guy in the room. He didn't care. He didn't care, you know. And this is probably the two levels that actually send him in completely different level. Even Andrew Tate doesn't make fun of him anymore. He said, I respect Jake Paul, I respect this, I respect that. Again, you can even learn from Jake Paul, regardless of what people say. He didn't care what people said. Number one reason for success. If he was listening, paying attention, what the media, what this, what that, he wouldn't be where he is right now. Second thing, his brother was more successful than him. And, you know, he was able to escape from his shadow. Again, it takes a character to build a character. And now you can bet he's more famous than his brother. This again proves the point that you can start from zero and build some profile that is very successful and fulfilling as long as you make your life easy. How you make your life easy? By being genuine. I like to do this, this, and this. If there's an opportunity where I can actually work in these niches, I will put all of my time, all of my energy, and I will provide as much as information or value or quality if I sell products or services, because I really don't mind. Same thing Steve Jobs. He enjoyed doing the marketing. Simple layout, simple packaging, very clean design, big picture, less words. Remember when they released the first MacBook, it was just one envelope, and it was the MacBook halfway through, and it says the world's thinnest MacBook. Remember, there is no interest, there is no intrinsic interest for these other people that you don't know to help you make money. There is no interest for them to share with you what is good or bad investment. There is no interest for these other people to actually share with you what they're doing, what they're buying, what they're selling.